up against 2%. Anything through 2.02, 2.03 would be something new. But you're absolutely right. This is underplayed right now, and that's going to change abruptly as we go. There's a meeting on Wednesday, I believe.
There is, and there's another meeting on Thursday at the Bank of England. There's another meeting on Friday at the BOJ. TK, your favourite line, that phrase from the Disney movie, A Whole New World?
It's a whole new world.
A whole new world. A whole new world. Where 21% price wage gains don't make it happen, don't get it done.
For the American audience, I mean, it's stunning to land here, you know, drop off the Gulf Stream at Heathrow and come in to a strike of junior doctors in 75 years, much like UAW, but in 75 years, you've got NHS strikes here over the shocking pay these guys make. Residents, they're making next to nothing here.
Compared to the United States.
Oh, it's amazing.
Well, auto workers as well, Bramo. Let's go through the numbers. Starting at 40%, down to 36 at UAW. Stellantis say, OK, let's go. Let's go up through 20. And nothing. Tumbleweed. UAW does not want to play at all.
Which raises a question, what will get it done? It's unclear. If it's not 20, if it's not 21%, if it's not 22%, if it's not extra sick days, if it's not anything else, is it just the full thing or else nothing? And this does tie together with the angst that you're seeing in the bond market. Basically, people coming out and saying this is going to keep inflation present for a longer period of time.
Well, what's Mari Barra do? I thought her conversation with David Weston was really apt. She was pretty tough about it and all. Does she dial 1-800-MUSTANG and, you know, call up Ford and say, let's go, what are we going to do? I don't sense any of that here as we begin the week.
Jim Farley, Ford, we've never seen anything like this. Dazed and confused. Lisa, we talked about the strategy coming into this ahead of the deadline. We were talking about how they might target one over the other. Traditionally, that's the playbook. Mr. Fain has not followed this playbook whatsoever.
And that was by design. That wasn't necessarily a bug. It was a feature of this entire program. It was to surprise. It was to shock and awe, to try to claw back some of the concessions that were made in the aftermath of the financial crisis and ahead of artificial intelligence and key changes technologically.
To me, so much of this, including the tension in the United Kingdom, is get it while we can, because if you lock in a disinflationary tendency, as many people suggest, you better get it while you can. Do you like my bow tie?
It's beautiful. What does it represent?
It's a Ferrari bow tie. Yeah, for those of you on radio,
over the weekend. Nice.
It's like very Carlos Sainz, you know.
OK. You want to talk F1 or move on?
No, we'll move on.
OK, good. I thought we were going to talk Formula 1 for a moment. Thank you, Ferrari, over the weekend. Let's start with the price action. Equity futures here positive by 0.1%, going into the central banking triple header this week. Federal Reserve on Wednesday. On Thursday, some Bank of England action. On Friday, the BOJ. Looking at this bond market, Bramo, I think we've got to talk about it again. 434 is so close to cycle highs, and I cannot believe waking up this morning it's hardly been talked about, with crude near new highs for 2023 alongside it.
And driven by real yields that are bumping up just a hair away from 2% at a time where people are gaming out. What does this mean longer term? Feeding into this argument, 10 a.m., and I think this is really important to watch. Energy Minister Prince Abdulaziz bin Salman is going to be speaking at the World Petroleum Congress in Calgary. I am so curious what he says about how much they're going to prolong their production cuts at a time where Brent crude is bumping up against $95 a barrel. Meanwhile, today, the UN General Assembly is holding its 78th annual session this week. Of note today, Vice President of China, Han Zheng, is meeting with Secretary of State Antony Blinken on the sidelines. Very curious about this, which came together quickly and quietly, especially in light of some of the tensions that have been percolating between both nations and the European leaders and China as well. And today, kicking off a week of the monthly housing data dump, 10 a.m. we get the U.S. NAHB Housing Market Index. Housing affordability is the most negative, the worst it has been in the history of this series going back to 1986 by the National Realty Association. And I'm wondering at what point you start seeing that feeding into some of this price-wage spiral. Rents are getting really expensive.
Big time.
Home prices are not affordable. How do people deal with that?
As we're in London, should we share some local knowledge?
I think so.
Rents in London up more than 17% year over year. 17.1%. Now, compare that to New York. We were talking about Manhattan rents being up something like more than 7% year over year. Bravo, 17% year on year. That is just absolutely phenomenal for all the wrong reasons.
And you wonder why people are striking. And you wonder why people are saying we got to get paid more. It is staring at them in their face when they see their rent increase, when they see their bill at the grocery store, when they see their petrol bills. See, I'm adapting.
Petrol. Do you like that? It was nice.
I was just like, you know, I'd like to be able to.
Have we got this? Are you bringing this back to New York? It's just petrol while we're here.
Well, while we're here.
Gasoline.
I think she's got a British accent going.
By the end of the week.
I'm not Madonna.
Give Bramo
actually.
till
Bring in
Friday.
Jeff Hugh and
Oh, digs at Madonna.
No, I
Sorry
mean,
for
it's
that,
just,
Lisa.
no.
Jeff Hugh joins us now, Senior Market
Hi, Jeff.
Strategist at BNY Mellon. Good morning, Jeff.
Got a British accent.
It's good to see you. Yields at 5% at the front end, pushing cycle highs on a 10-year. Dare I say it, is this the new normal? Are we getting comfortable with this?
Well, let's go back to Tom's point about real yields, okay? You can deflate via CPI, headline CPI. What if we deflate nominal yields by wage gains or potential wage gains? So then if you take the 20% or between 20 and 40% real wages, nominal wage gains, if realized, then real yields actually are very, very negative still. And then central bankers have to catch up. So there's a risk here, going back to your point about a wage price spiral that isn't going away anytime soon.
What is the x-axis on real yield? So here we are at 2%. I've done some fancy math. I get to 2.20. Maybe I'm still here at 2%. Whatever it is, there's a length of this new real yield. Where's the tension point out into next year?
So basically, you have to identify where potential GDP growth is, medium to longer term growth in the US. If that's a headline number, nominal number, 3 to 4%, then find your inflation target. Then if it's still 2%, right, then real yields, you still need to get to 2 to 3. Right.
To go nerdy on a Monday, R minus G, are we at a risk here where the interest rate becomes less than the small g, as Blanchard and Stiglitz, among others, worry about?
I'm glad you brought up Blanchard because I want to bring up another paper between him and Chair Bernanke.
Yeah, I saw that. Yeah.
When does this become a problem?
Such a nerd fest over on the port side of the desk.
Favorite part of the morning. In terms of wages versus price spiral, and with the oil prices going where they are right now, you get a price spiral according to that paper when labour markets are tight. Yeah. So here are the unions making the gamble or the determination in manufacturing. Labour markets are still very tight right now in the US.
Which raises a question, is this signal or noise? Because this is, yes, it is now tight. Although on the margins, you're seeing signs that you are getting some sort of labour market softening. Right. Is this the last gasp, as John was asking, of labour market power? Or is this something else that does have a stickier nature?
I'd say on a broader basis, this does feel like a last gasp if I look at things globally. But on the other hand, I'm an FX guy at the end of the day. Relative, it's all about the relative differentials. I think US labour market's still tighter compared to what we have in Europe right now. So on that note alone, probably labour has more bargaining power in the US compared to in Europe.
Does that mean dollar weakness?
I would say, short term, dollar strength, that's still going to be in play because that puts the Fed on a more vigilant footing, to borrow an ECB phrase. But net, I think pretty much that is in the price right now. So let's see where we go in the medium
Very
term.
cliché of you, Jeff. Let's talk about Powell on Wednesday. On Wednesday, we get a set of projections.
Yep.
Most people assume that for 2023, when we look at revised growth figures, they're going up.
Yep.
When we look at revised inflation figures, they're going down. What does 2024 look like for you and the team?
Still 2024, it's less about are they going to hike further. It's more about how long do US rates stay where they are. And that is what the BOJ will be looking at. And what, so you didn't mention Central Bank of Brazil, Central Bank of Turkey, and the Central Bank of South Africa, the Swiss, they're all deciding. And when they look at their nominal effective exchange rates, they'll all be looking at the Fed. How long can the Fed's projection keep the dollar strong? And then they'll have to calibrate their own forecasts accordingly.
Is that dollar problem bigger in Europe right now for you than EM?
I think that dollar problem is bigger than Europe because EM across the board, if you look at Brazil, for example, much higher real rates. So they've got the buffer, Europe does not.
Georgieva surprised us with a low 5-year growth view. Suddenly, oil 94. For Jeff Yu, where is the price of Brent that's a tip point that really accentuates that global slowdown?
Let's look at the individual markets. For example, China's at a slowdown already, no matter what China, unless you're looking at a real re-acceleration in China, which is not my base case, to 5 or 6%, then you get into a demand issue on top of a supply issue. That becomes a problem globally, and then that could be a tipping point. But right now, if it's just the US alone, and given US energy independence, I think it's much more manageable.
I'm glad you mentioned China. The Wall Street Journal had this big expose. China might be weaker than you think, and talked about focusing on the housing market. Other people have said, including Leland Miller of the China Beige Book, that from a U.S. perspective, this is what people want to see, but it's not actually what's happening on the ground, that there's actually a great deal of strength. Having been in China a couple of times recently, what's your view?
So domestically, I thought consumption was firm. So I was there about 3 weeks ago. People were spending. Some of the key tourist sites, like in Xi'an, the Terracotta Warriors, was basically several rows behind before you could actually see the soldiers there. But then on the way out, look at Beijing Airport. Just barely any international flights coming out. So that higher ticket consumption item momentum. So I think that's a bit more of a problem at this point. Going back to the real estate market, there's close linkages to the financial system in China. Stabilizing the real estate market means stabilizing the financial system, especially the trust and framework, shadow banking, for example. So that's where I think they are doing the right thing. But ultimately, how much more downside can you price in? Relative pricing, I think it's very limited.
Do you partition China into domestic balance sheet challenges, even out to Chengdu, or do you drag that into the more international analysis of renminbi and the rest? Do you partition or not?
So I think at this point, China's pretty much self-financed. We look at our inflow data. International financing for China's growth is very, very limited right now. So it's about domestic financial stability.
I agree.
And then the transmission is, if things go awry, can that drag down international growth further?
We've got to squeeze this in, Jeff. We're in Europe. There is an EV battle taking place. And to a greater extent, I think the transition to EVs is at the epicenter, the heart of this conversation with UAW and the Detroit 3 at the moment. Are we heading towards just massive tariffs for auto imports in places like Europe?
If you asked me 2 weeks ago, I would have said no, but I think something changed at the Munich Auto Show.
What do you think changed?
I think for the first time in 3 or 4 years, Chinese came back and European manufacturers looked at how far they were behind, not just in terms of cars, battery technology, and realized this is much more pressing than we thought, and you saw the reaction.
German manufacturers are scared of what's coming out of China.
Absolutely. And China saw this in advance. That's why they want to build in Hungary battery factories, and they want to build assembly plants in France as well. But even then, with that kind of cooperative approach, you're seeing the backlash already, and then you're seeing the backlash from Beijing. So this is going to get interesting.
Now, this is only one industry.
Yeah.
But do you think there's broader things at play here that ultimately influence things like flows that contribute to causing foreign exchange?
I think medium to longer term, let's look at the chip industry as well. That's going to feature heavily in terms of flows into Asia, into Europe. But the importance to employment, especially in Germany, and also that Eastern Europe that feeds into the German supply chain.
Poland.
I think this is, and politically speaking, this is absolutely going to be central to Europe.
Jeff, this was fantastic. Great to kick off the week with you here in London. Jeff, you there?
My pleasure.
Of BNY Mellon. Bramo, I'm with Jeff. I think you are too. Something did change on this front in the last couple of weeks.
And we had reports that some of the auto manufacturers in Germany were shocked at how much further ahead they are. Not just that, but have more access to the lithium underpinning this because they own that market. So at a certain point, if you can't compete, you regulate.
Well, it's not just tech, is it? It's not just the supply chains. It's cost.
Exactly.
It's cost.
Yeah.
And that's why I think these negotiations with the Detroit 3 and UAW just get bigger and bigger. When you start seeing 20% getting declined, how do they compete with Chinese EVs?
And this is what they're saying. How are we expected to remain profitable? How do we survive this if we're trying to compete with that? And the UAW said, figure it out because we don't want to lose our jobs.
Big story for us this week. The other one, of course, it is Bramo's birthday week. With us all week in London, Andrew Balls of PIMCO is coming up in the next hour. Live from London, good morning.
On the next episode of Hello World, meet the women driving Kyrgyzstan's tech revolution.
This is the first satellite in our country.
And some speedy horses. Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on Bloomberg TV.
Stellantis said they've offered 21%. What are you expecting out of tomorrow's negotiation with them? That seems forward movement.
We've asked for 40% pay increases, and the reason we asked for 40% pay increases is because in the last 4 years alone, the CEO pay went up 40%.
So 21% is a no-go for you?
It's definitely a no-go, and we've made that very clear to the companies.
Sean Fain, UAW president, speaking on CBS. We're living in a world where 20% wage increases do not get it done. And a difficult moment for the CEOs of Detroit's big three, GM, Ford, Stellantis. Lisa, how do you respond to this? When a CEO pay goes up 40% and they turn around and say, we're offering 20, you say you got 40, why shouldn't we? What does the CEO say?
The CEO says you're going to put us out of business, which is what they're trying to say, which is the reason why Ford came out last week with layoffs at a certain plant that was affected. So at what point does that translate at a time where there are going to be layoffs anyway? And they're trying to get the little power they have remaining before there are some pretty massive changes.
Obvious comeback as a journalist to that question then, TK, is ultimately if 40% pay increases mean you face existential risk, why are you getting one?
Oh, there's almost existential no. It's going to be interesting to see what the auto companies say. What I saw was a preponderance of pseudo-engineering analysis about putting an internal combustion engine together versus an EV. And there's some real stark differences there. There's some very good work on it this weekend. My answer is, so what? This is a cultural statement, which is simply, we sacrificed into your bankruptcies. Good morning, Dearborn. Ford, you didn't go bankrupt. And with that sacrifice, we need to get what? Some payback? I think that's where we're heading.
Question of the week, Tom. How long a visit will it take to have TK and Bramo pronouncing aluminium correctly? Never mind
well,
petrol
that,
and
but
diesel.
we're still going to
How
do
long's that
copper
going to
out
take,
of
Lisa?
Chicago.
Well, it just depends on a will. I mean, it's not sort of an incapability. It's just aluminum sounds better.
It's not about ability, it's about willingness. Okay. Equity futures on the S&P, totally unchanged. We're going nowhere. Looking at the bond market with yields a little bit higher by a single basis point. 434.45, very close to cycle highs. Looking at crude through 91 on WTI. We're talking about new highs for 2023. And a euro weak for 9 consecutive weeks at a close last week. The euro this morning slightly stronger, Tom. 106.71.
Sterling weaker too. There just wasn't a bid to sterling off the weekend, Friday through this morning, breaking through 124, and back at a 124 level right now. But John, sterling needs a bid too.
Coming up to the anniversary of the Liz Truss budget here in the United Kingdom.
Getting some press.
Lots of fun and games. Is that why we're here?
No, but
Make it up.
It's getting. Look, I got my bow tie tied like.
Did you see what a certain former governor of the Bank of England, Mr. Carney, said?
I saw that.
Some of that,
on the channel.
Yeah, that it was not Singapore on Thames, it was Argentina on the Channel.
I read every word of that.
Yeah,
that was before.
What did you make of that address?
I thought it was very carefully worded.
Okay.
I thought that I read the entire address, and I thought it was a very careful statement. And, they'll move forward in the debate. But even more important, Everton lost to Arsenal. So
you watched that game?
I had to watch it. Governor Carney told me I had to.
Okay, because he's an Everton fan.
Yeah.
I did not know that,
I
but there we
survived
go.
it, to be honest. Right now, we're going to survive American politics. Gregory Valliere briefs us this morning. Chief U.S. policy strategist at AGF. Greg, in the Washington Post, they talk about 5 ideological factions of the Republican Party. I didn't know that. Do you actually buy the idea, given labor unrest in America, given a possible government shutdown, that Mr. McCarthy's dealing with 5 ideological factions?
Oh, at least. Yeah, it's quite a spectacle right now. He's on really thin ice, Tom. I don't think he can get a deal before the October 1 deadline. So we do have a shutdown. I call it shutdown light because it's not going to be the end of the world. We're not going to kill Social Security and Medicare benefits. But if you want to go to a national park, you're out of luck. And I think the shutdown is going to last for quite a while.
Is there a shutdown in Detroit? What I find stark is the imagery and the great coverage by Bloomberg on this. I see them picketing, and there's like 7 people out front. It looks like a lineup at Denny's waiting to get in. I mean, is this like a real strike of labor like you and I remember? Or is it sort of kind of like pretend?
Yeah, it's not like what we remember, that everybody went out and you didn't selectively target factories. But I think there have been some sign of progress. I think Ford has been the most conciliatory. And I think the elephant in the room, obviously, is Joe Biden. I think Biden knows that Michigan has 16 electoral votes. And I think Biden will be influential in the final agreement.
What will that entail? Do we have a sense of what it will take to get it done and what that means for the viability of auto manufacturers that have traditionally added to the GDP and really fostered a lot of strength in the Midwest?
Yeah, I think it will have to be close to 30% in wages. 40% is out of the question, but I think the number will creep up. They may go back to more like defined pensions. They may have less than a 40-hour work week. It will be generous, and it will add to the perception that wages are sticky for the Federal Reserve. I think sticky wages are going to be around for quite a while.
Does this pressure, just sort of uniting the two ideas, does this pressure lawmakers to try to get a budget deal done just to avoid the extra hit on that front, especially at a time where there might be some agreement on things like border control between the Republicans and Democrats?
I tell you, Lisa, these people are on a different planet from you and me. They are fighting these parochial fights knowing they're going to lose. I mean, it's quite clear that this compromise over the weekend would never make it through the Senate. I'm not even sure it would make it through the House. So we're going to go through this exercise. And sadly, I think this drags on right into the holiday season, maybe after the holiday season, before we get a deal.
Greg, I got to turn the script. Once again, over the weekend, lots of discussion about the president's age. I think all of our listeners and viewers are sort of exhausted by the debate. But I want to know the Valier timeline to where I get an LBJ announcement like March of 1968. You and I were sitting on the couch watching the Bruins lose when that happened. How do we get Joe Biden out to where LBJ was in March of 68?
I don't think he realizes there's a problem. More and more Democrats I talk to, almost all of them, as a matter of fact, say they would like to see Biden step down. Two problems. Number one, he is delusional and he doesn't think there is a problem. Number two, there is no logical successor. That's the problem for the party.
Do the polls scream, Greg, that there's a problem?
Absolutely. I mean, about 70% of Democrats say they would prefer a different nominee. I mean, that I've never seen a gap like that. So you could have more pressure. You know, the other thing, guys, I should mention is that filing deadlines are fast approaching. By late October, early November, it's too late to file. So any talk about some last-minute rescue for the party, I think, is unwarranted.
Greg, before you run, before you go, have you heard about that missing F-35? Have you read the story on that?
The missing what?
F-35 fighter jet gone missing.
Yeah.
In the Carolinas.
Yeah.
Greg, what on earth is going on? How does the military lose an F-35?
I know, it's quite a story. And yeah, I think it's going to get bigger.
Greg Valier of AGF, thank you, sir. If you don't know what I'm talking about, I'll share the Washington Post story with you.
Greg, thanks.
It reads as follows. An advanced F-35 Lightning II jet went down somewhere near Joint Base Charleston on Sunday afternoon. And the pilot ejected safely and was in stable condition, the base said. But the problem is that the responders aren't sure where the plane ended up. Believe it or not, the jet's transponder, which usually helps locate the aircraft, was not working for some reason that we haven't yet determined. So we're sitting here, and somewhere, someplace, there's an F-35 that the military can't find?
It raises questions about whether someone interfered with its signals and then maybe took it somewhere else. Well, I mean, what else can you really start to question where things went?
I would question the moment I saw the news, to John's good point, John, I'm glad you brought it up, the conspiracy theorist people will click in here with a vengeance. You know, there'll be an investigation. Obviously, somebody screwed up big time. That's a piece of hardware.
What blows my mind is that at some point on Sunday, there was an F-35 just sort of flying through the sky on autopilot without a pilot. Like that's
it doesn't make any sense.
That makes no sense at all.
Correct.
It's incredible. Okay, we'll see what happens with that story.
I think it's really interesting, too.
I'm pleased you're on the same page. Madeline Jones of Oaktree is coming up. Before we get there, let's check out the price action for you. Equities on the S&P 500 up by 0.1%, just a little bit higher. And the bond market yields a touch higher as well by a single basis point, 434.25. Huge week for central bank decisions. Wednesday, the Federal Reserve. On Thursday, the Bank of England right here in the City of London. Then on to Friday, it's the Bank of Japan. Live from London this morning. Good morning.
what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Yes. Not keeping. Look, people have conviction, or they invest if they invest for the right reasons, just keep at it.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
Equity shaping up as follows on the S&P 500, slightly higher, nudging higher by 0.1%. Likewise on the NASDAQ 100, just drifting higher by 0.15, coming off the back of a really mild week of losses on the S&P for a second consecutive week. Into the bond market, hardly talked about, but worthy of attention, a 10-year yield, very close to cycle highs, 434.25 on a 10-year right now, yields up by a single basis point. The intraday cycle high on a 10-year was back in the summer, late August, Lisa, 436.18. We're not far off, are we?
And how much is this being driven in part by the wages that we keep talking about, this concern that wage price spirals are going to keep boosting inflation, or how much is this driven by something else with budgetary reasons? Either way, it to me is underpinning the tech underperformance and a lot of the questions in markets going forward.
I'm going to go all Neil Dutta on you here from across the pond, and Neil Dutta would say it's probably a burgeoning economic recovery and a real buoyancy to it with some demand function, which just lifts up yields into maybe a higher nominal GDP than anybody imagines.
Do you want to throw crude into that as well? 94 Brent, 91 WTI?
Yeah, I mean, what part of EM? We've got Christian Mela coming up later in the week with JP Morgan. To me, that's a key interview here. He's going to reframe EM demand for oil. Granted, it's a shock to see how fast oil's moved. And this morning, I think we saw 94.74 intraday high on Brent crude. That's shocking statistics.
It's amazing to see it, Tom, this close to triple-digit crude at the same time, yields near cycle highs when we were meant to be talking about recession at the end of the year, according to the outlook at the start of the year. I want to finish on foreign exchange. 9 consecutive weeks of dollar strength against a weaker euro. The euro right now 106.72, showing a bit of strength and positive by 0.1%. Standout decision of last week, ECB President Christine Lagarde rocking a hard place, TK, and hiking into it.
Oh, yeah, under 107 is where euro is, and we'll have to see how we do. 1 bank, 2 banks, 3 banks this week as well. But the answer is we've got resilient dollar, and Jeffrey Yu made clear short term that will continue.
Dollar strength, and maybe, according to Jordan Rochester over in Nomura, we come back down to about 105. 105 on the euro. Under surveillance this morning, TK said it, key week ahead for central banks, starting with the Fed on Wednesday. Traders expecting a pause, while a rate hike from the BOE on Thursday is seen as likely. The BOJ rounding out the week with their decision coming on Friday. Out of those three, Bramo, what stands out for you? Fed, Bank of England, or BOJ?
I think it has to be the Fed and the statement of economic projections in particular. People looking at the dot plot and understanding if they upgrade financial growth
this time around.
Yeah, but do they upgrade their expectations for the economic growth in this country? And then do they just assume inflation can keep disinflating immaculately, or does that raise some serious questions about how far they have to go?
Well, you say, will they upgrade? Are they going to mark to market their forecast?
Okay, same thing.
Basically.
Yes.
Because they got it wrong.
Exactly.
This economy's been so much better than people thought it would be. And based on the incoming data, Tom, we're expecting that GDP revision up, inflation down. It's 2024 that's going to catch my eye.
Yeah,
where do they see 24 going? And how much wood is there to chop? How much can you push against those rate cuts that people still expect later next year?
To your point, and Lagarde didn't go all Draghi on us and give us a lot of certitude about 2025. You're not going to get that from Powell. These guys are going to be focused on a massively data-dependent set of meetings into next year.
Pretty sure Lagarde's just desperate to get through 2023 before talking about 2024. The update on UAW, President Sean Fain rejecting a 21% pay increase from Stellantis as the strike against the three major US automakers rolls on. The offer coming in well below the 36% raise the union is seeking, with Fain calling it a, quote, no-go, signalling the union and the automakers remain far apart in negotiations. If you follow the interviews, Lisa, I do find it curious. Is it 40 or is it 36? It dropped from 40 to 36. Then in conversations I've heard in the media, he's still talking about 40.
So I don't really understand, and we don't understand what the line in the sand is and what they're pushing for. Either way, it seems like the Detroit automakers are already paying vastly more than Tesla, for example. They're paying about $66 on average versus $45 an average. And Wells Fargo estimates that if they conceded to all of the demands, that would go up to $136 per hour on average for all of their employees. So that's what we're looking at here.
The final story is just to make people living in Manhattan feel better about themselves. Britain's property market breaking another record. Rents growing at the fastest pace in at least a decade, while homeowners pushed up asking prices for the first time in 4 months. Tenants paid 12% more than a year ago, according to data from Hamptons, with the average rent in the UK and Britain now £1,300 per month, the highest on record.
Give us an anecdote, John, of all your contacts, particularly in the Midlands. You know, I don't need the details of family and all that, but give us a John Farrell anecdote about how people are living this.
I won't share a personal anecdote, but I think we should do the compare and contrast. It is so different in the UK because of the mortgage market structure. And Lisa, you and I have talked about this a million times. If you've got a 30-year mortgage in the United States, sit on it, hold on to it. Tease people about it, bully them if you want. I don't know what happens around the dining table. That's what Bramo does to me every single time with their 2% mortgage. But you're going to hold on to it, Lisa, and you're not going to sell.
Right.
In the UK, that dynamic does not exist. So you're going to see that effective rate in the mortgage market in the UK come up much more higher, much more quickly than you're seeing it in the United States at the moment.
And how much does that really sort of fortify some sort of wage price spiral if people are realizing that they cannot live with the same salaries at the same levels? And so it just keeps going up, and it's just this whole kind of, spiral.
So Governor Bailey's got short and fixed non-legs. Is that what we call that?
Well, Bailey's also staring down the barrel of something like 8% wage growth as well.
Yeah.
Inflation dynamics in the UK are very different. What's intriguing about the BOE decision on Thursday is that I see a lot of people are expecting a rate hike. Then I look at the recent communication from the core of the Bank of England. They're not screaming rate hike on Thursday at all. So there's a bit of a divide, I think, between the communication I'm hearing from Threadneedle Street and what the economists here in London are expecting on Thursday.
Yeah. I was having my hot brown water this morning. Kathleen called in.
Okay.
My phone rings. It's Kathleen. Kathleen says, my daughter's going to be on with you today. Can you be sure you pronounce her name right?
Are you going to pronounce it right now?
Madeline. It's
Madeline.
not Madeline. It's not
Madeline.
like Bemelman's Bar, or, Madeline
It's not Maddie,
Kathleen,
it's Madeleine.
Yeah.
Okay.
Kathleen, thank you so much for informing me. Madeline Jones, good morning.
Thank you so much.
What John just talked about, we talk about it in COSMIC, but you live the non-fixed floating rate market. If you were to speak to your mother or anybody else today, what does your world of floating rate debt at Oaktree do to the people of the United Kingdom, or for that matter, adjusting out over time in the United States?
Well, the floating rate market, so we're mainly talking about loans here, bank loans, which are supplied to single B average quality credit companies. And so these were structures that were put on back 3 years ago, maybe more than that, when floating rate was negative in Europe. And they weren't designed to contemplate the sort of rate hikes we've seen in the environment.
So when they reset, it's, to be clear here, price up and the asset value goes down.
Well, I think it's not as linear as you're making it out to be, because it comes back down to what's the structure of that balance sheet look like, and can that company tolerate that inflection of floating rate underlying rates that we've seen. Some companies can and some companies can't. I think the good news for Europe is that a lot of companies can tolerate it. They have not got debt maturities for some time, so some of them with a fixed rate market won't have to reset their debt. And also, we've had 2 or 3 years of quite shocking environments, not just COVID, but also the Ukraine invasion in Europe. And so companies have been quite conservative with their balance sheets, paying down debt, but not making big acquisitions, not doing shareholder buybacks and dividend payments, becoming a little bit more aware of the fact they've got rising cost of debt that they've got to deal with. So although we do believe there's a cohort in there which is structurally challenged because of the balance sheets they put on years ago, we don't think it's a huge insurmountable problem for the market.
Can we build on that a little bit more? Just the difference between and in Europe, given so much is done through the banking channel in Europe compared to, say, the United States. Does that mean the speed, the magnitude of the pass-through from rate hikes into the real economy is different? How does that work?
Well, you're right. On the corporate side, more floating rate corporate debt. So the feedback to the corporate is very quick, but the transmission mechanism to the consumer is still quite slow. And I don't think we've clearly not seen that yet. And I think for managers, you have to decide whether you feel as though, can we rely on that consumer still being robust and the broader economy still feeling isolated from that? Or is that something that's delayed and is coming further down the track and a recession may be just pushed out, a year or so down the path?
But this is sort of a what goes first, a chicken or an egg kind of question, right? When will the transmission effects actually go into the economy for the consumers and then for what we're seeing at corporations? In the meantime, borrowing costs don't seem to have torpedoed corporate models. Why is that? Why have things been so resilient after 10 years of people warning that it would be Armageddon if we got anywhere above zero?
Yeah, well, I think it's partly delayed because the fixed rate part of the high yield bond market, and a lot of companies have a mixture of fixed and floating debt, so they're seeing the immediacy of those floating rate loans impacting them. Some of them hedge that out, so it may not be as clearly impacting today as you might think. But with the fixed rate, they're going to have to wait till the debt matures before they really feel the pressure of that rising rate. And maturities, they aren't that significant this year. Next year, they start to creep up. In 2025, you'll see a much higher rate of need for refinancing at that higher cost.
So as an investor, how do you get in when the going is good? How do you know when there are opportunities, when you're expecting distress to come down the pike in a more material way, when you see the potential for yields to go even higher, but already are able to capture quite a bit of yield relative to where it used to be?
Well, that's the whole job, is to dissect that. And I think the market is pretty good. Frankly, the market's pretty good at that. It's already for quite some time decided which of these company balance sheets are just not sustainable. And these are trading at 70 cents on the dollar, something like that. But it's around 5-6% of the market is down there. And the market's saying that is a structurally impaired balance sheet, which will need an equity injection, a restructuring, can't survive in this higher rate environment. But for the rest of the cohort, a large, significant, sizable market is going to be fine and weather the storm. It's just thinner. You have to be very, very careful. Default avoidance is in our DNA. We have to focus on protecting ourselves against default and really stress test that thin layer of cash flow which is left in some of those companies.
Crane's a moment ago in New York, the real estate people published an important article for New York City, which is that old buildings have an uncertain future. I'm going to assume for Oaktree, old buildings with an uncertain future is a huge opportunity. How do you play commercial real estate in London, in Manchester? Manchester's north of London?
Manchester is very much north of London.
How do you play it across the United Kingdom and not in the romantic fancy spots like the skyscrapers around us here? How do you play commercial real estate as an opportunity?
Well, I think that's where you have to have that analytical team that understands the difference in the geographies and markets and what's the supply-demand fundamental looking like within a location. It can vary. The great thing about Europe is that it's so varied across so many different geographies. That makes it very interesting for people like me to find.
Well, where's the city? I mean, nobody's
places.
listening. Where's the city that has an opportunity right now?
Well, I think corporate real estate isn't in my wheelhouse. I'm more in the corporate debt market, so cash flows are the predominant mainstay of my investing potential. And you'll find lots of good companies across lots of good markets. Some of the places we've been rowing back from have been traditionally some of the best because they tend to get over-levered.
Name them.
Well, one, I mean,
You'll do better than me.
As a geography, when I look at our portfolios, everything is built from one issuer, granular up. It's not taken on a top down. But when you look at us in a portfolio where we were a year ago where we are today, somewhere like Germany has become a lot less significant in our portfolio.
Interesting.
Because we found, a lot of industrial Germany was successful because it relied on lower cost of energy. And now that dynamic has changed, and admittedly they did a brilliant job of shoring up that energy shortage crisis we were very worried about. But it is still structurally more expensive, and that challenges the competitive nature of industrial Germany. So for us, we've tailored back down some of our exposure there. It's things like that. It's all built from the bottom up.
Yeah.
You can start to see a picture of where those bets are taking place.
Fascinating. Madeleine, thank you. Madeleine Jones of Oak Tree. You want to do a shout out to Madeleine's mom again?
Kathleen, I hope I nailed it.
Okay,
Madeleine.
Okay.
Madeleine.
All right. It's Madeleine. All right.
I know Madeleine for the Bemelman's Bar.
Are you flirting with Madeleine's mum?
No.
Is that what's happening? I'm Rita Sen.
Kathleen briefed me.
Energy Aspects on $90 crude up next.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
So what do you have for skincare for men in their 70s that have a lot of wrinkles? I mean, is there any way to get rid of the wrinkles?
I have a lot of amazing things,
Really?
but maybe it'll be a little bit beyond skincare.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Should they worry about $90 crude if it's just a supply shock? Should they worry about that?
They should. I mean, otherwise they're going to repeat the same mistakes they made in 2022. In some cases, prices were falling, energy. Services were inflating, but if you wait long enough, services will start to disinflate as well. And the fear was that goods would start inflating. Now we're seeing goods are going to start to inflate. And that's, I suspect, will keep people up.
That was Mohammed Al-Arian of Queen's College, Cambridge, speaking to me on Friday on the impact of higher oil, potentially for the Federal Reserve, which meets on Wednesday. Crude this morning, 91.45. Brent crude having a little sniff of 95. This is stuff we haven't seen, Tom, for all of this year through 2023. And crude is at the heart of everything, I think, right now that we're talking about.
Three of us got together. We almost never see each other, folks, because of the crazy New York schedule. And to have a full English, all three of us, was really something here. This morning. And
okay,
John,
let me cut in. Headline. I come downstairs today. TK's having a fruit bowl.
Yeah.
A fruit bowl.
Yeah.
You were there for it.
Yeah,
it was
I saw
a fruit
it.
bowl.
Witnessed it.
There was witnesses.
That was new. What came before the fruit bowl is what I want to know.
The full English.
Okay, all right. Good to know, TK.
You nailed it, John. And to me, the lead story this morning for global Wall Street isn't happening. And the bond market is moving. It's fractional. We're all jaded by it. But nevertheless, the levels we're quoting, the real yield, Lisa, you mentioned 1.99. These are substantial numbers. And they change the dialogue of these three Fed meetings, particularly the one we're underplaying at 147 yen, which is Japan, the last one.
I like what Mohammed had to say, that this really speaks to this question of goods disinflation. and goods reinflation because of petrol and how it influences everything
Nice
in terms of getting things from one place to another, and transportation costs as well as production costs.
I'll ask the question that I asked Mohammed of you then, Lisa. Do you think it is something the Fed can ignore on Wednesday?
They can't ignore it. They're going to say it's transitory. But at a certain point, if they start to see goods reinflate, can they say that's transitory too? Can they say that that's manipulative? How can we know if we don't know whether the oil price is higher because of demand or simply because of the supply cuts?
What's the single effect you get from the wage negotiations with UAW and the Detroit 3? TK, I think for a lot of people who have their annual wage negotiations, looking at what's happening in Detroit kind of matters. They want a bigger share of that. Aren't they going to be more emboldened to go and ask for it?
Lisa was at Teterboro, Middletown, I can't remember which, getting on the Gulf Stream, and she put out that chart on union, and it's really spiked up. I mean, it's back 10, 15 years to the angst we're seeing now, and I do agree it percolates, maybe is the right word. It percolates, like what the percolation of water you do to make hot brown water.
Okay. Do you want to explain what you think hot brown water is? You're calling tea hot brown water?
Well, I was watching. I watched Richmond this weekend. They got relegated, but I watched Richmond, and what was great was walking down the street in West Ham. People were walking by me, like to the
Where did you go?
Ballpark. I was like
to the ballpark.
Yeah, they're going to the ballpark.
We're going to stop this now. Brent crude 94.53, TK WTI 91.54.
Let us move on. Amrita Sen joins us to save us here from the ballpark, co-founder, head of research at Energy Aspects, and critically joins us this morning from Canada, which is an oil producer. Amrita, within your racket, within your industry, are they looking at this as a surge that can ebb, or is there a feeling, within the macro petroleum business that this is a new pricing to stay?
It's still early. It's not even 5 a.m. here, so I don't know how they're feeling. But if I had to guess, Tom, I would say they are all going to be very happy. I mean, of course, there's World Petroleum Congress over here. Ministers from all around the world are gathering, including Prince Abdulaziz himself. There's lots and lots of talks with both consumers and producer governments really over the next couple of days over here. And I think the reality is that demand has surprised to the upside, regardless of all the recessionary fears that we've seen. And I think that's why what is interesting for me is, yes, crude is getting all the headlines now. We're talking about it. But if you look at products and crack spreads, that have already been high for the last few months. Gasoline, diesel, they've been trading at $120+ per barrel. Crude was 80. Now crude's catching up, but those prices haven't necessarily gone up further. So this is more of a redistribution between refiners and producers than really end users feeling the impact. So I know why the media is focusing on the crude, but I don't think the end user is necessarily seeing that big an impact versus a few months ago.
Right. What is the representation or tone of China is the marginal demand elephant in the room at the Congress? Is China there in a big way?
I think there is going to be presence for sure. And I think, again, the dichotomy between Chinese macro and Chinese oil demand is definitely going to come up, something we've been highlighting for some time now, because in the West, and Western analysts keep looking at the Chinese macro data and saying, well, oil demand hasn't been performing yet. Oil demand has actually been hitting record highs because it's become more consumer oriented. Plus, China's got some strategic petroleum reserve filling going on as well. In some ways, the US has been drawing it down last year, and China now is actually refilling it, having locked in some favorable prices earlier in the year.
What's the pressure on Prince Abdulaziz today, who's going to be speaking, I believe, around 10 a.m. Eastern time at the Calgary conference, to really increase production, especially if this is being driven in part by demand, not just their supply cuts?
Well, I think he's been very clear that, look, there still is a lot of uncertainty, be it from the Fed itself or even China, all the kind of noise that's coming around. And he has to be 1,000% confident, I would say, not even 100%, that there are not going to be any of these, surprises with the Fed, for instance. And it's a bit of a chicken and egg, right? If oil prices go up, what does the Fed do, as you guys have been talking about as well? But I think they are going to be cautious. They want to ensure that balances, or at least inventories, do not build because of those macro concerns. And look, Saudi Arabia has extended the cuts till year end. So has Russia. It kind of gives, for them, the main thing they want to provide is stability. And I think that's what he's trying to do. And I think that's what he's going to focus on today.
It's a really interesting confluence of events. At the United Nations, they're holding a conference right now where a lot of the focus is going to be on sustainable energy and moving away from fossil fuels. You have electric vehicles taking over. That is underpinning some of the discussions with the UAW. How much is that underpinning Saudi Arabia's decision to cut production, to get more profits now before some of these groups phase out fossil fuels, before they become less of a focus later on?
Well, you could argue that goes both ways, Lisa, right? I've also heard the argument that that's why other countries want to flood the market and make sure they don't have stranded assets afterwards. I don't think OPEC plus policy works like that. We've written about this as well, that ultimately Saudi Arabia and most OPEC countries are revenue optimizers, right? What they are trying to do for themselves is saying, okay, if this is the price and we cut production or raise production, what is our total revenue going to be? That is what they are focusing on right now. Of course, they are concerned about long-term energy transition, but I wouldn't even use the word concerned. I think they embrace it. They are doing a lot around it. And they very much are aware that oil has to fade over time. They just disagree with the timelines like the IEA has put out.
What's the Emirates timeline of an oil vector, I guess, in June or July of 70-something up to 94.51 right now? Is that just a continued vector up? Do you see 95, 96, 97, et cetera, et cetera, et cetera?
Yeah, if you remember, Tom, our price forecast for Q4 was an average of $92 for Brent. So I think we've kind of hit it now. So the question is, but look, an average of 92 does allow oil prices to go to 100. We're putting out a piece later today, which is calling for $100 by Halloween for Brent. And again, this is just a trajectory. And at this point, look, of course, it's a short-term thing, right? I'm not saying it's going to average above 100, but could it go to $100 for a bit? Absolutely, yes.
The triple digit by Halloween, Amrita, is that just a marketing mechanism? Just, triple digits, Halloween, or is there something about the next month?
No, it just rhymes, right? 100 by Halloween. That's why. No, I'm joking. But it's
nice.
No, I think, look, fundamentals are very, very strong right now, but also positioning. And that's one thing we shouldn't miss. A lot of hedge funds are very underpositioned in crude because of the macro concerns. Now we are seeing quite a bit of passive money come back as well. So I think the combination of that could actually lead to a temporary kind of upswing in crude. And that's why I'm not saying we're not expecting it to average above 100, but it could go above 100 in the next couple of weeks.
Only $5 away right now. Amrita, thank you. Amrita Sen of Energy Aspects. We'll run with that headline. $100 crude by Halloween, TK. It's just around the corner. It's hardly a call at the moment, is it?
Got to change my outfit for Halloween.
What are you going to wear? A barrel of crude?
Yeah. That'll go as a barrel. I like that idea.
We once joked we'd go as QE, TK, QT, and all of that good stuff, and now it's $100 crude.
I don't think this is a small idea. Javier Blas talking about Arab Light already there, and the way he looks at it, I don't understand it, but that's what he said. And
94.51 on Brent. I've just seen him out the corner of my eye. Andrew Balls of PIMCO coming up next. Very cool. With us here in the studio, here in London. Live from London this morning. Good morning to you all. With equity futures slightly positive, this is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I found myself in a spot where I was constantly getting new challenges. A lot of, I think, the best mentorship I had at Bridgewater is because people often saw in me the potential to do things I didn't even see in myself yet.
So I am expecting there to be not necessarily a wholesale adoption across the world, but we have many governments that are looking what the EU is doing and are in the process of introducing similar regulations or variants thereof. then I think it'll be very interesting to see how these global companies will adjust their business practices. Will they implement the obligations of those regulations only with respect to Europe, or whether they do it globally? And sometimes it may be very difficult in today's conversation environment about which is more hostile or more skeptical of the big tech companies. If Facebook, for instance, cannot use targeted advertising, or Instagram cannot use targeted advertising on minors in Europe, can they then justify that they continue that very same practice in the United States and elsewhere? Because there will be many who say, well, you have ceased those activities in Europe. Don't you care about protecting our minors as well? And it is hard for reputational reasons for Facebook, for instance, then to confine its conduct and the changes it will have to make to Europe alone. So I think we will see some ramifications of those regulations outside of Europe as well.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone. Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening, because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
We've yet to see the full effects of the previous tightening come through into the real economy.
We have structural imbalances here in the U.S. that no one wants to deal with in Washington.
The bigger concern would be that things get unruly in China.
I think the Fed is going to be paying very close attention to the path of energy prices ahead.
The Fed will do what we all expect it to do, which is to pause and basically indicate they're data dependent.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Live from London, on the edge of saying good afternoon for our audience worldwide. Good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market on the S&P 500, just a touch positive on the S&P. Going into a massive week for central bank decisions. Wednesday, the Federal Reserve. Thursday, the Bank of England. On Friday, TK, the BOJ, just around the corner.
Translated with $94 oil, up goes a gallon of gas. I know they don't pay attention to that. Somehow I think they will on Wednesday, and I would suggest the governor of the Bank of England, you ready for this? $7.24 for a gallon
painful,
of
right?
petrol
in
the United Kingdom.
That's real money.
That's real money. I mean, we don't look at that. The cars are smaller. Lots of electric vehicles here, way more than I would perceive in the United States. But I'm sorry, inflation's there. And as you said earlier, John, in our breakfast this morning, it's just real simple. I mean, all in, inflation's a story, higher yields.
Look, this hurts, even with 7 to 8% wage growth in this country at the moment. There's a lot of difficulties here in the UK, just as there are over in the United States right now. Do they get harder? Lisa, at the moment, we're looking to a growth forecast from the Federal Reserve on Wednesday that is set to be revised higher for this year. I've got no idea what 2024 looks like.
Recession coming.
Reflecting that, to some extent, yields near cycle highs, crude near the highest we've seen it for the whole of this year. Bramo, these kind of things, I'm going to borrow your word, percolating and hardly been talked about this morning. I find this bond market move, 434, right by intraday cycle highs, and I don't see a headline anywhere on it at all.
And it's being driven by real yields, which means that the inflation adjuster, the expectation of inflation baked into the market versus the actual yield is the highest going back nearly to 2009. We're bumping up against 2%. At what point is this a statement about some of the wage negotiations on the heels of some of these price increases, pointing to some sort of wage spiral? And at what point is this pointing to some sort of fiscal pushback? And at what point is this just great yield, go get it, because you're not going to get it for very long?
I'm not in the rate of change of a quote-unquote wage spiral and all the emotion and baggage of that from the 1960s, but Andrew Balls is over here next to me. We're going to bring him in a moment. He's nodding his head on real yields. And the key question for me is the benchmark real yield that the pros follow is a 10-year yield. And the answer is the 5-year real yield, to me, has uncommon value. And I'm sorry, it's a melt-up. There's no other way to put it.
We'll return back to that in just a second. Just to give you a flavour of what's happening cross-asset at the moment, futures slightly elevated by 0.1% on the S&P 500. Last week, a very mild week of losses on the S&P for a second consecutive week. In the bond market, yields a single basis point higher at 434.25. And just to finish on the euro, Lisa, 9 weeks of dollar strength against a weaker euro. We're trying to bounce back from that. 106.67 on the euro against the dollar.
The FT did a poll of economists who 40% of them expect more than 2 more rate cuts or two more rate hikes, at least in the next couple of years. Today, we're looking at oil very much front and focus. 10 a.m. we get some words from Saudi Energy Minister Prince Abdulaziz bin Salman speaking to the World Petroleum Congress in Calgary, curious how he dovetails supply versus demand. How much of the increase in crude really has come from a stronger than people give credit to China and just the rest of the world. Today, sort of in contrast, you hear a lot about electric vehicles and renewable energies at the UN General Assembly, which is a beginning. We're also going to hear from perhaps a discussion with the U.S. and China. More on that later.
Just to say that's why we're here.
What? Because
to avoid this.
100%.
This is like the worst week of the year living in Manhattan. Unger. It's just, I hate it. The traffic everywhere. I wish they'd move it.
Yeah.
Maybe that's controversial. I don't know. I wish they would move the UN General Assembly
Afterthought
out of New
schools
York,
being
out of
shut down
Manhattan.
this week.
Well, yeah. Honestly, we all had the same thought. How lucky are we that we get to be in London?
Take it to Queens.
Okay. Meanwhile,
Take it to Queens.
Meanwhile, so it is also, of course, celebrating birthday week. We'll have to do this every year. Today, also, we're kicking off a week of monthly housing data. This is when all of the data gets dumped out, including today at 10 a.m. Eastern, the NAHB Housing Market Index. This comes as affordability hits the lowest levels, at least by this measure, in the United States, going back to when this series was created in 1986. This raises a question: what goes first, the price of houses, or do wages just keep going up to respond to this?
That's all the data, the look ahead for today, and a sneak peek of the rest of this week as well. With us around the table, you've got a sneak peek of this. Andrew Balls, Global Fixed Income CIO at PIMCO. Andrew, good morning.
Good to be here. Thanks very much.
10-year, fantastic to be with you. 434 on a 10-year yield this morning. To build on what Lisa said, is this a moment in time, buy, lock it in before it goes away, or can we live with this?
So I think it looks pretty attractive. We're in the middle of our forum discussions, which we had in London as well, actually. So we're still talking about this with the investment committee.
Give us a head start.
But it looks pretty attractive here. If you have a high quality bond fund, 5-6% yield in US dollars with more credit, kind of 7%, maybe 7.5% yield. This looks very attractive. Equities have done very well this year. Looking forward, 6.5%, 5.5% type yield for a bond fund looks very good to us.
There are 2 points here. One is, does this look attractive now? And the second is, where is the next rate? Where does the move come from? Is it higher or is it lower? There are 2 different discussions, right, and how sticky this is going to be. How big is the argument right now in some of these meetings at PIMCO?
Well, I think you were talking about real yields, and I was nodding. When you look at real yields and look at long-term history, it's starting to look attractive. Here we had this period after 2008, quantitative easing and all of that, and depressed real yields. But you're now seeing real yields at attractive levels, and nominal yields I was quoting before look pretty good to us. You have, in the outlook, you have inflation still stubbornly high at the core level, improving much faster in the US compared with Europe. But I think the jury is still out there. But then don't forget the recession risk. We have had very significant global tightening across the world, and yes, the data has been better than expected, particularly in the US this year. But as we all know, these central bank tightening takes time to feed into the real economy. So looking forward, the jury's still out on inflation, but that recession risk remains significant.
Critical question for PIMCO, and it's not only the heritage of PIMCO from Bill and Mohammed forward to the great call you people made a number of years ago. You've got the advantage of the former vice chairman, Richard Clarida, I believe, darkens the door. I can just see balls and Clarida in a debate over where we're going to reset on R-Start and almost on a global R-Start. Do you sense within all the great work you do, Andrew, that we're going to reset at a new rate regime, something that we've never experienced before?
So I think it's an interesting debate. Rich and I tend to agree and on this point that as you look forward beyond this inflation episode, the cyclical rise in policy rates we've seen, there's good reasons to think that R-star neutral rates are at the low levels that we've seen for the last several years. We'll see this in the Fed's projections this week, but the chances are the Fed will also see 2.5% as their long dot. So compare the 4.5%, 4.3%, 4.4% for the 10-year Treasury, or look at the forward rates and compare it with that neutral anchor. We believe that anchor remains the correct way to do the analysis, and then the long-term outlook versus that then looks very attractive, I'd say.
Does Lagarde have an R-star? Does Ueda have an R-star? Dare I say, does Bailey have an R-star?
They all have the variations on this. I think the Fed maybe is a bit happier to talk about it sometimes, but again, looking at Bund yields now. Even in Japan, you are getting to levels in terms of the 10-year yield where it's starting to look more interesting. Control for volatility, return per unit of volatility.
I agree with that.
And it becomes a little bit, once we get beyond the YCC, once we get beyond the yield curve control. So if you think that you have that anchor, and we do, then look at your 5-year forward rates to isolate the long-term expectations beyond this central bank cycle. And that's the environment when it's much easier to come in and be positive like I am today compared with the lows of the COVID period.
We don't spend nearly enough time talking about this. How different this regime is to the regime of the last decade before the pandemic. How different is it for you and the team? What have you had to change just in terms of your approach away from zero rates and QE forever towards potentially the Bank of Japan hiking interest rates, the ECB going to levels I never thought they'd get to? I thought maybe they'd go back to zero, but here we are at 4%. How different is this for you and the team?
Well, I think it's very different, and I think as a bond manager, you like to see these high yields at the front end of the curve. It becomes really interesting, the relative value at the front end of the curve. The zero yields, remember those, something that hopefully we've consigned to history. I think one important thing looking forward, different to the last 10 years, is uncertainty around inflation. So we see inflation coming down towards central bank targets, a little bit above, but coming down over the course of next year. But I think clearly there's much more uncertainty in the inflation picture for the next few years compared with the last decade. And so back to the discussion before, you should be getting term premium. You should be getting paid appropriate term premium for holding the 10-year part of the curve. But again, comparing our forward rates with our expectations for our start, it looks like you're getting fair compensation after a period when, with quantitative easing and all, the risk premiums were really compressed.
What about in credit, though? I mean, given the fact that you're looking at greater vulnerability to an oil price shock or a unionization shock or a technological shock, some of these things that become that much more important when your cushion is that much smaller.
So I think the baseline for credit looks fine. I think credit should do well in an environment where you avoid the tails, not just about recession, but real recession, not just a technical recession. And on the upside case, if inflation is coming back into line with that fairly benign middle path, then credit should be fine. From our perspective, though, we want to guard against the tails. And if we do get deeper than expected economic downturn, that's going to be painful in credit. So I think up in quality, IG looks attractive versus high yield. Avoid cuspier credits, avoid any kind of exposure to real default risk in what remains a really uncertain environment. It's not often you have these sorts of tightening cycles globally to such an extent. And then the final thing, there's lots of other stuff we can do in the world. US agency mortgages, very, very high quality instrument, very attractive in terms of the valuation. So again, if you can get to the kind of 5-6% type yields on core bonds, that looks pretty good to us in terms of the next few years.
Andrew, always a privilege. Thank you, sir. Andrew Bulls there of PIMCO. Your bond market, 2-year just north of 5%, 10-year at the moment about 4.34. If you are just tuning in, welcome to the program. Equity futures on the S&P positive by literally nothing, 0.04% higher. Outside of that, in the foreign exchange market, 106.68 on a euro, positive by 0.1%. Crude, new highs for the year in sight once again, 91.52 on WTI. Andrew Bulls now needs to explain to Tom Keane who Norwich City is. TK, if we're going to do a football tour, you've got to talk to Andrew about Norwich.
Well, they're destined. Are they going to go up or down? I loved watching this weekend. Who played Chelsea?
Who did you watch?
Bournemouth, maybe?
Okay.
Brentwood, I can't remember. I love the little stadiums.
Brentford.
Yeah, there's no American equivalent to how close the people are, like in Norwich.
What's the Norwich Stadium like?
It's great. It's very loud. It's the old-fashioned stadiums.
The old-fashioned stadiums.
I go as often as I can without really annoying my wife. But I go to quite a few games.
But there's it's like here. There's like 10 Fenway Parks. Seriously.
Oh yeah.
You know,
I prefer the older stadiums as well.
It's very cool.
And then the new owners want to come and they want to rebuild things and.
So who are you playing in the EFL? Norwich. See how I did that?
That's perfect.
Next one is Leicester. So top of the table clash coming up.
There we go.
Did I do okay there?
I'm proud of you, TK. Good stuff. Anne Murray is in New York City for the UN General Assembly.
Leicester.
She's going to be joining us next from London. This is Bloomberg.
Multi-trillion-dollar industry. There's a lot of ground to cover.
A record year of growth, hand over fist all year.
We're just getting started.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Today on Bloomberg. From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
I feel we made some good progress this weekend. I want to make sure we don't shut down. I don't think that is a win for the American public, and I definitely believe it will make our hand weaker if we shut down. I've never seen somebody win a shutdown, because when you shut down, you give all your power to the administration.
I can't believe there's another story that I follow less than this one. House Speaker Kevin McCarthy discussing the possibility of a government shutdown on Fox over the weekend. Bramo, so many people that listen to this program find this subject absolutely tedious, and they start to ignore it. They ignore it, and then it starts to matter. Does this matter?
It seems unlikely that they're going to come up with some kind of proposal based on the fact that the proposals that they have out there aren't going to even pass measure within the own House. Here's the question. When do people start caring enough to possibly get on the same page and get to some agreement? When do people care enough to start putting that into economic projections, considering it does have something of a drag.
How linked is this mess with the impeachment inquiry that was started in the last week or so? Is that the bargaining between House GOP at the moment and the Speaker?
I honestly am not going to come up with rationale, but right now there is a bit of try to cater to the right of the parties so that you can get some sort of deal through so that you're not accused of shutting down the government, and that probably is part of the wrangling in the House.
Equities right now on the S&P 500, just about positive to kick off things this Monday morning. Good morning to you all, up by 0.1%, let's call it. Yields just about unchanged on the session, came really close to intraday cycle highs on a 10-year a little bit earlier this morning. 435.45 was the high of the session, high of the cycle 436.18, and in foreign exchange, Tom, 106.69 on the euro, just a little bit stronger here. And if you're wondering where crude is, it's near the highs of the year, 91.40 on WTI.
Well, I'm going to go to $94. A 95 print would be shocking on Brent. We're not there yet, but that gets my attention. John, I'm just riveted with what we heard from Andrew Balls. I mean, I just think the three of us out at Norwich with Lester here on the 20th.
Well, I wasn't aware that Andrew's brother is no longer the chairman of Norwich City. He's since
Josh
taken on a
Sargent
different
hurt
role.
his ankle, the United States player playing for Norwich.
Nice.
And, I
we'll
think
watch him play Leicester.
They're strong. They start 4-1-1.
Okay.
It's a draw, not a tie.
Thanks for that.
Thank you. But it's good to see that from Norwich. Keeping up with Norwich football is Anne-Marie Horton in New York, our Bloomberg UNGA correspondent, and we welcome her to the worst traffic in the world. That would be Midtown Manhattan all this week. Your message, Anne-Marie, away from the follies of Washington is you're watching the meetings away from the green marble of the United Nations. What meetings really matter?
Well, the meetings that actually really matter this week are the meetings that are not happening at the UN General Assembly. So what we've learned over the weekend is that President Biden's National Security Advisor, Jake Sullivan, met with Wang Yi, of course, Xi Jinping's foreign minister in Malta. And what those two were talking about, a number of issues, of course, but really the potential for Xi Jinping and President Biden to have a meeting. These two individuals, these leaders, have not met since the G20 in Bali, but obviously we've seen a number of high-level meetings from counterpart to counterpart taking place in Beijing. This could potentially see Xi Jinping coming to San Francisco, to California for the APEC summit. That meeting took place, and then Wang Yi later this week is going to Moscow, where he'll sit with Sergei Lavrov, who will also be at the UN, but Putin will not be at the UN, Xi Jinping will not be at the UN, Mohammed bin Salman will not be at the United Nations. So I think I want to see what happens between that Wang Yi and Lavrov meeting, which is happening on the heels of Jake Sullivan's Malta trip.
Well, I want you to report right now, Anne-Marie, why is the UN suddenly a non-event? I mean, everybody used to parachute in. I have the memory of being at the Council on Foreign Relations, Lisa, and Muammar Gaddafi walking by me, granted with a security entourage of 14 people, but it used to be a big deal. Why is no one showing up now?
It's still a big deal. For Diplo nerds, this is amazing. You can walk down 3rd, 2nd, 1st Avenue and potentially run into, say, Erdogan. Like these moments have happened, and you get some of these moments where you can see also who they're speaking to, and it's the sideline meetings, of course, that happen alongside the UN. Like President Biden will be sitting down with Benjamin Netanyahu. Interesting enough that this is not even happening at the White House. It's a meeting, a bilat alongside the UN. Obviously, there's been some tensions between Jerusalem and Washington. I'm just saying, in the broader aspect of what is happening in the geopolitical landscape in the world right now, the most important meetings, when you look at Jake Sullivan, Wang Yi in Malta, then Wang Yi going over to Moscow, those meetings are happening outside of New York City.
Yeah. It's like, Lisa, when I talk to Pharaoh, it's so rare, it's like it's a bilat. When John and I talked to him, it's a bilat.
I immediately Googled Diplo nerds, and there's actually an entire website devoted to games called Diplo nerds. I am curious, though, Anne-Marie, this idea that the United Nations is losing relevance is something a lot of people have been talking about, which raises a question of where are the forums going to be held, in what kind of space to bring powers together at a time of increasing divergence. Is this something that people are really talking about at this UNGA meeting?
At every UNGA or UN General Assembly meeting, people will cast the fact that is the UN obsolete? And I think the past year and a half has showed just how constrained the UN. I mean, Russia sits on the Security Council of the United Nations. The most they can do is get the General Assembly to condemn Putin's invasion of Ukraine. But can the UN actually do anything to stop this war? No. And that's part of a lot of criticism that the UN gets. But really, it is just a forum to bring individuals together. Another interesting story that will be happening alongside the sidelines of the UN General Assembly, I reported this last week, and the Iranian Foreign Ministry confirmed it this morning. We will be having a prisoner exchange today between Iran and the United States. I've also have reporting that $6 billion of Iranian funds that were held frozen in South Korea have now been delivered as of this morning, about 4 a.m., 5 a.m. Eastern time this morning, have been delivered to Qatari banks. And what our colleague Arsalan is reporting is that potentially there will be some discussions on nuclear program in Iran between intermediaries with the United States and Iran alongside UNGA this week.
Just to follow up on what you were talking about earlier, this idea that one of the most important meetings already took place between Tony Blinken and his Chinese counterpart. Was there any resolution from that? Was this paving the way for some sort of Biden-Xi bilat or something further to really shore up relations?
This Jake Sullivan meeting, I think, really is the preview for the potential Xi Jinping-Biden meeting. These two individuals have that unfettered access to their principles, and they could speak a little bit more candidly than you would see, say, a Gina Raimondo and her and her Chinese counterpart, or Yellen and their counterpart. Jake Sullivan and Wang Yi are the ones that can really set the parameters of this meeting, which the United States has been asking for. And Xi Jinping at the moment is dealing with a difficult economy domestically and also difficult issues within his government. You know, we still have missing Qin Gang, the former Chinese ambassador to the United States, who was the foreign minister. He was the one that should have been sitting with Jake Sullivan, but he has disappeared, and unclear where that individual is right now. And then, of course, Li Shangfu, who U.S. officials believe was removed from his post. This was the head of the military, the defense minister, who they've refused to have a meeting with Lloyd Austin with because of the fact that he was sanctioned by the United States. So you see some movements within the Chinese government. You see concerns domestically with the Chinese economy. Potentially, this is the time Xi Jinping wants to come to the table, and it would be on U.S. soil.
MH, we've got to squeeze this in. How has the U.S. military seemingly lost an F-35 fighter jet?
I do not know. I do not have answers for this. I've been looking to see what the command center is saying. The pilot was able to evacuate, but still this F-35 seems to be missing. I have a lot of questions, as you do.
Amazing story. Amazing story. Anne-Marie, over in New York all week for us for the UN General Assembly, or locally known as UNGA.
I hate it.
I feel sick saying it.
UNGA. Actually, it's really fun. Just say it repeatedly.
No, I'll take a pass on.
UNGA, UNGA, UNGA. Hooked on a feeling.
Wow. What was that?
It wasn't B.J. Thomas.
Yeah.
It was after that. Somebody did a redo of Hooked on a Feeling, and they go, UNGA, UNGA, UNGA.
So that's actually a song?
Yeah. It was a big hit. Big hit.
Play
Huge hit for B.J.
Thomas. It's a break,
Thomas.
Grandma. I don't know how you feel about that.
I think that it would be really great. I think it would be good. Let's do it.
How'd you lose an F-35?
I don't know. Here's my question. What do they know that they're not saying?
There's always something.
Right. So is this an issue of the weather needs to clear to then go into the lakes or wherever that they think that there could have been some sort of accident? Was this something about the transmission system and what could have gotten hooked in? I don't know.
So was it on autopilot still with fuel?
I don't know the details.
Oh, okay.
I don't understand. We don't even know why he ejected the pilot.
Pretty fascinating story.
It is.
Isn't it? Catherine Neese of PGIM Fixed Income is coming up shortly as we kick off a trading week full of central bank decisions. Equity futures totally unchanged on the S&P 500. Live from London, this is Bloomberg.
used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one. Okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment case for this in the world.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stenivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Coming off the back of a very mild week of losses on the S&P 500, trying to bounce back, but no sign of a bounce currently. Unchanged on the S&P 500. Likewise on the NASDAQ 100, down by about 0.06%. No drama this morning. The week really begins on Wednesday. We'll talk a lot about those central bank decisions throughout this morning and, of course, through the week. In the bond market, 2-year, 10-year, 30-year, just to slice up the yield curve as we often do across those three maturities. Your 10-year yield came very, very close to a cycle high a little bit earlier this morning. Within a basis point of it, this morning we're now just about unchanged at 433.85, but still here, Lisa, in the 440s on a 30-year. Still there.
We were supposed to be down to 3.5%, according to some. We were supposed to be already talking about recession in the U.S. Instead, we're talking about the ongoing potential for a wage spiral. We're talking about ongoing upgrades to economic growth. And we're talking about a 10-year Treasury yield that is closest to the highest levels back to 2007, raising real questions what the Fed is going to do on Wednesday in terms of projections.
For 3 consecutive sessions. Just building on some of the moves we've seen recently going into the Fed on Wednesday. Lisa, I want to finish on foreign exchange. Just get to the euro quickly. It's been 9 weeks of dollar strength against the weaker euro. And those numbers just tell the story, don't they, Bramo? 106.66 for the ECB.
Is this driven by U.S. strength or European weakness or both? And so how do you get the dollar really dictating what we hear, not just from the Bank of England and the Bank of Japan this week, but also the Bank of Sweden and Turkey and everyone else is going to be reporting?
I think we really focus correctly on bonds, but I really want to state here something we haven't stated. The resiliency of the equity markets is shocking. If you gave me the news flow, including U.S. government shutdown right now, I suggest we'd pop down 8%, even 12% on equity markets as a guesstimate, and it hasn't happened.
So question in the moment, I'm going to go back to it, and forgive me if you've heard this a million times because I'm on repeat on this point at the moment. Reflection of the extension of the cycle or a recipe to end it? Crude in the 90s, bond yields back to 430 something, 2-year at 5. Which one is it?
It depends on what's driving it, especially with crude, given the fact that if you look at it on an inflation-adjusted basis, it doesn't look so bad relative to recent history in the U.S. When it comes to rates, is that being driven by healthy inflation or unhealthy inflation on the heels of some of those crude moves?
Top stories this morning. Under surveillance, the Fed set to make its next rate decision on Wednesday. Investors betting the FOMC will hold rates at a 22-year high. Meanwhile, in the labour market, they've got to talk about this. The UAW rejecting a 21% pay raise from Stellantis. Negotiations between the UAW and automakers will resume today. If 20% doesn't get it done, I spoke to David Welch about this about 2 weeks ago, going into the deadline, and I said, what do you think gets it done? That's our Detroit reporter, incredibly well connected. He thought 20% around that kind of level would get it done. 21% isn't getting it done.
So what does it have to be, and what does it do to the Detroit auto manufacturers at a time of incredible competition, or even
Who says it's just
Europeans?
about the pay? It's about the other themes as well.
Totally agree.
32-hour
Yeah,
work
sure.
week.
It's super nuanced.
And the whole EV dynamic is interesting me more and more. They want union electric vehicle jobs. And Mari Barr is basically saying no, right?
Well, Tesla's rubbing its hands together, Tom, because they don't have to face that problem. Europe Europe is facing the consequences of underinvesting in the continent for a long, long time and being behind this race. Behind, and Lisa, ultimately it means perhaps competing with Chinese manufacturers that do this at a much, much lower cost. And as we mentioned in the previous hour, Jeff Yu of BNY Mellon said it, something changed in Europe over the last couple of weeks just on this front. It feels like the EU aren't going to tolerate that competition. They won't allow it.
Because they understand how much ahead China is when it comes to that. But from a worker's perspective, how much are they getting in to try to affect how some of these technological changes affect their jobs before it's too late?
Let's turn to this story. Speaker of the House, Kevin McCarthy, outlining demands to avoid a government shutdown. McCarthy calling for an 8% spending cut to domestic agencies and for work to resume on a border wall. The House expecting to vote on the measure on Thursday. Tom, we're doing this all over again.
We're doing it over again. I love what the Washington Post had this morning, where there's 5 ideological cohorts of the Republican Party. My basic idea is even the least sophisticated people know an 8% budget cut, either I assume nominal, maybe they even mean real. It's just foolishness. It's like, why waste our time of all political persuasions doing that?
This is not popular with voters. Let's just put that. Nobody really likes seeing government shutdowns. How divorced is Washington getting, frankly, from voters, whether it's on the Republican side with government shutdowns or whether it's on the Democratic side in terms of Biden and the viability of his candidacy? And it raises this question, at what point will political dismay at a potential government shutdown actually mean anything in D.C.?
Let's finish on the commodity market. We've talked lots about the economic perspective of this, but let's talk about the politics of oil pushing closer to $95 a barrel after a 3-week rally. The surge boosted by higher demand and continued supply cuts from Saudi Arabia and Russia. The Saudi energy minister, as Lisa has pointed out all morning, is set to speak a little bit later on today at 10 a.m. Eastern time. Energy costs putting pressure on businesses, consumers, central banks, and arguably maybe even putting pressure on this White House, TK, going into an important 12 months of campaigning.
It's a sustain of it. What my attention here is I don't see people going up and back down again. I don't hear many people saying we're going to wander back to $85 a barrel. I just, which frankly is still high for people.
Do you have to bake that into forecasts for next year over at the Federal Reserve?
It's a loaded question because they have this foolishness of core inflation. I'm really old school on this. I put much less weight, and a lot of respected people disagree with me on this. They think a core analysis is valid. I'm with Larry Kudlow, ex-Bear Stearns over at Fox now. I just don't buy for a minute the core analysis.
TK crude getting close to 95.
Yeah, $95 a barrel. We're going to see how it folds into the global markets and, of course, into the dollar. A student of that is Marvin Barth. He's founder of Thematic Markets and does a wonderful cross-asset analysis right now. Let's just start with basics, dollar 101. Surprising resiliency in the dollar. Does it sustain?
Yeah, I think we are in the midst of an unheralded dollar cycle like you've never seen one before. This was actually the first piece of research I turned out at Thematic Markets. It's about what's driving dollar cycles. I go back and look through time at what drives these big, huge, previously 17-year cycles. And what it seems to relate to is innovation cycles that come out of the U.S. and drive CapEx cycles. And until the CapEx cycle finishes, the dollar doesn't finish. We're not done with the CapEx cycle.
I mean, John, you thought Conda Chief paid for the Washington Capitals. He doesn't. So if you believe in a Conda Chief cycle and you're going to tie it into innovation, that screams to me American excellence. Is that overplayed?
I don't think it is. I think there's actually a couple different things here going on. One of the things that's very different from this dollar cycle from past ones is the shortness of the investment cycle. So as we are seeing every day, the technology cycle is getting shorter and shorter and shorter. So the U.S. is still running ahead of everybody in a way it didn't in those previous cycles. The second is, take a look at the data. U.S. per capita incomes left Europe behind in 1990 and have never looked back. There's no convergence anymore. And now it's starting to happen versus emerging markets.
What's interesting here, John, is your investment cycle on your ARM shares was what, 2.5 days?
You're going to get me in trouble. Just for the record, no ARM shares at all, none at all. Okay, are we done with that?
We're done with that.
Okay, good.
I'll move it forward. There is this question, though, about what this means in terms of central bank policy, or if that's not relevant, because people here are expecting the ECB to be dealing with a more intractable wage spiral and inflation problem than the one in the U.S. And that's going to leave a tighter ECB policy, all things considered, for longer than in the U.S. Are you saying that that really doesn't feature in here in terms of the dollar cycle?
Oh, I think it absolutely does. But remember, I think one of the key things people forget is central banks don't actually set rates. They respond to the economy. It's, you know, if you look at the Fed's forecast, they didn't tell you they were going to go this high. They had to because the economy told them to. All the things you were highlighting earlier about the mystery about why the economy is doing so much better than expected, why earnings and the equity market is doing so much better than expected. This is all a technology cycle. They have to respond.
If that thesis holds true, then wouldn't the Chinese yuan be doing better than it currently is, considering the innovation cycle around electric vehicles and how underestimated that has been based on the recent reaction from German auto manufacturers?
So, Lisa, this is a great question, and I think it's one of the things that if I go back to some of my previous research, I got wrong early on. I thought it was all about the tech companies. It's not. It's about something called localization. If you look in the data, it's not geopolitics or COVID or any of that. Those accelerated it. That has been driving the move away from globalization. It's been localization of production that's been enabled by technology. Nobody's doing that better right now than the U.S. That's what's driving this.
Haven't we also proven that preventing conflict through trade has totally failed?
Well, you can go back to World War I. Who were the two largest trading partners of each other? The UK and Germany. This is a failed concept. I don't understand why people thought it was going to work this time, but it doesn't.
Where does that leave China?
Well, China has its own set of problems, right? So China pursued this massive industrialization policy through subsidizing capital, repressing consumption. The same thing that many of its East Asian predecessors did. It's just done it on a much grander scale. But it now is going to have to pay the price. Fortunately for China, it's the creditor to itself. So like Japan, you're not going to have a global financial crisis type thing. You're just going to have a lost decade or so.
Which is the reason why, and John asked me this question earlier this morning, what's the most important meeting this week? The Fed, the Bank of England, or the Bank of Japan?
So I do think the Bank of Japan is really the most interesting one. The Fed, they are finally caught up with the curve. Yeah. That doesn't mean they're at the end, but they actually have a chance to pause. And so it's a toss-up there. But the Bank of Japan is actually potentially changing course.
I love the big picture you're taking. I'm going to go back to a podcast David Merritt did with Mariana Mazzucato. It's one of my favorite people here on economic history. Are we at a junction here, as Mazzucato would say, where there is a new, where leadership like at the UN can actually piece together a new world, or is it going to be a Marvin Barsh slog here forward?
So one of the things I've highlighted about this theme of localization is that this is actually wholly new in human history. We actually have records going back 300,000 years, before actual Homo sapiens existed, of increasing levels of trade among hominids. As you know, it's all David Ricardo's specialization of labor, right? What changes that? When I can substitute a machine for all different variants of human activity, intellectual and physical, why do I need to use the cheapest labor anywhere in the world to trade with that specialized labor?
Do I need a new iPhone? That's what I want to know. I just want to know, Marvin, do I need a new iPhone? Going back to Ricardo.
Yes, because they're limiting your memory and speed.
They are. Thank you. These are all nanometers, 3 nanometers.
We'll leave that there. Marvin Barth there of Thematic Markets. If you are just tuning in,
can you come back tomorrow?
Of course.
Equity futures on the S&P, just negative here, rolling over in the last 10 minutes or so. We're down by 0.14%. In the next hour, don't miss this conversation with Jules Moak of AXA Investment Managers. The lineup of guests already this morning, absolutely fantastic. Some of the headlines: triple-digit crude by Halloween was the call from Amrita Sen.
Yeah,
over at
this
Energy
is real.
Aspects. We're not far away. Andrew Balls of PIMCO talking up buying duration like right now. Thinks this is a moment in time you don't want to miss. Tom with a 10-year in the 430s.
And Jules Moak, for Global Wall Street, this is must listen with Jules Moak of AXA, because he's going to fold into the post-Lagarde ECB world. I mean, some of those headlines are shocking here, and you just wonder, on the gloom basis, where's Germany 6 months from now? But it's much more the holistic view of Europe as a struggle.
And a question, Tom, that you've asked, which is on a gloom basis, why have stocks been so resilient to where we are in terms of real yields, in terms of yields, in terms of oil prices? We're looking at a market that is not what anyone expected it would be 6 months ago, 3 months ago, 3 weeks ago.
Do we have to go to break here? I mean, is it commercial free in England?
In about 30 seconds, TK.
Okay, damn.
You've got a bit of time if you want.
No, but I just think Larry McDonald was great about this. There's a wall of money out there that's got to go somewhere. That's all there is to it.
It's gone into the equity market so far this year. Equity futures on the S&P negative by 0.2%. Coming up next on this program, Catherine Nice of PGIM Fixed Income. That conversation just around the corner. A triple header of central bank decisions this week. The Federal Reserve Wednesday, Bank of England on Thursday, BOJ coming up on Friday. Live from London. Good morning.
Warren Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things we have this great connection about the love for baseball, and the reason why Warren and I got to know each other is he insured my contract, the 252, and I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
On the next episode of Hello World, meet the women driving Kyrgyzstan's tech revolution.
This is the first satellite in our country.
And some speedy horses. Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on Bloomberg TV.
Are still thinking the inflation is going to drop towards 2%, and therefore the Fed is going to cut rate and cut them aggressively. The Fed is pushing back against them. They're saying we're going to be essentially higher for longer, not just the Fed, but other central banks. There are structural forces that imply that inflation may be higher. I think markets are still a little bit too optimistic that the Fed is going to aggressively cut rates starting early next year. That's not going to be the case.
Nuria Rabini, Associate CEO of Macro Associates, Rabini Macro Associates, speaking early today on Bloomberg Brief, a news show with Manus Cranny and Danny Berger out of London and New York, respectively. Catch that at 5 a.m. Eastern Time. Just to get you up to speed on some of the price action, equity futures just slightly negative on the S&P. We're down by 0.16% on the S&P 500. In the bond market, we are totally unchanged at 433.65. It is absolutely fascinating to see developments over the last month, to see yields get very close to cycle highs again on a 10-year within a basis point this morning. And in the commodity market, to have crude back in the 90s, not just on Brent, but also on WTI, 91.25 on WTI, up by 0.5%, and a conversation about maybe $100 Brent by the end of October. TK, that's quite a surprise. It's quite a surprise to see that, given where we were back in the summer. I think it's actually a move of something like 35% on WTI since June.
Yeah, I think I took it off June or August, and it was a 30% move, and he annualized out, I believe, 248%. Granted, that's a baloney number, but the fact is, here we are. And, we pride ourselves here with Will Kennedy's desk on hydrocarbons, actually based out of Queen Victoria Street. And, John, you look at the Bloomberg News hydrocarbons analysis and all the experts. how many people do we see saying, we're going back to $70 in oil? I don't see it.
Well, what I hear and what I see is basically what you will see. Lisa, you blame Saudi. You blame Russia. This is not about demand, it's about supply. But at some point, you've got to ask the demand question. It's pretty phenomenal. Demand holds up in the face of it.
Yeah.
Given everyone's talking about recession, slowdowns in China, and problems in Europe.
The only person who is calling for prices to come down that I'm seeing right now is Ed Morris of Citigroup, who put out a note. And he was the one who actually got it most right this year. And he said the swing factor here is supply. And you've pointed to this, John. The U.S. is producing a record amount of crude. If they continue to do so, that could potentially change the scenario.
Near 13 million barrels a day. The latest figures on that, 12.9 million barrels a day in America. I was reflecting on this in the last week. We've talked so much about the anti-fossil fuel stance coming out of this White House. Does it make a difference if we're pushing 13 million barrels a day, regardless?
That's a good question. And do you sort of see a difference in the actions of the White House versus some of the rhetoric?
One of the great things in economics is every region, every school has a specialty. British Columbia owns econometrics, like really, really extraordinary. She's out of the University of British Columbia. Catherine Nice joins us now, Chief European Economist for PGIM. She gets to tell bond portfolio managers who tell her she's smarter than they are what actually is going on. And she joins us this morning. Thank you so much for joining. I want to go to the right-hand side rather, of the algebraic equations you're expert at, the epsilon. What's the level of uncertainty right now? Do you have a conviction, or is there such a jumble out there that your uncertainty is just off the chart?
I think what is going on uncertainty is looking very different to the world that we got used to in the decade before the pandemic. And I think that is particularly the case if you look at long-term, where we think long-term nominal yields are going. We were in a world where effectively central banks were promising to buy, and we saw a lot of risk premium compression. We saw very low stable inflation with very little variation around that, very little volatility. That led to further compression into the risk premium. And in terms of the real economy, we weren't really seeing huge real side shocks. And on all of those fronts now, things look to have turned. And so I think this question about where is uncertainty taking us in terms of market pricing is a really relevant question.
I mean, I totally take your point. I've talked about it many different times on a simplistic Hicksian basis. Everybody's in the financial world, and you're overlooking at the real economy impacts of this new interest rate structure. Does that put a dampening on global GDP as the IMF calls for?
I think it really depends on where you look. The U.S. economy is showing real resilience. You've got a substantial amount of fiscal spending. I'm hearing about Inflation Reduction Act, obviously through, the European lens. That's where my focus is, on the euro area economy. And policymakers in Europe are really, hyperventilating about this Inflation Reduction Act. They're very concerned about the negative spillover effects of that for Europe. Whereas if you look at Europe economic activity, I mean, it is already slowing. That is not something that is as yet on the horizon. It is already looking quite weak. And so, the prospects for the real side of the economy, I think is the potential is there for a divergence between what we're seeing in the U.S. and the euro area.
Which is the reason why people are talking stagflation in Europe, and they're not using the S word in the U.S. How long can Europe stay in a stagflation type of environment?
Potentially, how long is a piece of string? I think potentially this could persist for quite some time. I mean, if I just think back to the experience of the UK, the UK is obviously small open economy. Euro area is a large open economy. It's quite different. We experienced here in the UK a very large series of large relative price shocks that meant that inflation deviated from the target for almost 4 years. And this happened against a backdrop of very little sign of pay growth picking up, certainly not to levels that were inconsistent with the target, a recovering but tepid real economy. And it took 4 years for inflation to get back to target. So that to me already suggests that these shocks will take some time to work their way through. And if we get more such upside shocks like what we're seeing with energy prices, the potential is that this does get drawn out.
So what is the monetary policy response? I mean, is this even relevant at this point at these levels if this is something else, if this is being driven by other features that aren't related to growth and aren't related to what the central bank can control?
It makes it a lot harder for the policymaker, for sure. But, my view, and this is a debate, I think, to be had with Bank of Japan framework review, potential of a Fed framework review down the line, is the flexible inflation targeting regime flexible enough that it can account for this? My view is perhaps one area that we haven't explored is around the horizon over which policymakers get inflation back to target. So built into that framework is an understanding that if an economy gets hit by a very large relative price shock, the policymaker should look through that, and it might take longer for inflation to get back to target. That was the message we were hearing from central banks when inflation was undershooting, and maybe there's going to be more of that messaging when inflation looks like it's overshooting, on the proviso that we don't see these second round effects crystallize.
Let's finish there then. If we took the clock back to the late 80s and caught up with that gang over in New Zealand and said, what should the inflation target be? Would they come up with something closer to 4 for the period we're in right now?
There are no strong and compelling economic arguments to have an inflation target at 2. If you were starting from a blank sheet of paper, I think 3 or 4 is probably, an equally, if not more sensible place to be. The problem is that, we are not starting with a blank sheet of paper.
Sure.
And my view is that it's going to be a very difficult thing to change. If it's not a good idea to change it when inflation is below the target, if it's not a good idea to change it when it's above the target, then it seems a bit odd to change it when you're at target. And so I think, to me, that tells us we are where we are, but maybe we need to think through other elements of the framework, like the horizon over which we get inflation back to target, and maybe the measure of inflation itself. Is it really accurately reflecting what people are spending their money on?
Well, most people feel like no, and have done for a long, long time. Isn't that a really sophisticated way of saying, just push it out? Just basically just say, we can't hit it now, we probably can't hit it over 2 years, so let's just adjust the time horizon, which is basically just saying, let's tolerate a higher inflation number, isn't it?
For a period of time, yes.
Okay.
And as I say, that's always been part of the framework. It hasn't really needed to have been utilized because we haven't really been hit with these kinds of upside real shocks.
This is what's so important about the IMF projection and the shock of going out to 2028. Who's doing that? Nobody's doing it. Nobody's looking out as Catherine is over a longer time frame. She's talking, she's not saying the x-axis we're going to move out. It's a bunch of fancy language, but the answer is, as you say, it's longer.
We said it this morning, I think, for President Lagarde over at the ECB, just wants to get through 2023, never mind thinking about 2027. Catherine Nice, a PGIM fixed income, is coming up. Catherine Nice, thank you,
You
rather.
nailed that, John.
Coming up, Sophie Lund-Yates of Hargreaves Lansdown is joining us very shortly. Catherine Nice of PGIM fixed income, thank you. Equity futures on the S&P 500, negative by 0.2%. Live from London, good morning to you all.
Venture capital, it's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology. the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television. Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping. Look, people have conviction, or they invest if they invest for the right reasons, just keep at it.
What do you have for skincare for men in their 70s that have a lot of wrinkles? I mean, is there any way to get rid of the wrinkles?
I have a lot of amazing things,
Really?
but maybe it'll be a little bit beyond skincare.
I think we may very well be at the end of rate hikes.
Most central banks, I think, are probably done hiking now.
The double-digit losses of last year are clearly behind us.
I think the S&P is going to 4,800 by the end of the year.
We actually may see higher than 2% GDP growth on a 5-year time horizon.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene from London. Our studios at Queen Victoria Street on Bloomberg Radio, Bloomberg Television. We've been looking at bonds, equities, the rest of it. John, it's time to look at the equity markets.
You want to look at the equity market right now?
Not right now, but we'll look at it as we go forward.
What kind of lead-in was that? Okay.
All right, the
I'll do that right now. The S&P, Tom. Futures. Slightly negative on the S&P 500. It's time to look at that. It's time to look at central bank decisions through the week, TK. Wednesday, we've got to talk about the Federal Reserve. Thursday, the Bank of England. Friday, the BOJ.
But it's such a good, good feeling. Greenspan had a good feeling about the equity markets and the backdrop to real concern over oil near $95 a barrel. You mentioned the rates popping up today, price down, yields ever higher. There is that good feeling of a market
Look,
that's been
TK, I'm with you. This was the dream. This is the dream.
Yeah, for
the Fed's
Jerome
about
Powell.
to market on Wednesday. It's going to upgrade its growth forecast and downgrade its inflation forecast in the minds of most people we speak to. At the same time, got an equity market that's seeing double-digit gains on the year. And we're doing this with yields at 5% on a 2-year, 430-something on a 10-year, and crude in the 90s. If that can stick, I don't know. But where we are right now is what people were praying for at the start of the year.
In the back of this is a social aspect. Not only the UAW strike, and Lisa put out a chart earlier this week, was the boom in striking, but John, the very fabric of this nation's being tested with the NHS junior doctor strike. I was shocked at the impact of the residents and interns walking out of the hospitals in the United Kingdom.
The United States is getting a flavour of what we've been living in the UK now for the best part of 12, 18 months. And that flavour is hurting these automakers. If they have to cough up more than 20%, based on what we've heard from the UAW, it's going to have to be much more than 20%. Stellantis have offered 21. UAW have said no thank you. That's not where a lot of people thought we would be a couple of weeks ago. David Welch, who we'll catch up with in about 10 minutes, Tom, thought 20% would get it done. I understand there's lots of other stories outside of just the wage piece of this, Tom. But to see 21% batted away the way it was by UAW tells you that there's going to be some problems on the horizon for Detroit's Big Three if they want to compete with the likes of China. Now, whether they'll be able to compete with the likes of China is one thing. Whether the US will just turn around and allow these Chinese competitors to come into the US market is another thing altogether. Because based on what's happening here in Europe, the real prospect of much, much bigger tariffs to insulate this economy and German manufacturers from low-cost competition coming from elsewhere.
Well, you see it with the German automakers as well. Lisa, I think you nailed this. I bust your chops about wage spiral, but that's what the fear is you do get into some form of embedded, maybe not a spiral, but a wage up, and that makes it tough for Jerome Powell.
That paired with oil really challenges this idea of a soft landing. It really challenges the idea that we can remain in Goldilocks for a prolonged period of time. It challenges immaculate disinflation. How do you get immaculate disinflation with increasing union actions and really wage negotiations, not just in the U.S., but around the world?
First thing I looked at today, 10-year real yield. John, help me here. I'm going to round it up to 2%. We made 1.99. 2% sounds, fancier, but there it is. Real yields elevated.
So let me get this straight. You go across the pond and you're not wearing a jacket. Tom wasn't wearing his glasses, and Lisa is still a bear. 1 out of 3 ain't bad. That was the latest feedback this morning. I just saw that pop up on my screen on the Bloomberg. Equity futures on the S&P 500 negative here by 0.1%. Yields up a single basis point, 434.25. Jackets off because the aircon in Europe's just not that great. I mean, it really isn't.
It is.
It's just
not the systems like
not. It's not like US aircon, which is just like super powerful.
Absolutely. You go in the US, you walk down a sidewalk on Lexington Avenue, and there's a store with the doors open.
It's like Arctic freeze comes
There's
out.
There's none of that here.
We're getting more European. I will just say that. We are getting more European.
On some fronts, that's a good thing.
Come on.
The aircon front, I don't think that's a good thing at all.
I'm going to quote you on that.
I don't have the number in my head. John, a gallon of gasoline for all the little itty-bitty cars here and the many electric cars.
In dollars, north of $7.
$7.24.41. I can't remember what it was.
That's brutal.
So it's a whole new...
A lot of that's taxes.
Did we do a data check yet?
We did. I did that briefly.
Okay, you did that data check. Okay, well, we welcome... It's going to be a great week here in London. Lots of really good guests to come up. And we have a credit conference we're doing. When are we doing this? Is it Thursday?
That on Thursday, Tom, with Apollo's Jim Zelter.
And it was great when we started talking about it, and it's now even greater, because I would say credit is really front and center.
And the compare and contrast between Europe's experience and America's experience.
Yeah. Well, we'll do that Thursday, and there's a modest Fed meeting there on Wednesday. We'll have complete coverage for you on that. Now, in the equity market, Sophie Lund Yates joins us now. Excuse me, lead equity analyst Hargreaves Lansdowne. Excuse me, I'm gasping. It's the hot brown water. It's killing me. Sophie, I look at the equity markets, and everyone's flabbergasted at how resilient they've been. Let's start with that. Why is there a bid to global equities as a general statement?
Yeah, this is the big one because I'm absolutely someone who's in the camp who I'm a little bit of a bear here. I think that
I should be sitting over with Lisa, but continue.
I've still got my jacket on as well. Is that okay?
That's okay. I have my jacket on.
All right.
There's no rules here, Sophie. Just make it up as you
That's not the vibe that I'm getting. I feel like there are some rules. But jackets aside, in terms of what we're seeing, there is a great deal of optimism, and I think that's kind of what you're alluding to here. And I think that unfortunately, that isn't going anywhere. What we're seeing is consumers in particular. They aren't behaving like there is a recession in any form coming around the corner, particularly when we look at the UK, Europe as well to a certain degree. There's a great deal of resilience still in the consumer, and everybody's just very excited. I think there's also a great deal of this notion that central banks are going to be sticking to the script and that interest rates are going to be doing exactly what everybody predicts it to be happening. And unfortunately, as we know, that's not necessarily going to be how this plays out. So I do think there's potentially some overexcitement in the markets.
What does it mean to be a bear in equity land as bears have gotten beaten up all year long again and again and are now throwing in the towel?
Are we throwing in the towel? I mean, I'm on the cusp. I think for me, what I want to really kind of just shout about, and I think is getting forgotten here, and I know it's boring and it's not what people want to hear, but let's not forget fundamentals. There are so many people out there, they are talking about incredible thematics and mega trends, But fundamentals to me are where people need to be landing as well. I'm talking about looking at consumer staples, non-discretionary spend. Where is that being funneled in the next few months in particular? I don't want to bring it up, but we are heading into the festive trading season. This is going to tell us so much about where strength lies as well. So for me, it's please remember about your fundamentals, because I think they're getting left by the wayside.
Speaking of fundamentals and pairing it with this idea of the latest tech thing, there was a huge boost to European markets with the idea of a weight loss drug and what it did to Novo Nordisk and the whole question around Ozempic. And suddenly people were talking about how this is going to rejigger the European markets because suddenly this is going to be the preeminent type of trade. We were talking yesterday about some of the side effects increasingly of this. How do you get ahead of fads that are perhaps bigger in name than they are in reality?
Precisely. It comes back, first of all, to fundamentals. So when we look at big pharma, for example, we know for a fact that you're looking at hundreds of millions of dollars of falling off that patent cliff in the next decade or so. And obesity treatment is a really exciting mega trend. It's something that is going to generate a great deal of money. It's I think, a really good place to be. But in terms of getting ahead of that trend and making sure it's not just a fad, you need to also look at what else these companies have on their books. What does R&D look like? What is the pipeline? Because if their pipeline is only this, that's problematic to me. What else do they have that can back this up? But as a mega trend, I do actually think obesity treatment and the drugs there, a lot of that excitement, takes a lot for me to say this, a lot of that excitement is warranted, but it's not enough on its own.
Sophie, how investable are car makers right now?
So I think there's a lot of strength in the sector still. Do I think it's going to be bumpy? Yes, I do. But I think there is some strength there, not everywhere. This is not a sector that is created equal, and the divides here are becoming much, much larger. And I think so much of it, perhaps unsurprisingly, is going to come down to this pricing pressure as well.
So 20% plus makes US autos, GM, Ford, Stellantis uninvestable for you?
It's borderline. I think for me, a lot of that, the problems and the risk probably does outweigh for me. A lot of the excitement is probably where I'm at. But when we look at some of the maybe more exciting names in the sector, I think there are still quite a lot of opportunity. But also this industrial action that we're seeing as well has a lot of read across as well for broader equity inputs as well. So people that are supplying car parts, those areas of the market too. These are really quite vulnerable right now.
Help us with your savings and resilience index. It's acclaimed. Bring that to the UK, but also over to the United States. It sounds so, talking points of consultants. Tell me about our savings and our resilience, given what we're going through.
Yeah, so here in the UK in particular, you mean kind of the savings rates that we came into the pandemic with. So the UK in particular, we had a far higher savings rate than a lot of our peers in particular, and this means that it's kind of feeding into our inflation problem in a really big way here, because we're only just starting to chip away at that. Whereas over in the US, that kind of resilience and those savings levels have already been depleted. So that's also kind of feeding into things and pulling things down in the trajectory that you would hope for, and that is not playing across in the UK right now.
Sophie, this was great. Sophie Lund-Yates there of Hargreaves Lansdown. Thank you. Thank you very much. Did you see no business attire on the Senate floor? Did you see that new one?
No, I missed it.
They've got rid of the rules. You can wear what you like.
Really?
Yeah, on the Senate floor.
Let me guess. You have thoughts.
I have strong thoughts.
Yes.
I'm sure you have strong
shocked.
thoughts too.
They're right.
What?
If you're leading a country, if you're representing the people, shouldn't you dress for it?
So in other words, no sneakers, or I should say no trainers.
Those hybrid things that senators have started to wear anyway with suits.
What if they've got bad feet? I mean, 1 in 5 are over 70.
What did you have to do at school? You got a doctor's note if you had bad feet and had to wear sneakers. That's what I did at school.
So you think that they've got to get a doctor's note if they want to wear the hybrids?
Get a doctor's note if you want to wear the hybrids.
That's fantastic.
You're representing the people, the country. If school kids have to do it, why shouldn't they?
So you think they should have a uniform?
They should wear a business suit if they're a male, yeah, without a doubt.
All right.
Business attire is the right way to go. For sure. Don't you agree with this? I'm surprised you're silent on this. They're going to go to the Senate floor in what?
Worse camp than you.
A hoodie and shorts?
I think decorum.
Go ahead.
Decorum has slipped, to say the least.
There's also a sense of respect, but there's also a sense of service. And this goes back to a discussion of, are you representing, are you serving a nation, or are you trying to be an Instagram
My
star.
mother got dressed up to go to the grocery store, and she wore white gloves to go to the department store.
There you go, TK. Well said. It's like Trudeau in those light grey
I do
suits.
okay. Well said.
G7.
Well said.
You have such issues with those light grey suits. I just think that
Trudeau's got a lot of problems right now. The light grey suit is also one of them. Just just to throw
he's
that
got great
in there.
hair.
He does. Something
So
I
it's
don't
all
have.
fine.
If you are just joining the program, welcome to the program. The S&P 500 negative here by 0.16%. In the bond market, yields are unchanged, 433.65. Looking at crude in the 90s, 91.27. Weighing in on all of this, Gilles Moek of AXA Investment Managers with a big week ahead. 3 major central bank decisions.
Joe, we're 9 points under 4,500. I mean, the resiliency of the markets
It's
with 95
impressive.
oil is stunning.
Given where the dollar has been over the last 2+ months, given where the 10-year is right now, where crude prices were and where they are currently, these are big changes, and equities are hanging in there, Lisa.
Well, which equities? And this, I think, is important because you have seen a market underperformance of the big tech names in the U.S. They have not kept up. And this, to me, raises a question. Is this the beginning of something, or is this the dip that everyone was hoping for? It wasn't even a dip. It was just a lag.
This.
Yeah.
0.1%.
You don't see this on radio, but behind John is St. Paul's. I just saw some birds there. Feed the birds, tuppence a bag. They're doing it.
Is that what you're going to be doing later?
Yeah, that's what they're doing. I just saw the birds over there. You know.
Do you want to sing us out? You're desperate to sing us out.
Birds.
David Welch on the UAW strike out of Detroit coming up next.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I found myself in a spot where I was constantly getting new challenges. A lot of, I think, the best mentorship I had at Bridgewater is because people often saw in me the potential to do things I didn't even see in myself yet.
Average of 92 does allow oil prices to go to 100. We're putting out a piece later today, which is calling for $100 by Halloween for Brent. And again, this is just a trajectory. And at this point, look, of course, it's a short-term thing, right? I'm not saying it's going to average above 100, but could it go to $100 for a bit? Absolutely, yes.
Absolutely, yes. Triple-digit crude by Halloween is the call from Amrita Sen, the co-founder and head of research at Energy Aspects. Crude right now on WTI, 91.37. On Brent, getting closer and closer to 95, 94.50 currently. Outside of that, in the equity market, futures just about unchanged, negative 0.1%, rolling over in the last hour or so. In the bond market, going nowhere, 433.65. Talked lots about that record run, that weekly streak of dollar strength, 9 weeks of it against the weaker euro, 106.66. Positive this morning on that currency pair by 0.08%. The story for the three of us all week potentially, and maybe for longer, The strikes from UAW against Detroit's big three, not one, not two, but all three major manufacturers over in Detroit. And TK, the ask, 40%, 36%. What they've been offered at the moment is 21% over at Stellantis, and the pushback was pretty swift. That wasn't entertained really in any way, shape or form.
Well, it's true you mentioned this. The pay is front and center, and that's what gets the media's attention. But I'm looking at all the other attributes as well, and particularly the ability of the union to capture present and future electric vehicle jobs. I'm not hearing enough about that.
How do these guys compete with China?
How do they compete with BMW in the Carolinas, or 3 plants by Atlanta? That's what I don't see.
How do they compete with Tesla?
Well,
that's what Dan Wedbush said. Look, I get it. Tesla bull, I understand. If you were bullish before, you're bullish now. But surely, you're looking at this play out. Union versus non-union. It's a pretty clear investment thesis there, isn't there, Lisa?
Which is the reason why some people think that the reason why you're seeing this playbook from the UAW is to try to capture some of the workers from Tesla, to say we actually can make inroads at a time of technological change. They're throwing it all out there because a lot of people view this as the last opportunity that they have to do this. And if they don't get those workers, you're right, it's game over.
Yeah, we're going to have to see here. Right now, we're going to get a briefing, and we have been so advantaged by our Detroit shop, I should say. He is our Detroit bureau chief. David Welch joins us on the worry of industrial decline. David, you and I lived it on the New York Thruway. It was Carrier and Syracuse. It used to be a huge operation for Syracuse, New York, and then there was manufacturing decline and the Eastern Rust Belt. Is there worry here about manufacturing decline in Greater Detroit?
No, there's always a bit of a what me worry sort of thing when it comes to that. By the way, it wasn't just Carrier, it was GE and Miller Brewing and a whole bunch of factories, so there's nothing left up there. But look, there is concern about being competitive with Tesla, with being competitive with Japanese, Korean factories. At the end of the day, though, for automaking, labor is, it's well under 10% of costs comes from labor. And if you boost wages up by 5% a year, it's not like suddenly every vehicle loses money. It cuts into what have been record profits, but it's not something that devastates them. They are at a competitive disadvantage from with labor costs. They already are, and they will more so. And look, now the union's going to make a big stink about this. And they've been saying that they need to organize Tesla and organize Toyota plants. They've never been any good at it. They've just routinely failed. They've never failed to disappoint when it comes to that. And so if they get a good contract, they've got to be able to say, go back in 4 years and say, look, we did organize these other plants and we're driving the wages up.
Have you been surprised or understanding or interested in how the executives of the 3 auto companies have reacted?
Look, actually I have. They've voiced frustration. You can see that from Farley. Farley's a pretty open guy, pretty colorful guy when he speaks. Mary Barr is always composed. You guys have interviewed her. She's always on message. For her to come out and say she's frustrated with the union really says that they're having a tough time with Sean Fain, and a tough time getting what they think is a fair deal. And in the story we have out today, Bill Ford said to the bargaining committee, he said, I can look you in the eye and I can say I believe this is a fair deal. And I don't think he's wrong. It was a pretty good deal that they've got, but the union's they're gonna run it to the brink and try to get more.
What are they after, David? You and I talked about this a number of weeks ago, and I said, what do you think gets it done? And you said something like 20%. And at the time, I thought, yeah, 20% sounds about right. That's the offer right now. Ford 20, GM 20, Stellantis 21. What do you think gets it done now?
It's tough to say. I mean, I don't think it's a lot higher than this. And clearly, you and I were wrong on that before. But the tenor of things did change over the weekend. The union, reporting coming out of the union saying that they made progress with Ford over the weekend, kind of a more neutral to positive view of meeting with General Motors, and they're reconvening with Ford and Stellantis today. So it went from heated, nasty rhetoric about greedy billionaires and awful CEO salaries to we're making some progress. To me, the big thing isn't really going to be wages, because I first off, I think 21% would get it ratified with the membership, but does the union really stick to its guns on pensions, or was that kind of a throwaway demand in order to get leverage for better raises and cost of living allowances? The companies will take a very long company-wide strike before they give in to pensions, period.
Unionization has fallen really dramatically. I was looking at one figure. It's about 6% of the population, of the working population in the United States, from much more just a little bit ago. Is this whole action by Shawn Fain going to actually get more membership, increase the actual participation in areas like electric vehicle making?
I think he will have success organizing some of the battery and electric vehicle plants simply because of the relationship with Detroit's three automakers. They've already organized the Ultium plant in Ohio. Of course, that's jointly owned by GM and LG. And they'll get wages up there, and that could help them organize some of the other battery plants owned by other companies that are coming over the next few years. So, yeah, I do think that will help. You know, in fairness to the UAW, there is a moment here for labor. The public perception of unions is much better. It's actually, favorable 75% now, which is double what it was about 5 years ago. You have successful organizing drives at Starbucks, at Amazon distribution centers. So there is good organizing going on. And look at what the Teamsters got out of UPS without even going on strike. They got a great contract there.
Amazing.
So I do think if Fain can score some victories here, workers will start to see the value of joining a union. And there's a lot of anger out there. I think one of the toughest things for the companies to explain, everyone knows that a CEO is going to make a lot more money than somebody working the line or even a rank and file engineer with a degree. But the fact that they now make, someone put a figure out, 200 times what the worker makes, and it used to be 30 or 40 a couple decades ago. The fact that their pay went up over 40% and union workers' pay went up about 12%. It is tough to explain that to a public that's very anxious about AI and worried about losing jobs to EVs and worried about income disparity.
Yep.
With the cost of housing, cars, food, and college tuition soaring faster than income does. It's really tough to explain why very wealthy executives get to more than compensate for that sort of inflation, and workers have to eat it.
It's almost impossible for them to explain currently. David, appreciate your time, sir. As always, David Welch there of Bloomberg out of Detroit on this battle between Detroit's Big Three and UAW to come to some kind of labor agreement. Lisa, as you often do, nailed it about attracting workers from elsewhere.
This, to me, is one of the biggest questions. We're seeing this boost in union activity, striking activity that is now the most over the past of this year, going back to 2000. And you're starting to see real pushback. So what is the next sector to really get hit with this? It can't just end here.
But imagine if Teamsters had lost at UPS. The fact is they won at UPS, and there's a wide understanding they're going to win again here. I didn't hear that from David Welch. This is not UPS saying, let's get this done so we keep the trucks going. I don't get any sense of that here.
What's your position on eating on morning shows? In America, they always eat. You see what Bramo's got for a birthday?
Oh, look at this. My word.
I'm just shoving it in my mouth.
For Bramo?
Yeah, it's good. And that'll go really good with the hot brown water. Somebody said
absolutely not.
Go for it.
Absolutely not. You know they do that on US morning shows.
Yeah,
they like
exactly.
Eat burgers
they have a cooking
and eat ice cream.
It's like people come in, and then we sit around. We all like, I like
Happy birthday, Bramo.
If I ate this, the look.
This was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly with just a couple people. Our average restaurant now does about over $1 million per restaurant in digital sales.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights.
How has that shaped your strategy for the bank?
Is this a new normal? Is this like a catalyst?
Do you think we're in a new phase for dividend policy overall?
That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
TK absolutely crushing Bramo's birthday cakes in the commercial break.
Is that right? With my Yorkshire tea.
Two down.
My Yorkshire tea.
Nice.
Somebody emailed in. They said, "What kind are you having?" I said, "Not PG. I'm going to Yorkshire."
You're calling it brown water for your
hot brown
one-week
water.
stay.
Yeah,
I imagine you'll get kicked out of the hotel for that. Equity futures on the S&P, positive. They're negative, up and down and all around. We're down by about 0.1% on the S&P 500. On the NASDAQ, we're down by 0.2. A little bit softer here. The Russell's still higher by 0.14%. Flat equity market, down on the week last week, but pretty flattish anyway. We were down by just 0.1%, not even by 0.2. In the bond market, 2-year, 10-year, 30-year, 2-year still around 5%. 10-year still in the 430s, 30-year still in the 440s, going into the Fed on Wednesday, Tom, expecting an unchanged decision, but maybe some changes to that outlook and the economic projections they supply every quarter.
Am I right that they're going to, the guesstimate from Mike McKee is they're going to raise the growth view?
Growth up, inflation down for 23.
Not to Atlanta's stupidity, but, lift it up a little bit.
A little bit, and then look to 24.
Yeah,
that's where the surprises might come from.
Let's go back 9 months. We're on the edge of October here. We're talking about Halloween and $100 oil with Amrita Sen. Go back 9-10 months. Did anybody think the equity markets would be here with the data check John just did? No way.
How many stories have you read recently about how wrong everyone's been and how just people keep repeatedly getting everything incorrect? And I thought that was really interesting in light of this Financial Times survey of economists talking about how more than half of them think, or almost half of them, think that the Fed is going to raise at least twice more before they are done.
As I'm often reminded, they are year-end forecasts, so there's still 3 months left or something like that. Who knows?
And they could be right just late, right? I mean, honestly, they could have the correct thesis.
Could you do a 2024 outlook right now? Could you provide us with any insight whatsoever on what
I could provide you with one.
In 2024? I've got no idea.
No, I can't.
24? No idea. We're going to be pushing out the recession game again? Is that what 24 looks like? Who knows?
I think I would predict there will be continued recession foolishness, and Neil Dutt has been brilliant on this. I think it's feasible. What we're going to do right now, this is really important. We're trying to piece together with the trip to London, the credit conference we'll be doing on Thursday. We're really trying to piece together 2024. They're the political conventions in America and that. But front and center for Bramo, John and myself, is we need tickets to the Paris Olympics. The only reason he's with us now with AXA Investments Paris, Gilles Moek is with us here. Give us an update right now on Mr. Macron, AXA, and the Paris boom you're going to see. Can Paris get any more boomier than it is now off the Olympics next summer?
Right, it's looking good. I guess tourism is helping a lot. So yeah, I mean, the city is having a good run. Gas is going to continue until the Olympics. Now the country around Paris, it can be a bit more complicated. We've had a good first half of the year. Things are starting to look a bit more complicated. So there's a lot of positivity at the moment in France because if you compare yourself to Germany, things are so much better. Right. Even the German stellar stop now, so it's quite unusual. But actually, if you look at the latest business confidence survey, it's not as bad as in Germany, but it's also heading south.
This is really important because I think to our listeners and viewers, particularly in America, when we say we went to France, we went to 3 arrondissements wrapped around Notre Dame and the wonderful repair of that cathedral. We don't have a real picture here of the greater European economy. We just see the boom of European tourism. Separate the European tourism from your caution on the rest of the European economy.
Yeah, I mean, definitely the weakness in the euro is helping from that point of view. So tourism is actually a function of that weakness, the rebound in the US, I think the appetite for traveling to Europe at the moment. But even in the most tourism-sensitive countries in the Eurozone, it's 15 to 20% of GDP at most. And the rest is the usual stuff that is dependent on either world demand in the generic sense of the meaning or on consumer spending. And consumer spending in France, for instance, has been contracting for 2 quarters in a row. So we have to be, yes, a bit broader in our assessment of the situation.
It takes us to the ECB, so let's be slightly provocative in this question. Trichet 2008, Trichet 2011. Should we add Lagarde September 2023 to those?
Well, they're trying hard not to fall in that trap because actually if you compare this with 2008 and with 2011, there was not a great sense of caution at the time when they actually hiked. There was a sort of self-righteousness, so we are definitely delivering what we need to and we're probably going to continue. Whereas this time it feels very much like it's the last hike that we probably need, maybe for tactical reasons internally, to get the hawks on board. Also because I think it's true there is a resilience of inflation which is more tangible in Europe than it is in the US. But the entire body language from Christine Lagarde last week was about, yes, they're now selling the long for, the high for long, sorry. But in terms of further hikes, we're probably done. And I think, yes, what happened in 2008, what happened in 2011 must be on their minds. And even the hawks are getting a bit less vocal, I would say.
I've noticed the same thing. It begs the question about what we can learn from the European experience on the other side of the Atlantic. Do you think there are any lessons? You see Germany essentially go into recession and inflation's still a problem. Growth in Europe essentially stagnate and inflation is still a problem. Is softer growth the cure for what we're experiencing at the moment?
Well, I know that lots of economists, including myself, have been wrong on that for the last year, but history would tell you that it's very, very, very hard to get disinflation without proper pain in the real economy, especially when inflation is no longer about exogenous forces, it's about your domestic forces. So as long as proved otherwise, I would say that what's happening in Europe is probably a lesson for what might happen in the US, even if, yes, the US resilience is amazing at the moment. I guess a big difference between the two is that there's, I think, in Germany a more structural issue, which is coming back to bite them at the moment, which is to some extent, to say, disconnected from monetary policy. They would be probably in a softer patch anyway, and that is dragging the Eurozone average down. But you want to kill inflation, especially when it started to get entrenched in wage negotiations. You probably need to engineer some sort of softening of demand. There is not a lot in the textbook that would tell you otherwise.
Is Europe completely different than the US when it comes to how well it can withstand the oil shock? Or just perhaps oil prices going back to something more normal on an inflation-adjusted basis?
Well, our big problem for the last 2 years has been gas rather than oil. But on average, we tend to be more sensitive to oil shocks than the US for complicated reasons, due to the fact that even if we are less oil intensive than the US, the actual price of a gallon of gas in Europe is much higher than in the US, and people are probably more sensitive to that particular item. But if it was just about oil prices, I don't think we would be really concerned. I think most observers at the moment are more focused on what's going on with food prices. Hopefully it will continue to slow down. At least this is what wholesale markets would tell you for most of that. And gas. And we went through last winter much more positively than what was expected. We need to do it again this winter, and to some extent it's beyond our control.
Which feeds into the whole discussion of wage spirals, especially in light of some of the labor movement that we've seen in the U.S., but also around the world, maybe taking a page from Europe, if anything. How much do you think that that's more noise than signal, or vice versa, in terms of wages staying sticky and labor power continuing to be stronger than it has been?
No, I think there's something profound happening there, which is that there has been I would say a change in the balance of power between employees and employers. I mean, it's very trivial to say that, but in Europe, where we have in most countries a collective wage bargaining system, what we tend to have is more inertia in the way wages react. I mean, in the US, you could make the case that wage accelerate when people actually can leverage the job opportunities and go back to their employer and ask for a pay raise. It's not really the way it works in Europe. I mean, some of it obviously happens, but most of the pay increases here happen as a result of collective bargaining. And it always takes a while for instance, the unions to realize that maybe the economy has become softer, job opportunities are falling, maybe it would be time to move back towards wage moderation. But you need actually a proper proof that the labor market is softening. And even in Europe, and that's actually one of the big positives of our current situation, is even in countries which have been used to mass unemployment for decades, the current situation of the labor market is more than okay. I mean, take France, my country, unemployment rate at 7%. If you had told me that France would be able to deliver that 10 years ago, I wouldn't have believed you.
I got 8 ways to go here, but just because of time, then can you state Europe is vaulted beyond eurosclerosis?
I mean, eurosclerosis is, I think in many cases, what we have is sort of a magnified version of what happens in the US in terms of demographic changes, for instance. We are a sort of more acute version of what is going to happen in the US anyway. But one point on which I think Europe at the moment is doing better than the US, it's on participation. The big positive right now in Europe is that our participation rate is rising and has been rising through the pandemic. It's today much higher than it was before COVID. It's exactly the opposite of what's been happening in the US, even if there has been a catch-up recently. We've put more young people, more older people back to work. And basically, I think we are benefiting from structural reforms which have been pushed through in Europe for the last 20, 30 years. Not spectacular ones, but gradually, I think we have a much better functioning labor market than what we had 20, 30 years ago. And it's definitely positive.
Jill, that is a bright spot. Thanks for being with us. Jill Moak of AXA Investment Managers. Europe finding itself in a very difficult spot after the ECB decision that we saw last week from President Lagarde and the Governing Council. It did feel like a bit of a trade-off, Tom, between Doves and Hawks. A deal that was struck just to get that extra 25 basis points. But as Jill mentioned, I think we've been talking about this over the last couple of weeks, even the hawks on the Governing Council at the ECB weren't screaming for a rate hike going into this decision, which I think speaks to the moment we're at right now. I would say the same thing over at the Federal Reserve as well. If you hear from a hawk on the FOMC, they'll talk about the prospect of maybe going 1 and maybe staying there for a long time. But they're not screaming for 50, 75, pushing this much further than where we already are.
To go back to our early conversations, and particularly with Jeff Yu earlier this morning, it comes down to a mass adjustment over a new rate regime, and that the negative rate regime, I believe we have Folkers Landau with us here through the end of the week, and the answer is a negative rate regime is gone. And we're adjusting to that right now.
And likely not going back to it. Very short, just short of 92, very close to 92 on WTI, I should say. 91.99 on WTI just moments ago. 91.83 at the moment. And a 2-year yield that's higher by 3 basis points on a session. Lease of 5.06% on the 2-year currently.
Markets are buying into the idea that the Fed might not cut rates in the future, at least not next year, or at least not until later next year. And that is the change.
Slowly internalizing that message in a much more profound way. If you are just joining the program, welcome to the program. The S&P 500 on equity futures right now negative by 0.09%. In the bond market, 434. In the commodity market, we talked about that crude move at 91.80 and a euro 106.59. It's a quiet start to the week. The week really does begin on Wednesday. Got a couple of days of quiet mornings, I think, in store potentially, based on what's on the schedule. Then it's on to Wednesday when you get that Federal Reserve decision. Thursday for the Bank of England, Friday for the BOJ, and then you get some PMIs as well for the month of September, Tom, to end the week.
Well, they end the week there, but I'm still recovering from this weekend. Thank you for teaching me about Formula One.
Oh, what a race, eh?
Singapore, Lisa, it was nuts. They're on the streets of Singapore that I've been on. They're bouncy, bumpy. They're wicked narrow like Monaco. The violence, John, near the end of the race.
Serious endurance test.
Yeah.
That Formula One race is.
And
so I'm taking off. I'm at JFK yesterday morning in New York, and there's like 10 laps left. And we start doing that taxiing thing. I lose the signal, and I don't get to see the last like 5 laps of this race. And the last 5 laps of this race were just magic. You've got Russell and Hamilton and Mercedes chasing Norris, Lando and a McLaren, and Sainz in a Ferrari. And Russell goes off on what, the last lap?
He goes off in the last
Hamilton
lap.
can't
His
catch
tires
Lando,
just
and
wore out.
Ferrari get a win.
They were saying that Sainz, when he won, the tires were barely working.
Do you know what you did to him? He came to London and he spent an entire day watching Formula One.
I know he did.
Like literally the entire day.
Watched quali, and then watched the whole race.
Well, the difference is we had it on the Gulfstream. It was great. We had the feed on the Gulfstream, which was really good. Yeah,
must be nice.
David Livingston of Citigroup is coming up shortly. Equities right now down about 1/10 of 1% from London. This is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one. Okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening, because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
One important thing looking forward, different to the last 10 years, is uncertainty around inflation. So we see inflation coming down towards central bank targets, a little bit above, but coming down over the course of next year. But I think clearly there's much more uncertainty in the inflation picture for the next few years compared with the last decade.
Andrew Balls, Global Fixed Income CIO at PIMCO. Clearly, Senator Schumer is not my boss, because I've got to put my jacket back on for our next guest. Equity futures on the S&P 500, slightly negative. We're down by 0.1% on the S&P 500. Yields unchanged, 434 on a 10-year. Eyes on crude, 91.88 right now, 91.99 just months ago on WTI, and just short of 95 on Brent, 94.78. High this session was 94.89. And Rita Sen of Energy Aspects on the program with us a little bit earlier this morning. That headline was always going to catch on, wasn't it? Triple-digit crude by Halloween.
Yeah, of course.
Scary stuff, TK, going into the end of October.
Well, it is. I mean, at the end of October, what we're going to see are including Jobs Day, which we haven't even touched upon after the Fed meeting here, but it's fluid. But I'm sorry, 94.79 on Brent crude. Is there any other story all of a sudden for our listeners and viewers? When does a gallon of gasoline pop? That's all.
That's happening. That's happening,
Yeah.
Bramo. Equities just a little softer then in the FX market. Going nowhere here, Lisa, on the euro 106.58.
I wanted to take a look just quickly at the auto manufacturers, including Tesla, since that is sort of the other side of this whole debate and what they were doing. And what you can see right now is Ford and Stellantis very much negative. Tesla actually joining the crew, although they did pop earlier this morning after the Wall Street Journal put out a report saying that Saudi Arabia is in talks about possibly building some sort of EV factory in that nation. I am curious, though, about the Stellantis underperformance, down almost 2%. Is there a signal here in terms of the union saying no to a 21% gain in their salaries? Does this mean that the bar is going to be that much higher and there's going to be that much more in terms of profit erosions after years of record profits?
We're going to have to see. I mean, it's the union day. When does the president speak again? I mean, what is the path forward Monday, Tuesday, Wednesday?
I spoke on Friday, and he actually handled the situation pretty well, I thought, based on his address on Friday, given how difficult this position is for him at the moment. We said a lot of weight was on his shoulders to come out on the side of the union and the strikers, and I think he did that in some ways.
Please stay with us. Of course, Balance of Power tonight with Anne-Marie Horton and Joe Matthew on what's going on in the United States. We're in London, and what that means is a sense of international banking for the banks of the United States. No one, not so much uncertainty, but is in a mode of restructuring, is Citigroup. Jane Fraser has called upon David Livingston to be her chief client officer, to pick up the pieces and to move forward for a stock that has been challenged coming out of the great financial crisis. David, thank you for joining Bloomberg this morning.
Tom, great
What's
to be here.
mission number one? What has Jane Fraser said to you? This is the marching orders. Go.
So we now have a structure which fits our strategy. So our strategy didn't change on Jane's announcement last Wednesday. What did change is the structure that's going to implement that. And in my new role as the Chief Client Officer, which is a new role in Citi, is very much to say we cover clients around the world, tens of thousands of them and millions of them in the US in our personal banking business. Are we doing it the best way we possibly can? Are we as coherent as we can? And are we delighting them as much as we possibly can with our capabilities? And so the number one is to make sure that we bring that dimension through all of our decision making.
You were an undergraduate in Australia a few years ago. It's the same then as it is today. You have to have a distinctive defining feature. What is going to be the defining feature of Citigroup 5 and 10 years out versus the other major U.S. banks?
Always going to be two dimensions on that. One is the fact that we offer the broadest set of capabilities, and particularly institutional client capabilities of anyone. And secondly, we do it on a geographic dimension, which is we are the most international organization. We do business in 160 countries around the world, and that serves our client base. That's those clients with cross-border needs of whatever nature, financing, payments, advice, that will continue to be the distinctive feature of Citi.
David, the uncomfortable conversation, it always is, job cuts. Are they focused or going to be focused on specific geographies or functions? How's that going to work? What's the approach?
So I think, firstly, job cuts is not the story here. It is unfortunate. We will have people leaving the organisation, some very talented people leaving the organisation. But that's not where we started. We started with the need to simplify our structures and our management routines. And therefore, the job cuts are the output. They are going to be, as you've seen, that there is my former role as the Chief Executive of Europe, Middle East and Africa, that layer, the Asia-Pacific layer and so on, they are being taken from the organisation, as are some of the capabilities that we had sitting above our products, which now our businesses report directly to the CEO. So it'll be in those areas where if you like, the reduction in the number of roles that we need will be felt.
Do you have a decent idea of numbers already?
We're not talking about numbers at this stage. We're talking about the strategy and the change in structure.
Because you don't want to focus on them, but internally there must be an assumption of what the number is right now.
There is a sense, but again, that's not exactly where we're spending the core focus of what we're doing.
The reason why we're talking about things like this and the reason why people pick up on the idea of job reductions is because it seems like even though banks had been looking for higher yields for so long, it's been difficult to pass them along in a meaningful way at a time where people are worried about recession, people are worried about the ability to repay those loans. How much are you expanding your loan book? How difficult is it at a time when you are seeing those concerns about recession looming on the horizon?
Different answer in different parts of our business and different by geography. If you take the United States, for example, the US is, as we know, flush with liquidity, which has been stimulus, which is from the US government. And so therefore, loan growth and demand at the consumer level and even the institutional level has been a bit more muted. If you take also what's happened to interest rates, particularly companies are looking and saying, what is the profile of interest rates and when is the right time to borrow, particularly entering into long-term commitments. And it's not that there's no activity, but there is cautious activity in terms of taking on additional or new leverage at this stage.
How do you acknowledge the difficulty, the complexity of the different regions that is specific to those regions while simplifying in a very new structure? How is that sort of going to be a challenge that you're going to work through?
We're not taking the regional, the geographic dimension out of Citi. That remains very, very sound, and we'll keep operating the company with a single international organization outside of North America, and with 7 core clusters which exist today and will continue to exist, but will be given more autonomy and authority in order to be driving the client activity which is happening within their geographic clusters, which means that they address the situation that's relevant in front of them.
You are deeply experienced at this, and it's outside your remit to talk about shareholder return, use of cash, etc. But the crushing disappointment from Mr. Weil to Ms. Fraser has been the share price. It just hasn't moved off the 10-for-1 reverse split of 2007. How do you counsel Jane Fraser to move that stock price higher to where your competitors are?
So I think Jane takes counsel, of course, from many people, but I'd say she also is able to be decisive in her own right. I think what she's done in terms of this reorganization, again, where our structure now fits our very, very clear strategy, is that we have the best possible platform now in order to make it clear what our return potential is, because ultimately it's returns that will drive the share price, and we need to be able to demonstrate that to our investors.
Let's finish on some easy stuff. What's office attendance like in London at the moment for you guys?
It's improved, and
is it better than New York in London?
Yes, in some parts, I think it is. But they're actually, New York and London pretty much on a par. But I think it's becoming very clear, not only to management, but also to our broader organization, that being in the office is just so much better.
Are you making the 5-day push?
Well, our policy is three days as a minimum. So that's where we are.
4, then 5?
We'll see over time.
David's not wearing the shoes with the white soles. Just
no hybrids here.
No hybrids here. David, I'm looking down here. It's
David, thank you. David Livingston of Citi.
Appreciate
it. Fantastic. I know that was something you were focused on, Tom, coming over to London. Office attendance here compared to, say, New York.
My sense is that here it's better than, I wouldn't want to editorialize, but then the disgrace in New York.
Given the direction of travel, it starts at 3, Bramo. You know what happens. Then it becomes 4.
100%.
And then it's like 5.
Basically, this is the global executive class coming out and being like, it didn't work for a lot of jobs, and you need to come back to the office, and sort of easing into it with workers pushing back and now getting a better sense. Okay, I need to relocate back to the city I was working in.
It's celebration time, Bramo. We're going to take Bramo to the pub. Get Bramo a pint. We can do that because it's 1:56 in London, so that works, doesn't it?
100%.
5 o'clock somewhere.
I saw people at noon with big pints.
Coming up on Bloomberg TV, don't miss this. The Stellantis CEO at noon Eastern time. Live from London, more through the week from us. Thank you for choosing Bloomberg TV. This is Bloomberg Surveillance.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Could be that given that we have this productivity enhancing technology that is AI, that has come off the back of this transformative communications network that's the internet, and we have a fundamental shift in the way the energy system is working, so there could be the ingredients of a pivot point of a kind that we've only seen a couple of times previously in history.
But let's ask what the driving forces will be. The world is propelled forward and has been for thousands of years by great power competition. That is the thing that drives innovation right now across the board. It is a competition which is intensifying between two superpowers, the United States and a communist-led superpower. Now, is this starting to sound familiar?
It does.
So what is really significant about this historical moment is that we are in the first inning, the early phase of Cold War II.
Right.
And that is going to drive all the things that we've talked about, and it will not necessarily drive these changes in directions that are benign. The big technological advance of Cold War I was, of course, nuclear weapons. And the arms race with nuclear weapons was an extremely dangerous one that very nearly blew the world up, particularly in 1962 at the time of the Cuban Missile Crisis. I don't believe for a minute that we can have a Cold War II without a similar risk.
Warren Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things, we have this great connection about the love for baseball. And the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
This is Bloomberg.
From New York City, for our viewers worldwide, I'm Matt Miller, in for my good friend Jonathan Farrow. We're looking at markets right now that are doing a heck of a lot of nothing in terms of the equity indexes, right? S&P futures right now down just 0.1%, a little bit less. Russell 2000 futures gaining about 0.2%, but oil continues to ride. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Coming up, Treasury yields testing multi-year highs as well, with global central banks in focus all week. Auto workers remaining on strike after the UAW calls the latest offer a no-go. And the UN General Assembly kicks off amid simmering U.S. tensions with China. Don't try and drive in Midtown Manhattan. We begin with a big issue looking ahead to a Fed rate decision.
There's obviously a pretty critical Fed meeting.
The Fed will do what we all expect it to do.
They'll pause.
Pause.
It's going to be probably a hawkish pause.
A hawkish pause.
A pause, but an indication that they're prepared to do more.
Leave the option open that there'll be another hike.
They'll keep wide open the possibility of another hike.
I don't think they can say they're done.
They're going to remain vigilant.
November is really what the market is going to look towards.
We may very well be at the end of rate hikes.
We see inflation coming down.
They're going to raise rates in November.
The economy is still growing above potential.
It's a really tricky needle to thread in terms of doing just enough, but not too much. Whether they hike again in November is yet to be seen.
Joining us now to discuss is BlackRock's Marilyn Watson, as well as Nuveen's Anders Persson. A lot going on in terms of the Treasury market, a lot going on in terms of oil, not a lot in terms of stocks right now. Marilyn, what do you think about 434, 435 on the 10-year?
Yeah, I mean, I think, as you say, this is a very, very busy week for central banks. I think the market has just been
trying to really absorb the price of oil, try to absorb the recent data that we've had in the US, which continues to be, pretty positive overall. And I think, this week our view is that the Fed will, continue to pause, be on hold this week, and then, but they'll make it very, very clear that they are still data dependent and that, November, we'll see what happens. But I think the market's just trying to really position itself and gauge what's going to happen this week, because we also have, the Bank of Japan, which is potentially more of an unknown. We have the Bank of England, we have a range of central banks, and I think given the focus on those, I think the market's just sort of, moving around with that.
Anders, what do you think? I mean, right now, back up to 435 on the 10-year. It's been a choppy morning for the yield trade, but you don't sell these bonds going into the pause, do you? Expecting a Fed hike coming later?
Yeah, at this point, we're certainly not expecting a hike this week. I think it's going to be this kind of hawkish pause that a lot of people have been talking about. I think they're going to reiterate this message from Jackson Hole to proceed carefully, kind of staying data dependent. And the big question mark is, are they going to do something in November? And the markets are pricing in roughly a 40% probability of some kind of move maybe later in the year. But right now, I think they're going to try to buy some time. I think really the markets will probably, look at the dot plots a fair bit, kind of see if there's some changes there, particularly for the 2024 kind of type dot plot. Because from that perspective, we had 100 basis points cuts kind of lined out from the Fed. We think that could maybe change to 75 basis points. So a little bit of new messaging from that perspective. But all in all, not expecting much fireworks this week from the Fed.
Marilyn, what do you expect from the dot plot and from November? I mean, this market has been overly optimistic throughout this Fed rate hike cycle.
Yeah, so in terms of the dot plot, as you know, at the moment it's essentially showing sort of 5%, 5.6% year end this year, down 4.6% end of next year. I think we'll be focusing on, we expect them to remain pretty much the same for this year, given that while we think they'll be on hold, they are still very, very data dependent. The question is, I think, more whether we could see an adjustment to that, but more I think it's, again, next year, what could we see, whether we expect to see, and whether the voting members expect to see rates higher for longer. And as we do expect, at the moment they're showing a cut of 1% in total next year, but from where they currently think they'll end this year. But we could see, next year and also further out into 2025 as well. If they expect rates to be higher for longer, then I think that will have an impact.
What has to happen for a 1% cut, Marilyn? What has to happen for 4 cuts next year?
So at the moment, the economic data, I think, has consistently surprised to the upside, both for the FOMC as well as for many market observers as well. And I think what we would need to see for them to change, or what they're expecting next year, is to see if they were to, maybe reduce their forecast further for next year in terms of interest rates. We would probably have to see more deterioration in terms of economic activity, the US economic outlook. Also in terms of inflation, it has been moderating, it is coming down, but it's still above the target. And so, but I think really what we would need to see is a deterioration really in economic activity, in GDP, in the unemployment rate, in the labor market. And at the moment, we're just not really seeing that in terms of the data.
All right, Anders, Marilyn, sit tight. I want to get over to Mike McKee because, early this morning, I thought crude had to be the asset class to watch today. But you look at these intraday graphs, and yields are just taking off right now. The Fed obviously headlining this busy week of central bank decisions, with the Bank of England and the Bank of Japan among the others meeting, and maybe the latter being more interesting. But Bloomberg's Michael McKee joins us now for more as we watch. We just saw almost 508 on the 2-year. We're looking at 435 on the 10-year. They're taking off.
They're taking off, and it's because who needs the UN General Assembly, Matt? We've got the Global General Assembly of Central Banks. Not only did that chart show you a few of the people who are meeting beyond the big three, but we have meetings this week for central banks all over the world: Indonesia, Philippines, South Africa, Sweden, Switzerland, Taiwan, Turkey, Egypt, Brazil, Norway. Just the list goes on and on and on. And in general, most of them are going to be looking at raising rates, or at least sounding hawkish as inflation continues. And now we see those oil prices going up. The big three will get the big attention, however, and rate hike odds, as you mentioned, Matt, are getting a little interesting. The Fed, nobody cares. They don't think the Fed's going to raise rates this meeting. It'll all depend on what Jay Powell says. But the Bank of England is pretty much priced in for another move. And then you take a look at the Bank of Japan. It's been a long time since people really traded on the idea that the Bank of Japan might do something. They don't think they will actually raise rates this month, but they do think that what we're going to see at some point here is them getting a hawkish tilt towards their policy, because inflation has risen high enough. And you can see there that they are going to be the most interesting of them all, because the Bank of England and the Fed have already raised rates so much. Look how far back you have to go to see a movement in the Bank of Japan's base rate. The number to watch, though, this Friday is the dollar. Once we get through this week of all these central banks moving, where does the dollar end up? We've seen the dollar index continue to rise as the Fed has raised rates, and that'll be a signal to the rest of the world about where we are going now. If the world thinks that maybe the Fed has slowed down, then we will maybe see a little bit less pressure on the other central banks. So right now, keep an eye on oil prices going into the week. At the end of the week, let's see where the dollar is.
Yeah, we're looking at $92 now for WTI, West Texas Intermediate on the NYMEX, $94.84, so nears the to $95 for Brent. What do we look for in the dot plot, in the SEP? I think we get that this time. In the face of rising oil prices?
Well, we're probably not going to see a whole lot of change, Matt, because we don't know how long those rising oil prices are going to, A, continue to rise, and B, how long demand is going to hold up for gasoline prices when they start going up. So the Fed can't really forecast that. But look for the dot plot to still retain the idea of one more move this year, because they don't want markets to start pricing cuts. And then look for the summary of economic projections to suggest we may have a little bit stronger growth and a little bit less unemployment than the Fed had forecast going forward. We'll want to see what they say about inflation as well.
All right, absolutely. I hope we don't hear the word transitory, though, even in relation to oil. Mike McKee there with a look ahead at this busy central bank calendar. Sticking with central banks, Nouriel Roubini delivering a warning to the BOE and the ECB. Take a listen.
The problem is that the Bank of England right now is sending sort of dovish signal in a situation in which the policy rates are well above the Fed, but inflation is well above the United States. So what they should be doing is actually hiking rates all the way to at least 5.75. The signals are telling us right now is they're not sure whether they want even to hike more. If that happens, there could be a de-anchoring of inflation expectation, and you could have a true stagflation. That's a dilemma for both the ECB and the Bank of England.
Marilyn Watson and Anders Persson back with us. Anders, let me ask you your take on the other central banks. I mean, how close are you paying attention to what happens at the Bank of England, what happens at the Bank of Japan, considering that the Fed has been driving policy globally until now?
Yeah, no, at this point, you definitely have to pay attention to all these kind of key central banks for sure. I think, certainly the Fed is still setting the tone more or less globally, certainly here for the US, but I think all these data points are important. I think Bank of England, I think, is probably in the most tricky spot right now. Most central banks, we do expect, as Michael mentioned, as the market is expecting one hike here coming to 5.5%, and maybe one more after that as well. I mean, it's just a very tricky environment going on in the UK at this point, more broadly. The Bank of Japan is probably going to be, a little bit less influential here for the near term. I think the market has already kind of accepted that the yield curve control is playing through a little bit here, and I think overall that's been fairly well messaged in the market at this point. So all in all, I think the focus will quickly go back to the Fed and potential next steps that the Fed's going to be doing in the November timeframe.
Marilyn, what's your take? I mean, everyone's excited about the Bank of Japan because it'll actually, potentially do something interesting and different. But does it matter as much?
So it does matter. And I think in particular, it does matter increasingly going forward as we do see the Fed get to the end of this rate hiking cycle. And then we look at the divergence in terms of the economies, the economic activity of the different regions. I mean, we're seeing increasing divergence between the US economy, the UK certainly, the Eurozone, and then Japan again is in a very different situation. So I think it does matter, and it will matter increasingly as we do start to see, this divergence in terms of when central banks get to the end of the hiking policy, but also in terms of economic activity, prices, valuations, and then where investors can find opportunities globally, in the different regions and in the different, financial asset markets as well. So I think as we do see, the Fed potentially pause and get to the end of the cycle, I think it does matter, and I think it matters for investors to be able to really be nimble and really get at the different opportunities that we'll see as we do see, a dislocation potentially between market pricing and the opportunities for investors.
All right, looks like we bounced off 148 yen to the dollar with greenback strength continuing, but maybe that's a level to watch. Marilyn Watson and Anders Persson are sticking with us, joining us now with a look at the stock market ahead of the opening bell. Here's Abigail Doolittle. Abigail?
Well, Matt, we do have U.S. futures lighter by just a little bit. Let's take a look at what's weighing, starting out with the shares of PayPal, down about 1.7%. This as MoffettNathanson has downgraded the stock to a market perform from an outperform as the growth outlook slows. Lisa Ellis is saying that profit growth will remain anemic and EPS growth is slow as PayPal is facing fierce challenges. Tesla had been higher earlier in a Wall Street Journal report that Tesla and Saudi Arabia are in early talks for an EV factory, but with yields higher pressing big tech down. Ford down 0.8% along with Stellantis. This as the UAW strike is in its fourth day. So a little bit of soft stock action this morning, Matt.
Yeah, very interesting developments on that front. A 21% pay rise offer pushed aside at Stellantis by the UAW. Thanks very much, Abigail. We're going to talk more about the union coming up unmoved by this sweetened offer.
So 21% is a no-go for you?
It's definitely a no-go, and we've made that very clear to the companies.
U.S. auto workers extending their strike to a fourth day. That conversation up next. This is Bloomberg.
Do you think there's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well? Or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea. But technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
So 21% is a no-go for you?
It's definitely a no-go, and we've made that very clear to the companies. We're prepared to do whatever we have to do, so the membership is ready. The membership is fed up. We're fed up with falling behind. It's been decades of falling behind.
UAW President Shawn Fain rejecting the latest pay raise from Stellantis, the automaker calling the offer a compelling solution for protecting jobs at an idled Jeep plant in Illinois. The disagreement signaling, though, that the union and Detroit's Big Three are still pretty far from a deal 4 days into the strike. Bloomberg's David Welsh joins us from Detroit. He's our bureau chief there and has been covering this very closely with his team. David, you know, we focus so much on the pay part of their demands, but the union has asked for a lot more than just a 36% pay increase at this point. They also want to bring back defined benefit pension plans, and I believe they're still sticking to a 4-day work week. What's the status of the demands from the UAW?
So they still want those things. The companies, if you look at their offers, that stuff's never in there, particularly the retiree stuff. They've even asked for retiree health care. Those are the two big ticket items that just weighed down the balance sheets of all three companies, played a role in driving GM and the former Chrysler into bankruptcy. Ford had to borrow $24 billion to stay out of bankruptcy. They're not going to do that. The companies will take a very long company-wide strike before they would agree to those, fixed retiree benefits. They are willing to move on pay, obviously. They're already up over 20%, and I think they'll continue to bump that, not interminably, but they will. That's something they can play with. But those other retiree benefits and the 32-hour work week, I don't think they'll budge on either one of those.
In terms of the damage this could do to companies, when you think about handing out a 21% pay increase to so many tens of thousands of workers, you might worry that it bankrupts GM, Ford, and Stellantis. But they've done well, and it's not actually a huge part of the cost of a car, is it, labor?
No, I've seen estimates. It's somewhere between 5 and 10% is the cost of labor. There's a lot of other labor in there from the suppliers, but they wouldn't all be getting 20% raises. So, yeah, it will bring their costs up. It will bring their labor costs would definitely be uncompetitive with Toyota, Honda, Tesla, Hyundai, and Kia. They'll be in a worse position. But there are two things. One, it's not the kind of money that bankrupts the companies. It eats into what are now very good profits. And two, these other companies, and we've seen Toyota do it over the years, they've had to raise compensation and improve benefits to keep the UAW out of their plants. You can't be at a $5-8 labor disadvantage versus a UAW contract and expect your workers to not maybe listen when a union organizer comes around. So union contracts do, and they have, raise all boats. Now, they've always stayed, something under what the UAW can get to maintain the advantage, these other companies. But they will end up having to pay more as well if they want to keep the UAW out of their factories.
Yeah, it's a very interesting point in terms of the competition, and it'll be interesting to see if a win here for the UAW can actually get them into some of those competing plants. David Welch has been covering this. We'll continue to. Obviously, the big story, I would argue, not just in Detroit, but nationally right now. Marilyn Watson and Anders Persson are back with us, and let's talk about how this strike could translate into the fixed income world that you guys are so focused on. Marilyn, clearly it's going to drive up compensation, so there's the concern about a pay wage spiral, driving inflation further. Is that the only connection that you can see?
So I think it certainly, highlights the strength of the labor market at the moment. And I think in terms of the fixed income market in the long term and what that means, also when you look further down the line at monetary policy as well, I think one of the factors to really bear in mind is that the US has an aging population in terms of demographics. You're seeing many people becoming of pensionable age. You have a workforce that you don't have the same supply in terms of younger workforce. And I think we'll continue to see these pressures for some time in terms of we've already seen the last couple of years, particularly since COVID, just how strong the labor market has been, how there's still a deficit in many areas in terms of getting the number of employees in different sectors back to pre-COVID levels. We've seen pay rises, across the board in most different industries. And so I think, in the long term, it just really highlights the fact that it is an aging population, that the economy is still very strong at the moment. And we've already seen this in other sectors where we have seen wage rises.
Anders, obviously, wage price spiral is the phrase that was eluding me there. It doesn't seem that monetary policy is really holding that back. What connections do you see with the fixed income world that you run at Nuveen?
Yeah, no, I would echo those comments, basically. I think the broader dynamic here is more key here, that the labor market remains very tight and wage pressures really haven't eased sufficiently. I think the Fed's going to keep a very close eye on that. And more broadly, these kind of type actions and discussions is going to put pressure on wage prices and inflation moving forward overall. That being said, I think it's important to keep in mind that from a credit perspective, we're not expecting these discussions to really put a whole lot of pressure on these issuers. You're seeing bonds and stocks and CDS, for instance, holding up just fine for GM and Ford and what have you. So it's been pretty well flagged, and we're not seeing much deterioration from that perspective. So I think investors, they basically appreciate that this is an uncertainty, but this industry and this sector has come a long way and is pretty well positioned. And so I think there's a balance there that we're trying to make sure that we're basically taking into account at this point.
All right, Anders, thanks so much for joining us. Anders Persson there from Nuveen, Marilyn Watson joining us from BlackRock. Pleasure having you on the panel today. Coming up, the morning calls, and then later Morgan Stanley's Andrew Slimin joins us, making the case for an equity rally in the next quarter after this September lull. That conversation still ahead. This is Bloomberg.
Okay, so you're moving in on me quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
My knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
Just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. Got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Time now for our morning calls. A look at some of the analyst recommendations on Wall Street that could affect the market this morning. First up, MoffettNathanson downgrading PayPal to a market perform, expecting softer EPS growth due to mounting competitive pressures there. Next up, Guggenheim upgrading Ralph Lauren, or is it Lauren, to a buy, seeing an attractive entry point with shares 14% down off of this year's peak. And then finally, Deutsche Bank upgrading Micron, the chip maker, to a buy, saying recent checks point to improving chip prices and strengthening demand for that sector as well. Coming up, Morgan Stanley's Andrew Slimin on why he expects stock to rally heading into the year end. That conversation up next. This is Bloomberg.
charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We will be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think, within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment cost agreement on which we could lead the charge of air travel into a post-war Ukrainian recovery.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready? Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stenevec bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
This is Bloomberg.
This is the countdown to the open. I'm Matt Miller for John Farrow. We've got equity indexes moving down for the big caps, not so for the Russell 2000. You've got an all-star lineup of bell ringers at the NYSE and the NASDAQ moments away from the start of trading. Here are the opening bells. One stock to watch at the open, we're going to get to in just a moment. Here you see the euro dollar at 106.69, the 10-year yield. That's really the stock to watch, is the 10-year yield, I think, or the price of oil. Both of them soaring to highs that we haven't seen in months, if not years. 435 almost on the 10-year. NYMEX crude at 91.86. So there you go. Former Vice President Al Gore ringing the bell at the NASDAQ. One stock to watch at the open, I was going to say Apple. Shares edging higher as pre-orders for the new iPhone 15 surpass expectations. Bloomberg's Abigail Doolittle is here with more on Apple. Abigail?
Well, Matt, it's interesting because there's a little bit of a mixed picture in terms of these pre-orders. Let's save the bullish picture for the end on a bright spot. But there are a couple of analysts out there saying that these pre-orders for the iPhone 15 might be a little bit flat. In particular, Barclays is saying that the early pre-order data point that China continues to point to a difficult iPhone 15 cycle with a negative mix shift, meaning trending toward the lower end phones. Bernstein saying historically Apple, the stock, has treaded water a bit after these iPhone launches. That is true right now. We have Apple breaking down to some degree, down more than 9% or around 9% in this quarter. Although today we do have Apple up 1.1%. So let's get to the positive. Morgan Stanley saying that the early iPhone 15 pre-order data is good. And Wedbush going even further, saying that the trend is toward the higher end phones and that it could be 10 to 12% above the iPhone 14 orders. Most important, Matt, I think to some degree are the numbers. This company has been showing over the last few quarters negative growth for both top and bottom line. The first quarter of their fiscal 2024, which is the December quarter, is expected to show a return to growth. If they can have that growth for the December quarter, well, Apple might come out of its recent doldrums.
All right, Abigail Doolittle there on Apple. Let's turn to the media space right now. Disney holding preliminary talks with potential buyers for its India streaming and television business. Bloomberg reporting Disney is weighing strategic options for the business, including an outright sale or setting up a joint venture. Plus, heck, we've had so much news on big asset moves over at Disney. Let's bring in Bloomberg's Ed Ludlow from the West Coast here in New York.
Yeah, good morning. Good morning to you, Matt. Disney modestly lower, 0.3%. What Bloomberg sources are saying is they could take the Disney Star property in India and sell it outright, or they could do more of a piecemeal approach where they take the sporting rights that are India-based and the Disney Hotstar regionalized streaming platform, put them in combination. As you said, Bloomberg had also reported first in July that forming a joint venture in the region is an option. It's interesting because one of the parties in talks, according to Bloomberg sources, is Mukesh Ambani's Reliance Industries. That goes back to Disney losing the rights to the Indian Premier League cricket in that nation. Where did those rights go? They went to a JV between Mukesh Ambani's Reliance and also Paramount. So now Disney looking at his options, an outright sale potentially, a joint venture, or a more piecemeal deal where specific rights and properties sold off. By the way, the stock's off to 0.2%. It was initiated at Raymond James this morning with an outperform. And their argument's basically like, it's been a horrible time for media companies, but beyond that, cash flow looks good, valuations look good compared to the rest of the sector.
All right, Ed, thanks very much. Ed Ludlow there taking a look at Disney for us. Now, a cybersecurity incident that affected Clorox last month has been contained after addressing the unauthorized activity. The company saying the attack damaged portions of the IT infrastructure, which caused wide-scale disruption of Clorox's operations. The company now believes the impact will be material on Q1 financial results. Simone Foxman here with more. You'd rather hear marginal there than material, wouldn't you?
I think you would, and it's unclear, the company says, if this will actually weigh on its full year guidance as well. And that's why we're seeing shares fall in today's trading, now down about 1.5%, weakest since early February. But more details of this cyber attack is really that it's continuing to have all these impacts on operations. The company's saying it's operating at a lower rate of order processing, and that customers are feeling some of the impact of product availability issues. It damaged the IT infrastructure that the company has, and I think this is really concerning as well. The company isn't going to be able to move back to its normal automated processing for orders until the week of September 25th. So we're not already back where the company should be. Now, this will have a material impact on the Q1 financial results. That is the quarter that ends in September 30th. But the company's saying, again, it's premature to look at the year and potentially see an impact there. Bloomberg Intelligence is saying that this is really a concern for the company as it tries to transition from this price hike-led sales growth to the volume-led sales growth, has the potential to weigh on margins, and that's clearly being reflected in trading today. Matt.
All right, Simone, thanks very much. Clorox down 2% at the open. Let's turn to the IPO market, stories around which have been very hot lately. Online grocery startup Instacart has been flirting with an IPO for years now, and it's finally taking the plunge, making its trading debut tomorrow. Bloomberg's Shonali Basak has more. Shonali?
Matt, you're looking at Instacart, which will price tonight, start trading tomorrow, as you've been saying. And last week, after the successful ARM IPO, Instacart and its bankers went ahead and increased its price range. Now, at the high end of the price range, you would have a company worth more than $9 billion, almost $10 billion. And while that's below its most recent funding round, where it was valued at about $13 billion, the name of the game for the IPO market is no longer high flying. The new game in town is smooth sailing. So you do have these companies now looking to set expectations, make sure that they're making it into the market with a popular IPO pop. These pops, as we saw with ARM, could be muted at first, but you saw ARM continuing to hold steam into the next day of trading. Now, one thing Instacart has on its side so far is the cornerstone investors that it has lined up. Even though the market is watching the story on margins moving forward on Instacart, you do have PepsiCo coming in as an investor into the IPO, as well as cornerstone investors that could take up 60% of the shares. That includes a division of Norges Bank and Dan Sundime's D1 Capital. Now, do those names give the market enough heat to buy into the stock? One thing these firms have in their favor is timing. They're all coming ahead here of that big Fed decision on Wednesday. They are trying to get a calm market into their debut. Klaviyo, the following day, has also increased its pricing range. Will price tomorrow night, trade Wednesday.
All right, Shonali, thanks very much. Shonali Basak there on IPO Watch. Let's get to Morgan Stanley's Andrew Sliman right now. He has been making the case for a rally in the fourth quarter, writing, quote, underweight to equities will likely become more painful into year end. According to consensus estimates, earnings are likely to inflect from negative or flat in 2023 to positive in 2024. Investors should greet the resumption of positive earnings growth warmly. I'm pleased to say Andrew Sliman joins us now. Andrew, great to get you on this. As we start to see all of the bears throw in the towel, has every last one capitulated, and wouldn't that make you nervous?
Sure. Well,
It's one thing to say that you've turned from bearish to bullish. It's another thing if you put your money where your mouth is. And if you go and look at fund flows on a weekly basis, that follows from funds and ETFs, they remain negative on a weekly basis. And that is very symptomatic of the early stages of a recovering bull market off a bear market low, where investors are sellers. It happened in 2020 off the March low. It happened in 2009 off the great financial crisis low. Investors sell into the rally. That is consistent with the first stage of a bull market. Eventually they capitulate and they turn back and go in, but that hasn't happened yet. So it's one thing, sentiment is one thing. I watch what people do with their money. I think that's much more significant.
That's exactly, well, it's paraphrasing what Alan Greenspan, I believe, said, Andrew. In terms of valuations, what's the best measure to look at? Is it still, forward PE, and where do you put that?
Well, what Wall Street is classically overconfident in is their ability to predict earnings. I mean, it is yet again this year has turned out to be a better earnings year than what many on Wall Street predicted. So what I watch much more is revisions and what companies are saying versus what's expected. And you know what? That's turned out recently to be better than expected. So that number for next year, the consensus is somewhere just below $250. That's come up recently. And so I think that's more important. There's no question that interest rates weigh on multiples, but I think in a recovery earnings, we're going to get a rally first and then ask companies to deliver on what's expected next year. So I suspect this year will turn out to be even better year for equities than next year.
In terms of the headwinds, are you concerned about, the consumer seems to be putting a lot more on plastic. Default rates on credit cards are rising. Same is true with auto loans. Student loan payments are going to resume. Oil prices, we're looking at $92 a barrel now for WTI, 95 for Brent. Households have run out of excess savings. I mean, the bearish list could go on and on and on, but I'm not sure how you feel about it.
Yeah, I mean, many of those statistics are what the bears throw up, but really has the household run out of excess savings? I mean, energy as a percentage of a consumer's expenditures continues to drop. Am I worried that the Fed is raising rates, interest rates moving higher tends to deter economic activity? Of course I'm concerned, but I think the story is that it's very hard to know when that will occur, and the simple reality is the consumer and corporations fixed a lot of debt during COVID so that they're less interest rate sensitive than they've been in the past. Doesn't mean it won't have the same effect. It just will take longer, and I think that's really what the story is. The inverted yield curve is telling you there's a slowdown out there. It's not very good at telling you when, and I take comfort from the fact that we keep pushing out the first Fed cut. I don't want a Fed cut because that's a sign of the economy weakening. The fact that we keep pushing that out, the fact that the 2-year yield remains high tells me the economy is stronger than what many people predicted.
What sectors do you like, Andrew? Because we've obviously seen most of this year's rally supported by only one, not even one sector, just a handful of companies. Do you see a broadening out? Do you like something besides tech here?
Sure. Well, but yeah, I mean, I like growth and I don't like value, or I don't like value, I like growth. I think you want a combination. What is clear, and again, consistent with the first leg coming off a bad bear market, is the worst performers are the defensives. And lo and behold, that's because, last year the market went down, defensive stock, consumer staples, utilities, etc., healthcare, they held up the best. And so what do investors do at the end of last year? They all piled into dividend-paying strategies. It was the number one selling strategy last year, and yet that's lagged this year. So I think you want to have a combination of growth, technology, and value, financials, energy. And right in the last
month or so, energy has really done very, very well relative to tech. So I suspect going into this fourth quarter, you'll get money coming back into many of these well-known cap names because they're liquid, they're easy to buy, and I suspect that their quarterly earnings won't disappoint.
Andrew, great to get some time with you. Thanks so much for joining us. Andrew Sliman, they are coming to us from Morgan Stanley. Coming up, GOP tensions looming over a potential government shutdown.
I want to make sure we don't shut down. I don't think that is a win for the American public, and I definitely believe it will make our hand weaker if we shut down.
Our team coverage up next. This is Bloomberg.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Paul Jacobson assured me that when he takes the new Hummer EV on long journeys, it's not just fun to drive, it's equipped to go the distance.
I hear so much about road trip anxiety that I wanted to experience it myself. My family likes to drive a lot, so I brought my daughter home from college in this, and it was great. I mean, the computer system is all intuitive. It tells you how to keep track of the battery. It tells you where the charging stations are. It tells you how much power you'll have when you get to the charging station. So it really puts a lot of your anxiety at ease. But as far as driving it, it's a treat.
So where are you on the charging stations? I know General Motors has made an investment in one company. How are we doing in this country generally in getting charging stations in?
So I think this is an area where obviously we can continue to improve as a country and a society. We're doing our best. We've committed almost $1 billion to EV charging. So we've taken that and looked at home charging solutions, local community solutions, and road trip charging solutions. With my daughter, what we would end up doing is probably stopping, grabbing a bite to eat, plugging it into a charger, usually a high-speed charger, to get as much charge as we can, and being there for 20 to 30 minutes. Get us a lot of range, and by the time we've used that range, we're tired, ready to stop again, etc. So it was a really good experience for me, and it's taught me, number one, what are the concerns of the consumer that are ultimately going to drive our vehicles, and then number two, where do we need to focus on addressing some of those anxious points for people.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
Make sure we don't shut down. I don't think that is a win for the American public, and I definitely believe it will make our hand weaker if we shut down. I gave them an opportunity this weekend to try to work through this, and we'll bring it to the floor, win or lose. I believe we'll get agreement this week.
That was House Speaker Kevin McCarthy speaking yesterday as tensions rise on a possible government shutdown. House Minority Leader Hakeem Jeffries saying, quote, "The House Republican civil war is hurting hardworking American taxpayers and limiting our ability to be able to solve problems on their behalf." Let's bring in Bloomberg's Kaylee Lines in Washington for more. So, Kaylee, it looks like the Speaker making some pretty adult statements there. Is the class going to listen?
Well, this is the question, Matt. We are now just 13 days out from a potential government shutdown, and so it was a working weekend for House Republicans. We do have on the table now a deal between two very key factions, the far-right House Freedom Caucus, which includes many of the members that are giving Speaker McCarthy a headache on this issue, and the center-right Main Street Caucus. They have a deal that would temporarily fund the government for 31 days, so through October 31st. The issue is, even if it can pass the full House, which remains a massive question because Speaker McCarthy is going to have great difficulty getting enough members in line with only a 4-vote margin of error, it wouldn't necessarily pass a Democratic-controlled Senate or be signed into law by the Democratic president, Joe Biden, who would have to sign it once it comes across his desk. The reason why is this measure that they have agreed to would include an 8% cut to domestic agencies funding everything basically except for veterans and the military. Also includes some measures on the border, like resuming construction of a border wall, making it more difficult for migrants to claim asylum in the U.S. It also doesn't include any funding for Ukraine or disaster aid that the Biden administration has asked for. So it's likely a non-starter if it can even get through the House of Representatives. That said, the Rules Committee is going to take it up today. They're planning a full floor vote in the House on Thursday. It's just not really clear that this measure is going to get us any closer to averting a government shutdown. And Matt, the clock is ticking louder and louder.
Absolutely. Kaylee, thanks very much. Kaylee Lyons there covering all things Congress for us out of Washington. Turning now to foreign affairs, National Security Advisor Jake Sullivan met with Chinese officials in Malta over the weekend, discussing a possible November meeting between Presidents Xi and Biden. The White House writing, quote, "This meeting was part of ongoing efforts to maintain open lines of communications and responsibly manage the relationship." This coming just ahead of the UN General Assembly here in New York City, which Xi plans to skip. Bloomberg's Anne-Marie Hordern is in New York, and she joins us now. So, AMH, what do we know about, who's not coming to this meeting and how, we're doing communication with our with our foes and allies in other ways?
Well, that's right. I think what's interesting about this UN General Assembly, or as everyone likes to call it, UNGA, is the meetings that are happening not here. So Jake Sullivan over the weekend sitting down with Wang Yi in Malta is almost a breakthrough, I would say, in the meetings we have seen and the outreach we've seen from the U.S. administration to their Chinese counterparts, because this would really be the meeting that could set the tone and the agenda for a Biden-Xi bilateral meeting, which potentially could happen before the end of the year at the APEC summit in San Francisco in November. Then you have Wang Yi, on the heels of his meeting with Jake Sullivan, going to Moscow to sit down with Sergei Lavrov. So obviously there's going to be a swapping of notes, I imagine Wang Yi will take from Sullivan to Lavrov. So that's one of the interesting developments around this UN General Assembly. We also have President Volodymyr Zelensky to be attending UNGA in New York City. And while he will meet with individuals here and he'll give a speech, more importantly is going to be his meetings that take place later this week in Washington, D.C. Of course, he'll be at the White House. He will go to Congress. How does he convince Republican lawmakers that at the moment are still unnerved and concerned about sending more taxpayer dollars to Ukraine that they should pass that bill? Remember, the U.S. administration, the White House, asked for in a supplemental spending bill more Ukraine aid. And what Kaylee was just talking about, that Ukraine aid was missing from that CR that the Republicans were discussing last night in a phone call.
It's amazing that, so many people are skipping not just Putin and Xi, but we saw there Macron and others in the Western world who are our allies not coming. Is the UN kind of dropping in its level of importance?
Well, that's a great question. I think every time you have these big UN General Assembly meetings, the question remains, is the UN obsolete? I mean, Zelensky has said that Security Council should be dissolved and the whole thing needs to be really redone because Russia stands on the Security Council while the UN writ large has condemned the war in Ukraine. They really can't do much about it when you have Putin sitting on the Security Council. So it's a big question, but at least this forum does provide an area and an arena for a dialogue.
All right. And we're glad to have you here in New York. Anne-Marie Hordern, thank you very much for that. For some of the sector price action this morning, let's get over to Bloomberg's Abigail Doolittle. This market just opened 22 minutes. Abigail, what do you see?
Well, we have a very small decline here for the S&P 500, Matt. And from a sector standpoint, not a lot of drama here, as John would like to say. On bottom, real estate, utilities. So as yields go higher, the dividends of those sectors look less attractive. Up top, communication services, energy getting a bid once again on oil strength, tech also higher. Now, interesting, Andrew Slimman earlier was saying that into the end of the year, he expects this rally and he would like a diversified growth value portfolio. That's actually what's happening over the last month. You can see tech, energy, financials, utilities, a little bit of everything there for anybody, all higher. It's going to be interesting to see whether this trend will in fact continue into the end of the year.
Yeah, absolutely. Although I think even Andrew said September is, not the strongest trading month historically. We know it's the worst, and he expects that trend to continue. Abigail Doolittle, thanks very much for that. Coming up, the market-moving events you need to be watching out for. That's next in our trading diary. This is Bloomberg.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. What's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
This is Bloomberg's The Open. I'm Matt Miller, in for my good friend Jonathan Farrow. Quick look at the markets as we stand 25 minutes into the trade. We're looking at the NASDAQ 100 up about 0.1%. The S&P 500 down about 0.1%. It's time now, though, for our trading diary to show you what you should be watching all this week. President Biden speaking at UNGA, the UN General Assembly, tomorrow on Tuesday. On Wednesday, we get the Fed rate decision and a news conference from Chair Jerome Powell. Then the BOE announcing its decision on Thursday. Plus, we'll get U.S. jobless claims and existing home sales on that day for the U.S. of A. And finally, on Friday, a BOJ rate decision. This was the countdown to the open. I'm Matt Miller for John Farrow. This is Bloomberg.
There's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere.
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights.
How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question.
I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg. From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Monday, September 18th. Here are the top market stories we're following for you at this hour. Next up, 100. We're going to speak to Mike Wirth, Chevron chairman and CEO, on triple-digit oil prices, strikes, and more. And the impact of that $100 oil prices could put a dent in the soft landing scenario. We get the take with Bruce Richards, Marathon Asset Management chairman and CEO. And no deal strike on day 4. The UAW rejects a 21% pay offer from Stellantis. We're going to speak to the Mercedes-Benz CEO on the state of the auto industry. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. That said, there's a lot of news flow, but I got to tell you, equity is going absolutely nowhere.
Yeah, but it doesn't matter, does it? It's all about oil today. You must have written those headlines with a spring in your step.
I really did.
Oil
I'm very excited.
is the number one story. Are we going to 100? Maybe. It's going to have an impact if we get there, certainly.
Yeah, absolutely. And also, if we're looking at a new range, 80 to 100 versus 60 to 80, which is maybe what talked about, say, 6 months ago, that also might be a little bit different. But different for who? Investors or the Fed?
Okay. Are we going to hear the words crack spread today?
Yes,
I'm just wondering how much jargon. I said it. You're not allowed to, okay? You are banned from the whole show from using any oil jargon, okay? That's the rule today. No oil jargon. I can do it. You can't.
Okay, fine.
That's fine. That's
you
where
just
we are.
can't say ESAF, okay?
Okay, I will find a way around of saying that. Sustainable aviation fuel is what she's talking about. So our question of the day is a fairly straightforward one. We've already alluded to it. Does $100 oil mean stagflation, not only for the US economy, but for the European economy, for the global economy? Let's bring in our panel to discuss. Manus Cranny, you can take the strudel out of his mouth, but you can't take OPEC out of his blood. And Liz McCormick, of course, on what is happening with the US economy. Manus now to be found on that side of the Atlantic rather than Liz. Manus, I'm going to start with you. As I say, you can take the strudel out of your mouth. You are an OPEC veteran. Are we going to 100? I use the word veteran in the nicest possible way.
It's fine.
Are we going to 100? Is that the direction of travel, and can we make it stick?
Markets, good morning, Guy. Good morning, Alex. It's lovely to be stateside. Markets like to test boundaries. They like to test the upper band, the lower band, and there's no doubt about it. The trajectory of the market, the hedge funds are as long as they've been. And this is going to be it. How quickly probably do you get to $100? And with what kind of volume and size? So in the first instance, I think everybody likes to try and test the market And I think that's what happens next. It's not about necessarily whether China emboldens the growth story, but you do have to have a base case of where you've hit peak pessimism on China to develop $100 oil.
And I should point out that he just gave you shade, Manus, because I always call Guy old, so this was like a moment where he could like move that shade somewhere else. So just know that that's part of our show.
Yeah, I can take you back 25 years. I worked with Guy Johnson 25 years ago.
Right. So
Shade.
this is part of the show. Liz, I won't do that to you, but I will say the Fed is completely going to say we don't look at oil prices, et cetera, et cetera. Is that actually true?
Right. But, you know, Chairman Powell has said a few times, like, why we care, because it goes into headline. They're more concerned with core, like you said. But he does say that what they have found is that headline, if it stays high, can bleed into inflation expectations. Because if you and I see higher gas prices from oil, we start to say, oh, boy, maybe inflation overall is going to be higher. So that's why they care a little bit. You know, they do look through that. But it's not like it doesn't matter at all to them. Yeah.
Liz, is this stagflation, though? Is that the direction of travel? We get to 100, is stagflation going to be the story? Because at that point, the soft landing becomes harder and harder.
Yeah, I mean, I think it depends. Like in Europe, there's already so much stagflation talk, right? So that's a different ballgame. But in the U.S., $100 plus, we were saying, could go to 110. It does not help. I mean, in this backdrop, too, on the economic side, like Alex was laying out, the auto worker strike, if that goes on every week, shaves off a little bit of economic growth. In Washington, we have the risk of a government shutdown, which if that goes on for a while, we haven't had it yet, but by October 1st, if they don't get together with these spending deals, that could slow growth. So that would not be ideal for the Fed. These things on the backdrop slowing growth, oil, headline inflation going up. I'm not sure it kills. I think the Fed is really, really wanting to pull off the soft landing, but that doesn't help their case for sure.
Hey, Manus, what do you think of $100 oil in terms of what the Saudis want? Like, I thought it was demand destruction triple digits.
Well, I think we go into a new, as we sat down and you were getting ready to come to I think our discussion was, well, we've got to discover where the new price destruction kicks in.
Yeah.
It may well have been in the depths of the pandemic or whatever, it may well have been at $80, $90. Here you are, you're going to test $100. I want to read to you what Halima Croft sent through just last week, and I like it because I think it gives it context. Completely unimaginable just a few months ago, striking or hyping distance today is $100 oil. The Saudis need fiscally 80 for a real comfort zone. The Emiratis are down at 40, 50 bucks. But for the big mega projects in Saudi Arabia, they need $100 oil. That's what Bloomberg Economics have run the numbers. Today, Prince Abdulaziz bin Salman speaks in Canada. It's going to be interesting to see what his tone is, where he pushes the market, because they took the heat out of the market by going for the extension on the unilateral cuts guy. And they took the heat out of the market by extending that through to December. So in many ways, we already know the shape of the supply constriction and the deficit construct.
And the Russians clearly want higher oil prices as well. That's in the mix there as well. Liz, we talk about what Saudi wants and the price that it wants. What about the United States? The United States is now a massive oil producer. The dollar is in so many ways a petrocurrency. Doesn't the U.S. benefit, therefore, in some shape or form from a higher oil price?
Yeah, absolutely, they do. I mean, you know, it's changed since decades ago. We won't talk about veterans of us anymore. but yeah, we do benefit. But on the flip side, you know, like we're on this cusp of could we get a soft landing? You know, for the consumer, like I was looking at gas prices, I'm like almost $4 again. But then again, it was at $5, right? You know what I mean? So it hasn't kind of get to the core yet. But yeah, oil prices rising will help many companies in the U.S. as well. But they're facing other headwinds too. The slowing consumer, even though we're doing okay, you know, you hear that even in the earnings calls, you know, people are trading down and sort of cheaper things. So, you know, I think it'll help, but it's like cross currents, and the U.S. market has other forces at play that are troubling, driving yields higher, and, you know, this doesn't help.
So, Guy, it's interesting you make that point, because you could argue that the administration would want 60 from the demand side, but you know what really helps when you have higher oil prices? EV car sales. So you have to wonder, like, how that kind of plays into the conversation, too, because that's really the impetus. Like, that's where you're going to get a shift. If you get higher gasoline prices that you just can't make, then you're going to go on and go buy an EV.
But you can't buy an EV because the UAW is on strike.
Oh, you can't. I mean, maybe a Tesla's.
And
they just discounted prices.
I'm joking. You can, but what it might ultimately mean, therefore, is if you've got more restricted supply, you've got higher prices for autos, which is another challenge on the inflation front. used auto prices have come down. Maybe they start going back up again in a meaningful way. That's what we saw in the pandemic. It was interesting. We were talking about this on Friday. During the pandemic, auto prices went sky high because you couldn't get new and you could barely get used. We know because you bought a car at a very elevated
Jasper,
price.
100%, yes.
You may have got a low yield, but you paid a high price for the car. And that's maybe the scenario we're going to end up with again here. And that could, again, just feed back into the inflationary story.
Yeah, and I have to wonder, too, and then you add on something like the consumer spending less because of the student loan debt issue, right, and having to pay more there. But there are all these things that we worry about that we've worried about for like a year, and there are always new things, but it doesn't seem to make a difference.
Right. In the stock market, I think Jess Benton had a great story saying everyone thought the stock market was going to do so bad this year, and people having to revise their forecast because it keeps going. That recession, what do they say, the best forecast recession that hasn't happened yet, being pushed into next year. So, yeah, maybe we surprised to the upside again.
The one thing that I would just throw in here is that we haven't touched on the petroleum reserve in the United States, which is at the lowest. We need to double check the fact, the lowest since the 80s. And herein lies the point. When there was so much vexation between the United States and OPEC in the latter part of the autumn of last year, in that bunker, they released press release after press release when Jake Sullivan came out. Here we are with this, the petroleum reserve here. It's at a low point. That instrument that the Americas had to bolster the gasoline prices that you talk about rising it's not destructive, but it's much less muscular than it was when they last clashed with one another. And they're not clashing to the same extent because geopolitics is now much more important to the Americans with the Saudis, with Iran in play, and Israel. Yeah. There's a whole conflux of geopolitics which reduces, and also the SPR, not necessarily as muscular as it was.
Oh my gosh, yeah, like non-existent. Guys, thanks a lot. This was really fun. Bloomberg's Liz McCormick, Amanda's Kearney, co-anchor of Bloomberg Brief. That's at 5 a.m. on New York time. Good to have you on this side. All right, coming up, more insight into the question of the day. Does $100 oil mean stagflation? Bruce Richards, Marathon Asset Management Chairman and CEO, joins us next. This is Bloomberg.
Okay, so you're moving in on me quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this, put it over here.
Not cool. Not cool. All right, I will concede. I can see you've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Wall Street is waking up. Europe is already trading. And starting today, Manus Cranny and Danny Berger will make sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, premiering today only on Bloomberg.
argued that the era of the great moderation of low inflation below 2% and stable growth is gone, and we're entering an area of what I call great stagflationary and financial instability.
That was Nouriel Roubini, the CEO of Roubini Macro Associates, speaking exclusively to Bloomberg TV earlier today. That kind of sets us up for the question of the day. Does $100 oil mean stagflation? And if anything, does it take the soft landing scenario off the table? Bruce Richards, Marathon Asset Management Chairman and CEO, joins us here. He braved the UNGA traffic that is erupting here in New York City. Hey, Bruce, what do you think? Does $100 oil disrupt it?
You know, short answer, no.
Okay.
But there's a yes part to it, too. And so here's the no. Growth here in the United States, well, first of all, stagflation is slow economic growth with inflation. And right now we have very strong economic growth. And what you're going to see is the third quarter, which is the quarter we're in now, which doesn't end until September 30th, will be reported in the third week of October. And it's going to come in, and people don't realize this, not a 2% GDP, not a 1% GDP, but a 3.5 to 4. And here's the reason why. Nominal GDP right now is growing around 6% GDP. We saw that in the prior quarters, and that will hold for the third quarter. But the deflator, the GDP deflator, is slowing to 2. And so it's unlike CPI, how it's calculated, and it's going to slow to 2. If you have 6% real minus that 2% deflator, you might get like a 3.5 to 4% print. And then what does the Fed do when they have November 1st, their next meeting? Obviously, they have a meeting this Wednesday, which they're going to hold and do nothing and say they're data dependent. But when they get that data set, late October, what do they do November 1st, their next meeting? And that is the $64 question. That's the big question for me. So here in the United States, growth has accelerated a bit. It feels relatively strong with inflation. So I'd say no here. But the yes part is just go across the pond to where Guy is, and you look at Europe, and the ECB is calculating for next year growth coming in at 0.8% after having raised rates to 4%. And so there, with inflation high and oil approaching 100, $95, but approaching 100, and Germany already probably toggling on recession right now, the answer is unequivocally stagflation for Europe, yes.
Just walk me through the impact, though, Bruce. And believe you me, we're already beginning to feel it. The energy story is going to rip through Europe in a way that it's definitely not in the United States. But I'm wondering what effect it is going to have on the United States. Is the effect that it slows the consumer down, $100 oil? What effect does $100 oil have on what is effectively a petrocurrency economy? You guys produce a lot of oil.
Yeah,
I'm just wondering whether $100 is a good or a bad thing.
Well, it's great for the energy companies, not so good for the consumers, of course. And the consumers, look, higher wages and higher yet, but higher wages is really good. And relatively full employment with higher wages is great for the consumer. And so looking back for the consumer, been great. But here's 3 things, and one of which you hit on. But first, related to consumer, first is that student loans for 27 million of the 152 million workers here in the United States, about 18% of our working population, have a student loan that they have to now service on October 1 that they haven't had to make a payment in 3.5 years. That's number 1. Number 2 is what you said, inflation. Inflation is still relatively high, and higher oil prices at the pump are going to hurt them. And number 3, of course, is the simple fact that all excess savings is now gone. And so all the huge COVID stimulus and huge COVID savings plan that we had among America is now been eaten away. And so the consumer looking forward looks to be vulnerable, and we're starting to see that in some of the delinquency rates going up and some of the credit card balances and borrowing rates going up.
I mean, you're the distressed debt guy, so this is like, yay, good time for you. What do you like? What are you buying? Where is there opportunity, really opportunity now?
Well, the biggest opportunity, I think, is in CRE. So the commercial real estate market, and Signature Bank, FDIC is holding an auction, as everyone knows. It's been in the public. FDIC released this information, $33 billion of loans. And here in New York, since we're New Yorkers, Alex, about 2/3 of that portfolio are multifamily loans, and they're selling it in 13 different parcels. We'll be bidding on that. And so there's lots of I think, product coming out of the banks, because I think Jamie Dimon's right. Don't buy the banks is a theme. And I think he's right, because it's not only the stricter regulations, but it's the higher, I think, loan loss provisions are going to go through with the higher rates. They're really impacting the consumer, businesses, and real estate. So number one is real estate, and number two are businesses. Do you know that 2/3 of the B3 rated companies can't service their debt without burning cash? And so the cash burn is real, and the number of downgrades is offsetting upgrades by a ratio of 2 to 1 at this point. And so we're starting to see more and more defaults coming through the system, Guy.
Bruce, let's just talk about kind of where we are in this process. If you had $1 in your pocket, you had $1 in your pocket, have you spent half of it? Have you spent 50 cents? Have you spent 25 cents? Have you spent 75 cents? I'm just kind of wondering, are the opportunities now, or are you waiting for better opportunities further down the road? How much have you deployed? How much are you going to deploy?
There's a lot of dry powder. Away from Marathon, there's about $1 trillion in dry powder in private equity, and there's hundreds of billions among the private credit managers that are going to be investing capital in the marketplace. So how much have we deployed? We have a lot of our book that we have in the markets now earning really nice cash flow. It's the highest return that we've made in a generation. Remember, Fed funds is the highest rate in 22 years. We haven't seen the Fed raise rates by 500 basis points or more in 40 years. And so it's the golden era of credit, because we're getting paid such high rates of return for making our investments. And so having said that, we always like to have dry powder to be able to deploy capital in the marketplace. And yes, we have our fair share of dry powder. So the numbers are in the billions, and we're very well poised to deploy that money when there's real dislocation in the marketplace. And the real dislocation hasn't quite happened yet, but it's in the process of happening, we believe.
What do you hate? What do you definitely avoid?
Office on 3rd Avenue.
Okay.
Top of the list. But there's a lot of CRE that's going to bust.
Yeah.
And the more you keep rates higher, the worse it's going to be. There are a lot of companies that are going through some type of structural decline. And there are other companies that, came up through the SPAC market or too early, got funded in the credit markets, but they're more venture-like, that don't really have earnings, and we avoid all that. And so what we like to look for are good operating businesses with good cash flow in place that just have high debt cost service. And, companies in the next few years are going to have a real issue, because they're going to pay a lot higher labor costs. You see that with the UAW. You see that in Hollywood. You see that with what the pilots negotiate with the airlines. The labor costs are increasing, and we love to see labor cost increases. It's good for America. It's good for Americans. It may not be good for corporate earnings. What's also not good for corporate earnings are these higher funding costs. Now, Apple and Microsoft are making more money off of the cash and the 5.5% rate that they earn on cash than the 2% rate that they pay on their bonds. And so while the rich companies are in really good shape in terms of debt service, it's the thousands of others of mid-sized companies that really represent the Russell 2000 that are going to be stressed. And so we're going to be there to help them, to provide capital solutions, to provide capital for good operating businesses that just need to make it through.
The big opportunities, the bulk of the opportunities still yet to arrive. That's an interesting line. Bruce, great stuff. Nice to see you. Thank you for braving the traffic for us. I hope the journey back is not too bad. All the way across town. Bruce Richards, Marathon Asset Management Chairman and CEO. Still ahead, we need to talk about Disney holding preliminary talks for its India streaming and television businesses. There's a cricket element to all of this, which is important. Details on that next. This is Bloomberg.
how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again? Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We will be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment cost agreement on which we could lead the charge of air travel into a post-war Ukrainian recovery.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
+7 on the West Coast. Time to go to the startup. Top tech stories from the Bay Area and beyond. Silicon Valley starting this morning. We're not actually going to do that today. We're going to talk about Disney. We're going to talk about what's happening with the business, which is about to change quite significantly. We're going to do it from New York. Technology co-host, Bloomberg Technology co-host Caroline Hyde has kindly joined us. Disney's about to change in quite a big way. ABC, India, these are seismic shifts.
Yeah, these are an asset shake-up, ultimately, where the signal that we've got to take away from Bob Iger is that he wants to focus more on the streaming, the future of parks, and move away from linear television and ultimately some of the asset burn that they've seen there. This really is trying to signal that, yes, we're looking at India, but Reliance Industries maybe having an appetite to get more into what is Disney Star, but maybe it's more Hotstar as well, the Disney Plus offering, the streaming offering. We've kind of seen it signaled since Bob Iger went out to Hong Kong back in July and sort of said, look, I'm not that happy with the way in which the assets in India are performing, particularly since they lost the rights to the IPL. I know this is a big one for you, Guy, the cricket. They haven't lost all of their cricket assets there, but they have been largely losing that key element of subscriber growth. But then twin that into the fact that we're thinking about whether or not they let go of ABC, the TV, the cable channels, some of the FX and National Geographic is something that Byron Allen is looking at. We know that Nexstar is as well. So there is a lot of reshuffling going on. And that's not even talking about Hulu and the option to buy the Comcast amount from there back in 2024.
So I've been in this industry for almost 17 years, and I have heard the death of linear TV since the day that I started. What's the level of confidence that people on the street have that something will actually get done?
I think KeyBank, for example, some strategists there were slightly worried by the signaling that they might be getting out of linear TV, because they say, well, what does that mean ultimately about the way in which this is disintegrated, the void, the hole that perhaps linear TV becomes, and what it means to the rest of the legacy assets that Disney might have. Yes, you're right. Ever since I got into it too, everyone's been trying to call the death of linear television. This is close to all of our bones right now, so it's an odd sort of story to be telling about. But the fact that Bob Iger is trying to signal that he wants to get out, I don't think really sounds that great.
Yeah, no, fair enough. All right, Caroline, thanks a lot. We can catch you at 12 o'clock with Ed Ludlow. Coming up here, Chevron CEO Mike Wirth joins us in studio for an exclusive interview. This is Bloomberg.
From the world of politics
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power in the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question. Best question I get all night.
Bloomberg. Top experts. Great questions.
We welcome now our Bloomberg TV and radio audiences. Today, we are focused on oil as Brent nears $95 a barrel. No better guest to discuss that with than Mike Wirth, Chevron chairman and CEO, joins us now. Mike, it's such a pleasure to see you. Thanks for joining.
Alex, it's good to be here.
Okay, $100 oil. Is that going to happen?
Sure looks like it. We're certainly moving in that direction. The momentum, supply is tightening. Inventories are drawing. These things happen gradually. You can see it building, and so I think the trends would suggest that we're certainly on our way. We're getting close.
Mike, good morning. It's Guy in London. What impact do you think $100 a barrel will have on the U.S. economy? What impact will it have on the global economy?
Well, certainly those are higher prices than we tend to see out over the long term, and so I think it will have some effect on the economy. But we've had relatively higher oil prices here now for most of this year and certainly all of last year. The recession that everyone's been talking about hasn't arrived, and so I think the underlying drivers of the economy in the U.S. and frankly globally remain pretty healthy. So I think it's a drag on the economy, but one that thus far I think the economy's been able to tolerate.
Have you adjusted your price deck? Meaning, that's my question, being like, are these higher prices sustainable for the long term?
Yeah, we take a very long-term view on supply, demand, policy, technology. We haven't changed our long-term price, but we really don't change that very often, and not in response to what our short-term. And we've been in a volatile market really going back to the pandemic when things came down, the recovery when it was high, the war. So this has been a period of time where prices have been unpredictable and volatile, and not what you would call mid-cycle.
Mike, if I worked for you, if I worked for Mike Wirth and I worked for Chevron, would this be my cue to say, Mike, can I have a pay rise, please?
Well, we're certainly seeing, I think you're making reference to what's going on in different parts of the world. We're seeing organized labor, in many different industries now, kind of assertively step forward and say, look, we want to be compensated. We see the inflation in the economy, and we've seen companies recover. We've had a very strong pay program last year for our employees. We try to stay very competitive, and I would expect we'll continue to do so.
That is Guy's way of getting into the strike action that's happening in Australia with Gorgon and Wheatstone. So far, cargoes have not yet been impacted. You're using some non-union workers, right? Is there a point where that would change?
Well, we certainly hope that what we'll see is a negotiated agreement. Others in Australia have reached agreement with these unions. We've been at the table bargaining in good faith, and that's our desired outcome. That said, when we face potential strikes anywhere in the world, we have to prepare to maintain operations. Our products are vital to the global economy and the flow of those commodities, particularly LNG, in a world, as we've seen last year, where it's important to keep economies going, not just in the region in Australasia, but also in Europe, that's our responsibility. And so we do prepare to maintain operations even during an industrial action. And thus far, we've been able to successfully do so in Australia.
Do you think if I'm sitting here in Europe, I should worry about what's happening here? Is this going to be a problem when we get to winter, do you think, Mike?
Well, last winter, Europe came through better than I think most thought, Guy. Now, inventories were high going into the winter because Russian gas had been flowing in. Industrial demand really came off, and then it was a relatively mild winter. We certainly can't count on all of those things happening again, but gas inventories in Europe are pretty strong right now relative to history. And so I would say Europe is set up much better than it was last year. The weather is always difficult to predict, but I feel like Europe is in about as good a place as it could hope to be at this point in time.
That's one of the weird things about looking at China growth, because obviously Europe wants China growth, but the energy sector probably doesn't want China growth if you're in Europe because of the demand pull. What are you noticing in China, whether it's LNG or oil demand pull?
Well, it's been gradual. It's been slower than people expected it to be, but it is coming back. And I think that's one of the reasons why you've seen crude oil prices tightening.
Is that inventory restocking, do you think, or is that end user demand?
It's always a little bit hard to tell. The data out of China isn't exactly as transparent as it is in other parts of the world, but I think it's probably indicative of an economy that is finding some traction and is moving forward. We're going to see record oil demand this year. All-time record demand, right up a couple million barrels a day versus the prior year. It'll grow again in the year ahead. And so as long as the global economy stays relatively healthy, demand for these products steadily marches forward.
Mike, you've mentioned inflation a couple of times already in the conversation. Are you still seeing inflation? Are you starting to see deflation in certain areas? What does the cost side of the equation look like?
Yeah, so we've certainly planned for inflation. What we're experiencing is consistent with how we laid out our budgets for this year. I wouldn't say we're seeing deflation anywhere in a meaningful way. We may be seeing disinflation, right? So a reduction in the rate of inflation. And it tends to be isolated to certain parts of our supply chain, certain geographies, a little bit more than something you would describe as widespread. I think wage pressure is pretty broadly distributed. Other things in our supply chains tend to be focused in areas where there's a lot of activity, like West Texas and the Permian Basin, which has seen a little more pressure than some other parts of the world.
Yeah, so to that point, can you increase, if you take U.S. shale for a second, the Permian, can you increase productivity enough to offset those costs when a lot of your spending in the next, say, 10 years will be in U.S. shale?
That is the big question right now that we're confronting as we're putting our plans together going forward. Thus far, that has been the case. And in fact, productivity at a time when we saw lower inflation was marching forward much faster than costs were, which is why we saw cost of production coming down. I think those are coming into more of a balance today. And I think the forward view, the question is, can you continue to move up that productivity ramp and offset inflation or not? I think it's early to say. The one thing that is sometimes not talked about in this discussion, we've seen a lot of productivity gains on drilling and completions. We're still only recovering about 10% of the molecules that are in place. If we can improve recoveries, that changes the entire economic equation in a very profound way. We're working hard on that. We expect to see recoveries improve over time. So it's another leg of that equation, which is not necessarily productivity on the activity, but it is on the recovery and the economic equation.
What is that? Is that 3+ mile laterals? Is it going to be just different types of enhanced oil recovery? Like, what's the super magic sauce for you?
Yeah, we're working on a lot of different things. We're certainly drilling
You're not
longer.
gonna tell me.
We're drilling longer laterals. We're working on different completion technology to create different fracture geometry so you can get more flow.
Does that all cost more money, though, to do, too?
It does. And so that's why you've got to evaluate the economics of this. We're working on chemicals that can enhance recovery in terms of the interaction right down at a molecular level. And all these things you have to pilot them in a lab, you have to pilot them in the field, you have to understand if you can scale them up and if they make economic sense. That's been the history of our industry. The technology tends to solve these things. We've got a lot of smart people in our company and in this industry, and a lot of incentive when you know where those molecules are to figure out how to get them to flow in a way that's economic.
I said to Alex this morning, Mike, that she wasn't allowed to use any technical jargon. I think you guys just about skirted around it in that part of the conversation. You were fine. You were fine. You get a pass on that one. Mike, you talk about the fact that you've got lots of smart people. Do you have lots of smart lawyers? One of the things that Alex and I were kicking around before we spoke to you this morning was what is happening with this California case and the fact that increasingly it looks like climate change is going to be litigated. Is litigation the right way of dealing with this?
In a word, no, it's not. Look, this is one of many such actions that we've seen over the years. Ironically, a number of them filed on behalf of people who have actually profited from and encouraged energy development. Climate change is a global issue. It calls for a coordinated global policy response, not piecemeal litigation that benefits attorneys and politicians. So we do have smart lawyers. We will deal with the lawsuits. But more importantly, we're working on finding ways to meet today's energy demand with energy that has less carbon intensity and still is affordable and reliable for the economy, even as we're investing in new technologies like renewable fuels and hydrogen and carbon capture to build a new energy system over time that is inherently lower carbon. That's a constructive approach. That's where we're engaged. That's where most of my attention is focused.
Okay, so to this point, you guys are going to become majority owner in what could be the world's largest hydrogen production and storage facility. There's that. You do have a huge carbon capture facility next to Gorgon in Australia, et cetera. These things are huge and they're expensive, and some have been around for a while. Hydrogen, though, is new. How do you know how much CapEx to realistically allocate before you're like, this is too big and it's a money suck? How do you see this playing out?
Well, it requires a lot of judgment. You have to spend time. You have to really select. There are many opportunities out there. There's a lot
so why hydrogen, for example?
There are a lot of places you could invest in hydrogen. You can invest in blue hydrogen. You can invest in green hydrogen. There's different carbon intensities. There's different technology pathways. We've got an entire organization that spends all its time working on the technical, the commercial, the practical engineering realities of these things, and looks to find the best places to start. Certainly in the U.S., we've seen some policy through the IRA, which creates incentives. Those aren't intended to last forever, but they can help prime the pump as we bring the technology costs down. The project you referenced is a project in Utah, which is actually very economic today. We'll take surplus renewable power that comes primarily from wind in the western U.S., and when it's more than the grid needs, which happens during certain times of the day, we can use that to convert water into hydrogen. We'll store the hydrogen in underground caverns, and then at other times of the day when you want to bring that power back, we can bring the hydrogen out of the caverns. It can be put into a gas-fired power plant along with natural gas to produce lower carbon electricity. So it's an example of something that's technically feasible. The economics and contract terms on it give us a return on our investment, and it's a platform from which we can then grow.
So great to see you, Mike. We could go on forever, but we have to leave it there. You're also a busy man. Mike Wirth, Chevron Chairman and CEO, thank you so much. All right, we are about an hour into U.S. trading sessions. Honestly, stocks are doing nothing. Abigail's tracking the moves. Abby?
Yeah, it's not just stocks. Take a look at this board. Really no movement here on this Monday. A quiet Monday. Stocks down slightly, fluctuating all around the map, really, but on small moves and also on below average volume. The Bloomberg Dollar Index doing the same thing after its big gain recently, just sort of holding pat here. You can see yields not doing all that much. Earlier they had been higher, now about flat. This is interesting though. We do have the VIX up a little bit now at a 14 handle. The fact that you have the S&P 500 down, not a commensurate amount, may suggest that some more volatility is ahead for stocks. Now, very appropriate for the conversation that you all were just having with Mike Wirth. And the question of the day, let's take a look at one asset class that is moving. That, of course, is oil. Over the last 3 days, this is the 3-day chart above $90 a barrel over this time period, up 3.8% at almost $92 a barrel. Now, the question of the day, of course, begs the question of whether or not we do get to 100. Let's take a look at the technicals. And I was expecting it very firmly to say, yes, we're going to 100. However, when I charted it out, it's not quite as clear. And I say that because you can see this year over last year from the peak, there is this perfect descending trend channel, which we are hitting up on right now. Now, this bluish area, that tells you the buyers are very strong. They want to take oil to 103, 105, somewhere in there. But if they can't get it above, let's say, just basically $92, $93, we could actually see oil move back down in that range. It would be surprising to me, but this chart certainly makes the possibility that we may not even see oil hit $100 in the near term.
Well, that kind of undermines our question of the day, but Abigail, okay, that's fine.
We'll go with it. It's
Abigail,
fine.
Doolittle. Yeah, we'll go with it. The momentum seems to be there at the moment. You never know. Okay, what are we going to talk about next? The UAW, the United Auto Workers strike, entering its 4th day. Both sides are very much digging in at this stage. What's going to break this strike? We will find out next. The latest. This is Bloomberg.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. What's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
City.
London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside? Day 4 of the UAW strike. The United Auto Workers and U.S. automakers appear to remain far apart from reaching a deal. Here with the latest, Bloomberg's Detroit bureau chief David Welch. The latest is Stellantis rejecting that, offering that 21% pay rise. The UAW says no. What's next?
22? We'll see.
Fair enough.
Look, I thought this deal would get done somewhere around 20%. That would be what the union wants. But there are other demands on the table, right? This 32-hour work week, which I don't think they'll get. Retiree benefits, a pension. I don't think they'll get those, but they do want cost of living allowance, which is, kind of adds to their raise, gives them inflation protection. Maybe I think the companies are going to need to improve the formula. They've already kind of decided that they need to offer what they call COLA again. It's just how do you calculate it? And I think that's where they will go back and forth. It'll probably have to be a bigger raise. And then there are other issues. GM's the only one so far that has really absolutely guaranteed employment throughout the life of this contract. And I think Ford's probably there too. The union, there was some kind of tit for tat over the weekend on whether or not there were guaranteed jobs at this plant in Belvidere, Illinois. That's a sticking point. But they're going to need job security guarantees as well. The big question will be, what do they do for the retirees? That I think determines whether this is a very long strike or just another week or so.
Interesting.
David, there does seem to be this sense that we're just negotiating. It's going to get done. Don't worry, a deal will get sorted out. Is there a danger that A, the companies, and B, the financial markets are underestimating just how angry the unions really are?
Look, I think everybody already has. The financial markets have built in a big discount that's in the shares already. That's why when the union does something, when they refuse an offer, you don't see the shares get hit by very much because the market was already there. But I do think the companies themselves also may have, they didn't know Sean Fain, the new UAW president, very well. So it was hard to get a read on how he was going to handle this, and he's done this. All of this has been done in a very different way, and I think that's caught them by surprise, and the market doesn't know exactly how to read it. So look, this could go on for a while. The one thing I will say, though, that maybe a bit positive, over the weekend, we did see them unions saying that there was progress made at Ford, and they said that they had a decent meeting, I think, with GM yesterday, and they were going to reconvene with Ford and Stellantis today. Those were more positive things than we've heard. Usually whenever there were meetings or offers, Sean Fain would go on Facebook Live and say how terrible the offers were, and how they weren't respecting the work that the members do. So it maybe an absence of negativity tells us that there might be a bit of a pivot here in progress for talks.
We're going to watch this space very carefully, and you're going to help us do that. David, thank you very much indeed. We're going to dig more deeply into this topic in the next hour. Ola Halanus is the Mercedes-Benz CEO. We're going to be speaking to him, as I say, in the next hour. Looking forward to that conversation. Coming up in this hour, we are going to gauge investor appetite for Instacart's long-awaited IPO. That's in today's Wall Street Beat. Shanali is coming next. This is Bloomberg.
Do you think there's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea. But technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
Beat. We take a look at what's buzzing on Wall Street and the world of banking and finance around the world, and we're taking a look at Instacart's upcoming IPO. Joining us now, Bloomberg's Shanali Basak. If I'm a banker on the Instacart IPO and I'm looking at ARM today, am I nervous?
It's so funny that you say that, because it's the first thing I did before I got on this segment, is seeing how far down it's going. And it's interesting, you have ARM now trading at $57 a share. It was above 60. Listen, I think the name of the game for the bankers in town, as well as the companies, is this idea that these IPOs will not be high flyers. They will have to be smooth sailors. They have to make it into market smoothly. We know that at the top end of the range, it could be worth more than $9 billion in market value. There's an interesting footnote here, this idea that cornerstone investors, D1, a division of Norges Bank, could take up to 60% 20% of the shares. So you have some embedded demand, but getting this onto market smoothly after already upsizing here or increasing the price range for both Instacart and Klaviyo will be an interesting thing before Fed Day, when both of these things are supposed to start trading ahead of.
Yeah, Shonali, it's taken a long time to get Instacart to market. We've been talking about it for many, many, many years. Is this as good as it gets, though?
Great question, because you have ARM, Instacart, Klaviyo all in a row. Instacart has been able to make themselves profitable. There's a very small window to go public this year. When we speak to bankers across Wall Street, they say that the pipeline is building into next year, and you have a lot of companies saying that they want to front load and go public in the first quarter of next year. Remember, we have the elections next year, a lot of potentially volatile events for the market. So yes, it does give a sense of, okay, maybe you're not going to get the $13 billion valuation that Instacart had last year, but a $10 billion valuation, more realistic, as well as a lot of retail interest. Remember how many retail investors were pouring into ARM stock immediately. Speaking of retail investors, remember SoFi is one of the underwriters, the first ever underwriting mandate it's ever had on an IPO in the Instacart instance. So bringing more people into the stock tends to be good for marketing. It gives you stock as currency. These companies want to go public, especially because the M&A route has dried up so much as well.
I guess I'm just having a really hard time understanding the actual proposition, the value proposition for Instacart. Like, when you have grocery stores can just build out their own infrastructure if they want, and the margins are so super thin anyway. And I'm wondering what you talk to bankers about in terms of that part of the story.
Yeah, the margin part is a fascinating one, because on one hand, you have Instacart and Klaviyo in a row. Klaviyo is a very clear AI story. Instacart, they are trying to show you that they can do more with their technology and data and really win on that in terms of bringing on customers. Hence, Pepsi being an initial investor here into the IPO helps give some idea here that their own clients buy that story, that they can keep on continuing on and expand that share. But your point is very well taken. That margin pressure and the fact that there are others that do this is a big question mark when it comes to Instacart. The newer CEO has been able to improve returns clearly, but can she sustain that? That's the post-IPO story, and that's the more important story than the day itself.
It's amazing, isn't it? That process we often think about as being a one-day event. Got to keep going. Shonali, great stuff. Thank you very much indeed. Let's talk about the European markets as we head towards the end of the day this Monday. This week is a bit of a slow burn, to be honest. We really get going, obviously, with the central banks a little later on this week. The data begins to kick in as well. But actually, a little bit of price action to begin the week. A little softness into the European equity markets. Every single sector is in negative territory today. Some of the consumer names are the weakest. Some of the housing names, some of the luxury names softening up today. The market broadly down by 1.22%. Flattish for the euro. Again, I think we're waiting, we're watching, we're going to see what's going to happen here. Obviously, we've got the Fed coming up, plus there's a whole load of data to digest. So euro dollar flat but below 107. 106.72 is where we're trading. The main event, dare I say it, I hate to say it, is what is happening with Brent crude. We're up again. We're up by 0.9%. We're kind of flirting with 95. Are we going to 100? That's the key question. What impact will that have? We'll come back to our question of the day in just a moment. We get to 100, do we get stagflation? We're going to also talk about what's happening in the car sector. European luxury names. What happens with China? What happens with the United States? What happens with Labour? Ola Halenus is the Mercedes-Benz CEO. He's going to join us in the next hour. This is Bloomberg.
Okay, so you're moving in on me. Quick. Distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right, I will concede. I can see. Got me beat.
Very good game. Well played.
Thank you, sir. Thank you. On the next episode of Hello World, meet the women driving Kyrgyzstan's tech revolution.
This is the first satellite in our country.
And some speedy horses. Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on Bloomberg TV.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Monday, the 18th of September. European equities are a bit soft today, and actually volume's a bit light. It's a big week. It doesn't really get going this week, though, until the Fed and the Bank of England and some of the data we're going to get. But nevertheless, the market certainly feels like it's starting off on the equity front a little cautious. We're down by 1.5% in Paris. The DAX is down by 1%. FTSE's a little better, down by 0.7%. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Let's talk about these markets, figure out what is happening here. Stock 600 down by around 1.2%. Banks are a feature. SocGen, the update, the new management, didn't go well. Really didn't go well. Disappointment. Expectations significantly higher. They've underwhelmed. You do not want to underwhelm in this kind of a position. That's the factor that's weighing on the Paris market today. There are a few positive signs out there. Ocado's got a very nice upgrade. That's certainly helping out that stock. So there are single stocks that are on the move, but broadly stocks are lower. Euro dollar is flat. We're waiting. We're going to wait for midweek, I think, before we get some movement there. But the story, as I say, which is bolstering the oil sector, but it's still not enough to push it back into positive territory, is Brent crude. It is up by 0.7%. Are we going to $100 a barrel?
So oil is so exciting that Guy and I both have it in our board. That's how cool it is. I jest. But the Saudi oil minister, I should point out, was speaking in Calgary just a moment ago. He says, look, we're targeting volatility, not the oil price. Okay, all right, we'll see if we get towards 100. The S&P, literally nothing to see here. Stocks are doing absolutely nothing. Individually, though, ARM is down by 5%. Bernstein downgrading the company, warning on its growth outlook. And I did, it IPO'd at 51. Still above that, but just headed into Klaviyo and Instacart and potential IPOs this week. This is where the price action, I think, becomes quite interesting. S&P Energy Index, the best performer within the non-moving S&P, up 1%. And of course, that is the oil price, as we keep hearing about the divergence between oil stocks and oil price, particularly over in Europe, just huge. And that discount actually has to close.
It's going to be fascinating to see exactly if we do get to 100, how it changes the narrative here. Governments are also paying attention to this, and they are beneficiaries in all of this process as well. Competing currents in oil. This was Abigail's chart from a little bit earlier on. It was so good I've decided to steal it and bring it to you once again. Oh, yeah. I think it's a huge compliment to Abigail. Fantastic chart. You can see the channels we've been in. We've had this wedge formation. I'm going to try and do my best, Abigail, on what is happening with charts here. We've broken out to the upside, but you've got this channel which exists at the top end. I hope I'm describing it correctly, which we're at right now. So her view is maybe, just maybe, we bounce off that and come back down again. But if I was looking at the momentum that we have in the oil price right now, Alex, $100 a barrel? Maybe not for long, but maybe we'll get there.
Yeah, we spoke with Mike Wirth, the Chevron chairman and CEO, earlier in the last hour about $100 oil.
The momentum, supply is tightening, inventories are drawing. These things happen gradually. You can see it building, and so I think the trends would suggest that we're certainly on our way. We're getting close.
Question of the day, fairly straightforward one. What economic impact will $100 a barrel deliver, both for the European economy and the US economy? Does it mean stagflation? I think Europe is already, to a certain extent, already experiencing the rollout of that process. Will the United States ultimately follow it? Does it take a soft landing off the table? Julian Lee, Eddie van der Walt joining us now to discuss here in London. Julian, I'm going to start with you. Are we going to get there?
I think we might well do. It may not last, but we're seeing more and more analysts coming out and saying, $100 a barrel is looking more likely. They were all saying this at the start of the year. By the middle of the year, there was virtually nobody forecasting $100 a barrel. Now we're starting to hear them say, we may get there, but it won't last, or it probably won't last.
Well, even Citi is saying that. They're like, look, we're going to have ex-OPEC supply coming on, and then you're going to get lower oil prices. Eddie, though, what say you? Are we in a new range for oil? Let's say 80 to 100. What does that do for the stagflation thesis then?
Well, it changes the narrative substantially, right? Throughout this year, oil prices were below where they were a year prior, right? So for most of this year, oil and energy more broadly, diesel and all the derivatives from oil, had created a disinflationary force in the world economy. Now that's changed around. Even if you just sit at these levels, right, you're not having that disinflationary force, which means that the rest of the basket of goods that you look at needs to do so much more work.
Yep.
And sure, okay, this doesn't impact core, except that it does, because the reason we don't include oil prices in core is because we'd effectively be double counting it, right? Because people will be paying more to drive things around, right? So you'll be paying more for goods and services and then adding it to the core basket. So it will impact on all levels the economy. And I do think that it's at the same time it's a tax on spending. So it's a stagflationary force.
Differentiate the picture between Europe and the United States, because it feels different. The consumer feels in much better shape over there, more able to tolerate that higher oil price. Now there's a number of other factors coming together, like student loans, which may exacerbate the situation. But here in Europe, it already feels like we are kind of heading in that direction.
Right, and I think that is a big difference. But I think that's a potential downside for the US almost, right? Because I think we're almost accepting that we are going to hit a stagflationary environment, definitely in the UK, probably in Europe, right? For the US, all the upside is still priced, right? For the US, it's still ignoring all of this stagflationary risk, the risk of a secondary wave of inflation just at the time when growth is slowing. So I think there is probably more downside left to price in the US, or stagflationary realities to be priced in the US, which it isn't just yet.
Yeah, 100%. You just have to wonder, though, how long we stay here, and if it's a new range, is that different than the high price? So, Julian, do you agree? Like, are we in a new range of 80 to 100, and is that enough to kind of squeeze the consumer even more?
We certainly seem to be in that range at the moment. I mean, I think, Saudi policy is really what's driving this. They have decided, and they can dress it up in terms of market stability or whatever, but they have decided that the oil prices that we were seeing a month or two ago were too low for comfort for them. They have been prepared to sacrifice volume to boost the price. And as long as they're prepared to do that, then they can underpin this price range of 80 to 100 or 85 to 100, whatever it turns out. And they are showing signs at the moment that they are prepared to extend this production ceiling of about 9 million barrels a day. I mean, this is the lowest they've been pumping for many, many years outside of the COVID shock that they had and that very brief impact of the attack on their oil facilities. But they are showing that they're prepared to cut production in order to boost prices. And consumers are paying the price for that. And of course, the big winner out of this is Moscow.
And to a certain extent, the United States. Alex, this is the thing that I'm trying to figure out as well. The US consumer is going to suffer as a result of a higher oil price. It is a tax. You guys feel it much faster. There is less tax on a gallon of oil, a gallon of gasoline over there. But the US is still a massive producer of oil. And the effect must be, therefore, that much less on you guys than it is on us.
Well, if you look at it from a producer point of view, and Mike Wirth was talking about this, a lot of the inflation costs that you still see in oil production is in the Permian. It is in the U.S. because there's so much activity there. So oil price in some ways does need to be higher because it costs so much more to get a barrel out of the ground. Exporting it, though, sure, that would probably, you'd make a lot more. But again, and those local prices are going to be significant as well. What do you actually make for a barrel of oil in the Permian? We have lost your mic. This is basically the equivalent of a big hook that comes and takes Guy off the stage. Anyway, much more conversation on that coming up. Guys, thank you so much for joining me. Really appreciate it. Bloomberg oil strategist Julian Lee and Eddie Vanderwalt from our MLive team. But oil staying sticky. Brent around $94 a barrel, staying sticky at that higher level. All right, coming up, Chinese car makers are under scrutiny in Europe. We're going to break that down with Mercedes-Benz CEO. That's coming up next. Don't miss it. This is Bloomberg. And as we head to break, German Foreign Minister spoke to our own Anne-Marie Horder on the sidelines of the UN General Assembly about the EU's relationship with China.
And so being a partner in climate issues, being a competitor, obviously, with China with new technology, but also seeing that we are systematic rivals and we have to protect our own vulnerability. And this is where von der Leyen comes in, the Commission President, to strengthen our critical infrastructure in Europe, but also looking at outbound investment screenings.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We will be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment cost agreement on which we could lead the charge of air travel into a post-war Ukrainian recovery.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I found myself in a spot where I was constantly getting new challenges. A lot of, I think, the best mentorship I had at Bridgewater is because people often saw in me the potential to do things I didn't even see in myself yet.
We welcome now our Bloomberg radio and television audiences to a fantastic conversation with Ola Halanus. He is the Mercedes-Benz CEO. He joins us in New York, as does, of course, Bloomberg's Matt Miller. Ola, great to see you. Thank you very much indeed for taking some time to drop by and see us here at Bloomberg. Ola, the story we've been talking about over the last few days has been all about China. We're trying to work out whether Europe is going to start a fire with China that is going to impact Mercedes-Benz. There's talk of tariffs. There's talk of trade wars around autos and EVs. Are you worried?
Well, it's great to be with you this morning, Guy. No, we're not fundamentally worried. We have a very strong business in China that has grown significantly over the last 10 years, and we're continuing to invest in China to make sure that we bring the product that the Chinese customers are expecting from us. I think it's important in these types of discussions to not forget what has made us so successful over the last decades. It's been opening up markets, free trade, free competition, but also a level playing field. So as long as all of those frameworks are in place to make sure that we can do business in a sensible way, we're not worried.
Well, we have, though, Ola, an EU inquiry into Chinese car imports. Don't you expect Beijing to react with countermeasures?
We will see how this plays out and what comes out of that. And we like to remind people that open markets is what drives growth and also drives wealth creation. In fact, if you look at the history of our company, it didn't take Gottlieb Daimler more than 15 years to figure out that Germany is not the only attractive market in the world, and we've been here in the United States for more than 120 years now. So that companies go global and that competition goes global, I think that's natural. We had the Japanese come to the United States in the 80s and the 90s, then the Koreans, then Tesla came now when we're going into electrification. So let's keep markets open, let the market participants fight it out.
Annalena Baerbock, the German foreign minister, was speaking to our good friend and colleague Anne-Marie Hordern a little bit earlier on, Ola. She was saying that there's a risk that Europe is too exposed to China, that we need to be cautious in our approach to China. Do you think that European, German luxury car makers are, though, at risk of being overexposed to China, that that market has become too big for you and that politics could get in the way? How do you think about it when you get warnings like that from German ministers?
On the one hand, I think we learned a thing in the pandemic, that supply chains can be fragile. And to create some optionality and more resilience into your supply chains is generally a good thing for businesses. This is something that we have already started, especially on battery materials, where we have devised a strategy where we're going to try to, as best as we can over the next years, go into a kind of region for region sourcing. So yes, we do look at different commodities to make sure that our supply chain is resilient. But it would be a complete illusion to think that we can divide the world, the automotive world, into individual regions that have nothing to do with each other. These supply chains, or supply networks rather, are much too sophisticated. There are 5 continents in every Mercedes that is being sold. And that is the strength of market economy, that the invisible hand of the market figures out what the economic optimum is. So supply chain resilience, yes, but keeping the markets open and the market working, I think, is even more important.
You have a strike going on here in the U.S. Well, not you. The UAW is striking on Ford, GM, and Stellantis. You have production here in the U.S. Doesn't have UAW workers, but you still got to be prepared for supply chain issues due to the strike. What are you expecting now, and how do you expect it to affect your business?
We don't expect any major impact on our business. And of course, Mercedes-Benz doing business in more than 150 countries and have operations in all major economic regions. We try to make sure that we're competitive, that we're an attractive employer. But at the same time, we're in transformation. The auto industry is getting more competitive, not less competitive. So whatever pressures we have on cost is going to have to be made up in productivity. So I think we have to be very mindful to keep the gain on productivity up and make sure that we don't have costs that run out of control.
But don't you expect, Ola, if they get a 20-25% increase at UAW plants, you're going to have to raise your price, your pay at some point in Tuscaloosa as well. Otherwise, you're going to lose workers to plants up north.
We have been in the United States, in the southeast of the United States, with our plant in Alabama, and also our commercial van operation in South Carolina now for, in Alabama, more than 25 years, almost 30 years. And we have always kept lockstep with what's going on in the economy to make sure that we have attractive jobs. So we watch that and we make adjustments as we go along. But at the same time, we look at, how can we do things better? How can we do work in a smarter way, get leaner, because the cost competition is not going to go anywhere.
Ola, do you think that companies such as yourself, companies like Stellantis and Ford, should be guaranteeing that workers that are working on combustion engines will have a place in the new EV world? Should they be guaranteed jobs? Should they be carried through this transition process?
I cannot speak for other automakers, but if I look at what's happening at Mercedes-Benz around the world, and primarily in Germany, where we have most of our operations, yes, we're investing heavily into the new technologies. The lion's share of our capital allocation goes into electrification and digitalization, and we're creating new jobs there. But the fact of the matter, on the powertrain side of things, the net at the end of this transition, which is a 10-year plus affair, is going to be less jobs on powertrain. On vehicle assembly, it's about the same, but we will use demography over this 10-year plus period, our demographics, to make sure that we can get into a position where we do this in a sensible way.
Ola, I drove recently the EQS. It's an Euro electric SUV. Obviously a very luxurious product as you move even more upscale. At the same time, the Tesla Model X and Model S are getting kind of long in the tooth. If you have lost customers to Elon Musk, are you gaining them back with this new push into luxury electrics?
What we have seen with the EQS and the EQE, both on the sedans and the SUVs, and here you have some extremely high-tech, luxurious products. We didn't make carbon copies of our combustion equivalents, but really tried to create a complementary offering. And yes, we have a lot of conquest customers coming into those vehicles. People that maybe didn't look at Mercedes before, that goes like, wow, Mercedes is going electric. This is interesting for me. So far that plan is working out quite well.
Matt, I have to say, you got a big smile on your face. You look like you're enjoying driving that car. Is it as good as a nice engine? Are you a convert yet? I've been tracking Matt's history as he's worked his way through this process.
You know what?
I'm wondering if we're there yet.
This is the one electric vehicle that may be able to win me over because of the pedal feel, because of, I hate to say it, I don't want to get flamed, but the fake sound, which I absolutely loved. It really felt like a big block more than an EV. And Ola, are you going for that? I mean, are you trying to make these electric vehicles feel like the luxury V8s that we long for?
Of course, there's a different sound profile, but the way a car drives and rides, what you expect from a Mercedes, the safety, the quality, how everything just feels right. That is true for an electric vehicle as it is for a combustion vehicle. But for you, Matt, I got a special coming up next year. I know you're a big fan of the G-Wagon, the G-Class, and next year we're going to have an electric G. It's going to blow you away, promise.
I am absolutely looking forward to that. As you know, I have had the V8 version, so I'll see what the EV version is like.
This is a high bar we're talking about here, Ola, so I hope you know what you're doing here. That's a big promise for Matt. Final quick question. Champagne sales are beginning to falter. Luxury goods companies like Richemont are talking about the idea that even upper-end consumers are beginning to feel the inflationary effects. Is that going to be a challenge for you as well? Are you in that kind of bracket? Are you going to be affected by those same forces?
Our top-end vehicle sales for the first 6 months of this year were very strong. But at the same time, you have to watch the macro picture. In North America and in Europe, we have higher interest rates. Those higher interest rates are probably going to stick around for a while. That affects the pricing of capital goods in terms of financing and leasing, and that's about 50% of our transactions. So we have taken a cautious view on the macroeconomic side. That is why we have guided for vehicle sales at around the same level this year as last year.
Ola, great to see you. Thanks for stopping by to see us. We really appreciate it. I know Matt's looking forward to that. Is it G-Wagon next year? I'm very excited. I've heard him talking about it. So this is a big moment. Ola Halanus, the Mercedes-Benz CEO, and of course, Bloomberg's Matt Miller. This is Bloomberg.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready? Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stenivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
You were just talking to Ola about one of my favorite stories, and that is apparently the bubbly. LVMH has warned that there is champagne demand softening.
You've been drinking some of it.
Yeah, right. That was what I did in the last block. So this struck me because it's a joke that like whatever I'm doing, you should be shorting, and if I'm not doing something, you should be buying. And I hardly drink anymore versus my healthy champagne habit pre-COVID. So I feel like I am a good barometer of these not awesome champagne sales.
So what do? Do you downgrade? Is this good for the Prosecco markets?
Probably.
But it does speak. It speaks more widely, though, doesn't it? People are clearly having to downgrade their lifestyle expectations. You're hearing it from Ola. You've heard it from Richemont recently. Even the upper end of the income brackets are starting to feel the pinch. And champagne is probably the most obvious kind of way of viewing this.
Caveat. The caveat is that nightclub demand. No, nightclub and beach demand for champagne is still totally rocking. This is definitely I'm no longer drinking champagne alone in my house scenario.
Was that a thing?
No. No. I was definitely with my 5-year-old, so that was definitely not it. But I think that's interesting. It's still the experience, but you're going out, not staying at home.
Yeah, it'll be interesting after the summer. Once all of this kind of revenge is over, are we going to continue to see this happening? The luxury sector is one of the areas of weakness for European equities today. Right down there at the bottom, continues to be an area of concern. It's come back a little bit over the last few days. European equity markets are soft going into the close. The close is next. This is Bloomberg.
do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. What's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
From New York City.
From London, in Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
Monday, a little soft. It's a busy week, but it really only gets going later on this week. Volume's quite light, so maybe the price signal isn't that good. We've come through, cautious start, but you do wonder whether there's a little bit of positioning in the element in the story that we're seeing here and the elements that are contributing to it. Some of the UK house builders are a little soft today. The consumer definitely is a little soft today, the consumer side of the story. You're also seeing the banks a little weaker. We'll talk about SocGen in more detail a little bit later on in the show. So that's the picture. France is down by 1.5. London's a little better, only down by 0.8%, but the traffic has really been one way today. We're down by 1.2%. We're still in a very sort of narrow range. Europe's been in this range for longer than the US, but even the US market's starting to feel a little bit range bound. But it's certainly true of the narrative over here. So down by 1.2%. Single stocks, let's focus on them. Just talk through what exactly is happening here. Not exactly the the start that the new management team over at SocGen would have hoped for. The stock is down by 12.47%. This is the new strategy update for SocGen. Where are we going? How do we be profitable? What are our targets? Didn't go down well. Look at the market, significantly underwhelmed. Ocado with a nice upgrade today. That stock responding quite positively as well. It's an Instacart kind of element around all of this as well, which I think is interesting. And Nordic Semi downgrading forecast. Look at how you get punished if you don't deliver. Look at how much you get punished if you don't deliver on those high expectations that have been set for you. Nordic Semi is a classic case in point. The stock is down by 10% today. So that's Monday. As I say, the week really starts to get, I think Wednesday the week really starts to get going. But tomorrow, we've got a whole bunch of stuff that we're going to be focusing on as well. We've got an interview with this guy, the German finance minister, Mr. Lindner, tomorrow. Future of Finance Conference. That is where that is going to take place with Anna Edwards. You've got the IPEM conference taking place in Paris. You've got Kingfisher out with earnings. You've got UNGA destroying the traffic situation over in New York. And you've got EU CPI. I think that probably is the story that everybody in New York is focusing on. But you've got EU CPI. I think that's a later read. But the story, Alex, really gets going Wednesday. You've got UK CPI, we've then got the Bank of England. Of course, we've got the Fed to think about as well. We've got the BOJ. So the first couple of days, Monday, Tuesday, I think are a little bit quiet. Wednesday, Thursday, Friday are going to be huge this week.
Yeah, and to be fair, you probably can't trade very well because you can't get to your desk because of UNGA. So it is all interrelated. Okay, meanwhile, Nouriel Roubini, CEO of Roubini Macro Associates, talked earlier to Bloomberg Television about what the BOE should do.
The problem is that the Bank of England right now is sending sort of dovish signal in a situation in which the policy rates are well above the Fed, but inflation is well above the United States. So what they should be doing is actually hiking rates all the way to at least 5.75. The signals are telling us right now is they're not sure whether they want even to hike more. If that happens, there could be a de-anchoring of inflation expectation. You could have a true stagflation.
So he's saying go to 5.75%. Annika Trion is chief economist over at Van Lanschot Kempen joins us now. Annika, I know we do this as a day ahead, but really if the main event's going to be the Fed and the BOE and the BOJ, well, do you think the BOE would go to 5.75, and if not, pure stagflation?
Well, I think the issue is we've come from an era where all central banks were quite synchronized. So, inflation paths were relatively similar, rate paths were relatively similar, and it's now being all unwound from each other. And I think this week is fascinating because the Bank of Japan is in a completely different place. It's still at negative rates. The Fed has accomplished quite a lot on the inflation fight, and the UK hasn't. So, to be specific to your question, we believe the Bank of England still has serious work to be done, more than the ECB and definitely more than the Fed. So more than one hike to go there.
Annika, how much more serious? How far do we go? How far does the Bank of England need to go? And how big a risk is there we get a policy error that actually tips the economy into what could have been a mild recession but could end up being a serious recession?
Well, it all stems on one thing, and that is this 2% inflation target. This target has come about, and this target is giving us a lot of troubles all over the place, including the UK. Why? Because if we are saying that 2% is the correct level of inflation, and if core inflation is significantly above there, which it is in the UK, but it also is in the US, it's very difficult for central banks to argue that they should just stop raising rates. At the same time, if you look at the real economy and look at structural things that are happening, which means structurally higher inflation for longer, whether it's the UK, whether it's the US, it seems strange to destroy the whole economy for the sake of this 2% number.
Longer term, though, if we get inflation expectations unanchored, isn't that the counter argument?
Yeah, obviously inflation expectations are key, but I think what people are looking at, whether you're talking about consumers or businesses, is price discovery. So if the world gets accustomed to an inflation rate of around 3%, I think we can manage. I think we can get over it. And look at how strong consumer spending is held up thus far. After very high inflation numbers, we get used to it.
The problem with all of this is, are we getting to the point where actually governments rather than central banks are where the challenge really lies? You've got big deficits, that's going to be a problem in the United States, which could end up pushing yields kind of around more than maybe central banks do. Here in the UK, there's structural issues that the Bank of England really can't deal with. Is the right tool now interest rates? Or actually, is it something that governments, the Treasury, should be focusing on, dealing with some of these structural issues, rather than relying on the central bank to fight the battle?
Mm-hmm. I think it's a really good question. You've got to imagine it, as a big table. And on one side of the table, you've got monetary policy, central banks. On the other side of the table, you've got government's fiscal policy. The first issue is that the two sides of the table are contradicting each other. So the central bank's monetary policy is being very, very sharply restrictive, but the fiscal policy is very accommodative. So one side is putting extra cash in consumers' wallets, arguably, and the other side is pulling it out again. So that's strange. And the other part, to your point, there's structural things going on. Look at the world, look at the balance sheets. Consumer balance sheets are relatively healthy. Company balance sheets are relatively healthy. Banks as well, relatively healthy. Governments, they're not healthy. They're debt loaded. So it's a bizarre time at the moment.
That is such a good way of putting it. It is completely bizarre. If you look for this, all central banks are going to come out this week, and it's not just the BOJ, the BOE, or the Fed. There's a ton more too. What do you think is going to have the most market impact? Where's the volatility going to be felt the most?
So the most interesting one of all three is the Bank of Japan. Why? Because they are just standing out like a sore thumb. To be in negative rates in this day and age is again, bizarre, right? They're probably not going to do anything drastic, but the hints, the language, they've already started more accommodation with their yield curve control. That's important because if you're the only one being so accommodative, you are exporting that loose monetary policy in the world. So that's really interesting. Regarding the Bank of England, I don't think it's a big surprise that they hike. We're all expecting it. Regarding the Fed, they're expected to pause. They probably continue to pause. The thing there that's interesting is the dot plot, is the expectations that they themselves have around future rates. And, the hopes that people had about rate cuts next year, how that works.
Okay, let's talk about rate cuts and where yields are going to go. Annika, is there a danger that we get rate cuts or even just steady rates from the Fed and yields continue to climb higher? And I'm wondering at that point how the economy reacts. we're going to see so much supply coming through. We're going to see QE continuing. Maybe you're going to start seeing sales as well from places like China. If yields continue to climb in the United States, the cost of money continues to climb, how do central banks, how does the Fed react to that?
Yeah, and you said exactly the right word, supply. So let's remember the fact that we've had a 6-9 month period where bond supply, let's talk about treasuries, have been limited. Why? There was the debt ceiling, government spending was funded by the Treasury accounts, etc. So with that bond supply coming up, you see the impact on yields, and that impact is quite sharp. So that's definitely taking its course above and beyond what central banks are doing there. And I think, to your point, it makes it quite puzzling. That's why you've seen equities, especially growth stocks, very richly valued equities under pressure, because the yields are squeezing through. So yeah, it definitely adds to the complexity of things.
Annika, great to see you. Thanks for stopping by to see us. Annika Trion, Chief Economist at Van Lanschot Kempen, joining us from Amsterdam. Okay, just on a programming note, we're going to have an exclusive interview with the German Finance Minister, Christian Lindner. Anna has gone. I saw her with a suitcase this morning. She's off to interview Christian Lindner. We're going to have that interview for you tomorrow here on Bloomberg Television. European stocks are done for the day. Negative session. There's Christian Lindner. I'll show you the negative session in just a moment. We are looking at most stocks being lower. The French market's been under more pressure than most. Some of the luxury names have been down. The real story today, though, is what has been happening with oil stocks. But banks have been a big story as well. SocGen certainly under pressure, which is why the CAC is down. The stock's slumping the most in 6 months. We had the strategy update a little bit earlier on. We're going to talk about that next. Okay.
Could be that given that we have this productivity enhancing technology that is AI, that has come off the back of this transformative communications network that's the internet, and we have a fundamental shift in the way the energy system is working, so there could be the ingredients of a pivot point of a kind that we've only seen a couple of times previously in history.
But let's ask what the driving forces will be. The world is propelled forward and has been for thousands of years by great power competition. That is the thing that drives innovation right now across the board. It is a competition which is intensifying between two superpowers, the United States and a communist-led superpower. Now, is this starting to sound familiar?
It does.
So what is really significant about this historical moment is that we are in the first inning, the early phase of Cold War II.
Right.
And that is going to drive all the things that we've talked about, and it will not necessarily drive these changes in directions that are benign. That the big technological advance of Cold War I was, of course, nuclear weapons. And the arms race with nuclear weapons was an extremely dangerous one that very nearly blew the world up, particularly in 1962 at the time of the Cuban Missile Crisis. Yeah. I don't believe for a minute that we can have a Cold War II without a similar risk.
Do you think there's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is Deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth, down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
Not a good day for SocGen. Stock down sharply. This after the company announced a few cuts earlier on to its revenue and profitability targets. Here to talk more about the challenges that are facing the newly installed CEO, Slawomir Krupa, is Bloomberg's Alex Rajvandari. Nice to see you. Expectations were very high. How on earth did they disappoint to this degree?
Yes, expectations were high indeed. Analysts in the last month were very enthusiastic about the new CEO, who argued for change and made his point to the board to be appointed because of that.
Yep.
Eventually, well, that didn't prove really to be fruitful today. He made some changes and made some pledges that were very important for the bank.
Yep.
Capital strength is a key element of his new strategic plan. Efficiency as well is cutting costs, but that is sacrificing growth really. So revenue growth targets are being lowered. Profitability targets have been lowered too. When, at the same time, BNP has increased its own target earlier this year. So it's really not a good look for the bank within the French market.
Hey.
The payout ratio as well is completely different. I mean, it used to be 50% of the underlying net income, and now it's 40 to 50% of the reported net income. So it's going to be lower. And he indicated earlier today with analysts that the payout is going to be lower. It's fair to assume that it's going to be lower in the first years when the bank is building up capital, and then it might increase. But this is, I think, two main concerns for analysts and investors today.
Did he have to do this? This just seems like a lot of disappointment. Did this kind of cost cutting, did this kind of focusing on capital buildup at the expense of profitability, did this have to happen?
Cost cutting was something that has been floated around by analysts for a while. Its cost-income ratio was pretty high compared to peers. However, for the profitability, I mean, it's the thing is that Slawomir Krupa was in a tight spot until last week because SocGen has a history of presenting targets to the market and not really achieving them.
Yeah.
And maybe it was easier for him to not do anything.
So honesty, not the best policy here. Could he have just said nothing?
I'm at the same time, what he says now is that he doesn't have his view on the intraday share price. I was with him with other journalists when the share price started to drop this morning, and he said he wouldn't comment on that. That he had his view on the total return for the shares in the long term. He agrees and argues and insists that his plan is the best for the bank in the long term, and it's a plan that has not a lot of promises, but at least promises that are achievable. This is a change from the ODR era where, there were targets that were presented and sometimes they were dropped a few months after.
Is he blaming the previous administration, the previous management? Is he blaming the ODR era for kind of where the bank is?
Somehow he's hinting at this when with analysts he kind of said a few things about choices that were made that were not maybe ideal, but he's not being very is not blaming everything on UDR, but because he was here at the time as well. But I did notice that he said that the plan he presented for the investment bank 2 years ago, all the targets were achieved then. So yeah.
Fair enough. Alexander, thank you so much. We really appreciate it. Alexander Rajvandari joining us on SocGen. Yeah, it's a big head scratcher. How do you get yourself out of that hole that you just dug there? All right, coming up, world leaders descending on New York for the United Nations General Assembly. We call it UNGA. We call it the traffic nightmare. We're going to discuss what's on the agenda and who won't be attending. This is Bloomberg.
Okay, so you're moving in on me quick, distracting me with your fancy hands. I'm going to deal with your night because it's really bothering me.
Ah, my nights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right, I will concede. I can see. You got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Stock's still going nowhere fast, but maybe a little green, but honestly, not a lot of movement. Abigail's tracking the moves. Abby?
Yeah, small moves, but a little bit more green than we had earlier. The S&P 500 E-mini futures overnight up maybe about 0.2%, then down about 0.2%, thereabouts. Now up a whopping 0.3%. So stock investors really trying to decide after 2 weeks of declines what way to push stocks now. As for some of the movers beneath the surface, because it's not all dull, take a look at Apple up 1.7%, despite the fact that the stock has been breaking down technically to some degree. There were reports that sales of the iPhone 15 may be solid. There's some mixed thought there between Wall Street analysts, but investors clearly going with the bulls. Lennar up 2%. You can see Tesla down 2.6%. Saudi Arabia and Tesla, according to the Wall Street Journal, talking about some AI production facilities. And then Moderna down 8.7%. I'm not exactly sure why. I'm looking at the news right here, but that's a pretty solid decline. As for the S&P 500 itself, not surprisingly, with this bear and bull or bull and bear battle, let's check in on this chart that we've taken a look at before. Here's the uptrend of the year, and now over the last couple of months, stalling as investors try to figure out what next. Is there more rate hikes ahead? Is the economy going to slow? Last week, it did seem possible that we're going to break out of the range. Now we're back in the range below the 50-day. There's some lower lows, suggesting, Guy, that we may just see this S&P 500 go back toward the bottom of the range at, like, let's call it a little bit above 4,300. The important thing of any range, though, is not the range itself. It's what way it breaks out. It's still unclear whether this is consolidation before a big move up or consolidation before a reversal back down. Stay tuned. Never a dull day, except for today's small game.
We will certainly, well, today maybe, but it's an exception that proves the rule. Abigail, thank you very much indeed. What are we watching for the rest of the day? Instacart pricing ahead of its trading. That's going to happen tomorrow, debut tomorrow, basically. Watch out for that. We'll have some great coverage. The US Treasury Secretary Janet Yellen, Hillary Clinton, speaking at the Clinton Global Initiative annual meeting. That is taking place in New York. New York's a little busy right now. Also in New York, I think he got here over the weekend, or there over the weekend, President Biden attending fundraising dinners tonight. Of course, he's going to be addressing the UN General Assembly tomorrow, Alex. I'm sure you and New York traffic very much looking forward to that.
It feels like the trains also get messed up during UNGA. I don't know why they're related, but yet it somehow always happens. And then it's also pouring rain all day today. So all of this just means that Midtown stinks. Getting around Midtown, no good. Bloomberg's Emery Horton is in New York now, covering UNGA here for us. Emery, what's the most important thing you're watching this week?
So the most important thing actually I think probably happened, and that was Jake Sullivan, President Biden's national security advisor, over the weekend in Malta, sitting down with Wang Yi. Xi Jinping's not going to be here at the UN General Assembly. Emmanuel Macron's not going to be here. Mohammed bin Salman's not going to be here. Vladimir Putin's not going to be here. But China obviously plays a pivotal role in what is going on right now, whether it's the war in Ukraine, whether what's happening in terms of export controls. The United States is trying to make sure they're not getting access to advanced technology. And we've seen the U.S. have a number of meetings with the Chinese and their counterparts, but we've been waiting to find out if there would be one between Biden and Xi Jinping. And potentially this meeting with Wang Yi and Jake Sullivan could be the path to that in November. Xi Jinping potentially could be coming to California at the APEC summit.
Anne-Marie, can we also talk about this prisoner exchange? Everybody's focused on the oil price right now. Everybody's trying to figure out where we go from here. Do we go to 100? What's going to happen next? How significant is what happened in Doha today? And what does that tell us about how relationships are developing between United States officials and Iranian officials, and how that's going to evolve?
Well, when you look at the oil market, what we do know from Iran is that there is a lot of Iranian barrels leaving the country, heading to China, and not a lot of the sanctions have been fully enforced. I think quietly that's been happening more. I would say U.S. officials pretty much agree with that, but all of this is taking shape around that prisoner exchange, which happened today, just a few hours ago, in Doha. These are 5 Americans, as well as 2 of them had relatives traveling with them as well. The Qataris, the Omanis were really pivotal in making sure that the swap could happen. And for the release of these Americans, also Iranians, prisoners were released from the United States, as well as $6 billion of Iranian funds that have been frozen in South Korea were transferred to Qatari bank accounts that Iran will be able to use for humanitarian aid. This is what we're hearing from the administration. Only humanitarian medicine, things like that, although you did have Ibrahim Raisi, the leader of Iran, tell NBC that they can use it for whatever they want, but it does look like this is going to be strictly for humanitarian purposes.
So tie that in then to the relationship right now between the Saudis and the U.S., and if we're going to get any clarity on that, because it does feel like the Saudis have a lot of sway and a lot of hammers to inflict pain on the U.S. through the oil price, but they can exert a lot of energy, no pun intended, to get what they want. How does this all fit together?
Well, when it comes to Iran, it also fits together here along on the sidelines of the UN General Assembly, because what we heard from the Iranian Foreign Ministry is that there will be an intermediary that's going to talk to the Iranians and talk to the Americans. Potentially there is a path for opening up, I wouldn't say nuclear talks for JCPOA, but maybe an understanding of where they are when it comes to nuclear. At the same time, you do have Iran and Saudi Arabia opening up embassies, having ambassadors now. This is a breakthrough for these 2 main rivalries in the Gulf. When it comes to the oil market, Saudi Arabia obviously can flex their muscles, move the price, even though the United States is the biggest oil producer. We are on track to produce under 13 million barrels a day this year, 12.8. The Saudis are under 10, but obviously they're a huge swing producer. And I think what was a little bit more shocking to watchers of the oil market in OPEC was that Saudi Arabia, instead of just going 1 month of cuts, they went for 3 months of cuts.
Yeah.
This becomes very political because we're heading into an election year, and U.S. gasoline pump prices are heading towards $4 a gallon.
Absolutely. So given all of this, what do we think the president's going to say tomorrow?
I think the president is going to double down on the support for Ukraine. Again, this becomes very political because you have Zelensky here for the UN General Assembly, but the more important meeting is going to be not just when Zelensky goes to the White House in Washington later this week, but when he makes a trip to the Capitol. Who is he going to talk to in Congress? Who wants in Congress to have a meeting with him? Because remember, it's very challenging right now to get Ukraine aid across the finish line in Congress. It's not even included in this continuing resolution to keep the government open, the supplemental aid that a lot of Republican hawks want, but some of the far right flank in the House Republicans do not want to see. So I think you're going to see the president really want to double down on that when it comes to Ukraine aid and Putin's aggression.
Anne-Marie, thanks a lot. I'm looking forward to having you here all this week. Anne-Marie Hordern joining us on UNGA. Okay, again, stocks going nowhere. Maybe tech up by 0.1%. Nothing to write home about here, but lots of things happening in the next week. That wraps up for me and Guy. Coming up, Bloomberg Technology and Stellantis CEO. This is Bloomberg.
been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted. And I think many people, even in the markets, have not quite understood in my mind how much we are now in a different regime compared to the last 4 decades, effectively.
So it's what, almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
From Bloomberg's World Headquarters in New York, I'm Caroline Hyde.
And I'm Ed Ludlow, reunited in New York City. This is Bloomberg Technology.
Coming up, full IPO coverage ahead. Instacart pricing tonight as Klaviyo prepares to go public this week as well. We'll bring you everything you need to know.
And we'll get the inside look into the digital asset industry with Blockchain Capital as the VC firm announces it's raised $580 million for new funds.
Plus, AI startup Writer. It raises $100 million to further grow its business. We'll have an exclusive conversation with the CEO. But first, let's check in on these markets. And actually, it is a week of macro focus. New York is packed for UNGA, but we're all looking at what's happening in terms of the Fed, the Bank of England, the Bank of Japan as well. We're treading water ahead of that. A little bit of caution. NASDAQ up 0.25%. Two-year yield just ticking higher. We're still above that all-important 5% level. So some nervousness about where the Fed will go. We're expecting a pause for later this week come Wednesday. New York crude, though, the real inflationary pressure point at the moment. We're seeing it up $91, $92 a barrel, let's call it, at 1.2% again. Moving on to, of course, the point for all risk assets at the moment. And it's interesting that even amid this caution, these nerves, well, we're actually seeing a little bit of a bid into Bitcoin. Many saying we're not really sure, thin liquidity. We're seeing some outsized moves, but still above that $27,000. Sort of more psychological one, Ed, but you're with the micro.
Yeah, there's a lot of sell side and a lot of news driving movers. Apple's really interesting, rallying up 1.9%. You got the sell side trying to make sense of that early pre-order data for iPhone 15, and it's such a mixed picture, but the market seems to really like what it's seeing. Remember, iPhone 15 Plus Pro and Pro Max goes on sale September 22nd in this country. We follow that so closely because we want to know if it's a big driver of an upgrade cycle for Apple. Elsewhere, there's so much going on in the news as well. Here are some specific names that I'm taking a look at. Disney now flat, basically, up 0.1%. Bloomberg reporting, citing sources, that they're looking at their India assets, an outright sale, a joint venture, a lot on the table, and some interesting names in the mix. Micron up 1.4%. Interesting call from Bernstein, basically saying that they see price recovery. Remember, memory chips, DRAM, NAND, highly commoditized. We want to see evidence of stabilization there. And then some IPO for you, Caro. Take a look at ARM, right? We're in our third session since the debut Thursday. Surges 25% on the Thursday debut, falls Friday. Third session Monday, we're now down below that around $57 a share. Interesting because there's a number of IPOs waiting in the wings.
This is why New York is hot this week. This is why, of course, it's so important to have Ed here, because it is an IPO week. The New York Stock Exchange, NASDAQ are going to be busy. Let's think about Instacart first and foremost, because it's finally set to take that plunge into public markets, pricing later today, trading tomorrow. Joining us now is Bloomberg's Katie Roof. And
It's kind of interesting timing. We don't often see IPOs priced on a Monday, right?
Yeah, it's kind of unusual. Usually they debut Wednesday, Thursday, Friday, and they price the night before. So big ones, yeah, not typically on pricing Monday night, but hey, why not?
Why not? Officially, Maple Bear Inc. is, of course, the name overall. Oh dear, we just have some people walking in front of the camera.
Hey,
Apologies
it's Monday
for that.
Madness. Let's
It's
go.
Monday Madness. We're new to this particular studio at the moment. But I'm interested in what you think ultimately this is a test of. This is a test of interest for tech assets at this moment, but is it a test of kind of the pivot that CEO Fujisimo has made to focus more on sort of an e-commerce bellwether player, not just, of course, delivery?
Sure, yeah. I mean, the market's looking at a lot of different things here. I mean, first of all, I think it's a big test of whether the market cares more about profitability or growth. There's been so much that's been said about why all these tech stocks went down in the last few years, and a lot of people are under the impression that public tech investors, care more about the rate of growth than they did. They cared more about the rate of growth before, and now they care about profitability. So Instacart has a slowed rate of growth, but they've focused on being profitable, and they've been focusing on new business segments.
Remind us, who's set to benefit? Who are the VCs that backed this early?
So Sequoia backed it early, and a lot has been said, that there have been VCs that invested at a $39 billion valuation, and at the top of the range, Instacart might just be $10 billion. But, I'd keep in mind that Sequoia invested maybe around $1 a share. A lot of venture firms invested early. So I would say the average cost per share was going to be meaningful for a lot of VCs. There are some venture firms that, maybe invested too much at the pre-IPO stage. Actually, a lot of them are like crossover investors, like hedge funds, like D1, although they had invested in several rounds prior to the $39 billion valuation as well. So, yeah, there are some investors that will be underwater.
Katie Roof, breaking it down for us. We thank you. And look, it's not the only IPO, Ed.
Yeah, look, I'm not making it up. It is a Mad Monday. Let's keep the IPO conversation going. Marketing and data automation provider Klaviyo gears up for its IPO. Joining us now is the man you saw run across set. I've never met anyone as keen to break news as Bloomberg's Ryan Gould, who's only a few weeks into his time in the Bloomberg newsroom. Klaviyo, interesting. Let's respectfully say, of the names we waited for, it was the less talked about, but what's going to happen in the next 24 hours or so?
Yeah, do you know what's interesting, I think, is that you say it was the one that was less talked about, but actually if you look on paper and think about, size and profile, Instacart is very similar to Klaviyo. They're both, pushing a $9 billion valuation. Klaviyo has followed Instacart's lead. Just yesterday, we reported that they were looking to boost the IPO price range, $2 either side of the bottom and top end. So they're now pushing a 27, 29 price range. The SEC filing came out this morning. And I think, this just confirms what we learned last week, that, this is still a pretty tentative time for markets, but, there's been a shot in the arm, so to speak, for, companies who are perhaps thinking, all right, we've got, a good amount sort of backed up by cornerstones, both in Instacart's and Klaviyo's case. And so, let's play it safe, let's play it smart. And they're raising their range.
Give me some of the names behind Klaviyo, some of the existing backers, and which banks are going to help us take this company public.
Yeah, so Summit Partners is behind Klaviyo, and actually 11% of Klaviyo's revenue comes from Shopify. And, I think when you start thinking about, how does the consumer respond, what's the sort of retail appetite, it's pretty interesting to think about the insights that these guys are sort of giving us across the spectrum. But I think, I would caution and say that Klaviyo and Instacart are very different businesses.
Yeah.
I think it's probably good not to draw too many comparisons. But, come tomorrow, we would have had both, Instacart pricing today, trading tomorrow, and then Klaviyo pricing tomorrow afternoon too for trading on Wednesday.
There are some similarities across all the IPOs of having some cornerstone investors involved, but focus on the difference for a minute. What is a marketing and data automation provider? What is Klaviyo up to from its business model perspective?
Yeah, I mean, it's really getting down into the weeds as to what people want to, or what they think people are interested in, how they can better provide those insights to those who are ultimately looking to make the most money. I think when you think about Instacart, it's, grocery delivery. How do you provide them with the best insights into what people are wanting at a given moment? And, I think even outside of the IPO, IPO candidates, there are even quite a few companies on the sort of strict M&A side who are, exploring options, so to speak, for businesses that are exposed to marketing, data, information services, insights across the piece.
Or making us buy the right thing at the right time. You need data for that. Rangold, thank you very much indeed. All things IPOs. Meanwhile, coming up, we'll talk a bit more about the world of crypto too, digital assets. There's some fundraising going on, friends. Blockchain Capital general partner Spencer Bogart, his firm's just raised $580 million in some fresh funds. We'll get into it. This is Bloomberg Technology.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We will be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think, within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg. Top experts. Great questions.
Chinese fintech giant Ant is planning to unwind its investment in A&T Capital, pulling back from a $100 million fund that was actually central to its bet on digital assets. A&T Capital is losing one of its biggest financial backers. It seems unclear if actually the venture firm will continue to operate or, well, snag a new key investor. But meanwhile, bucking that particular trend and the down rounds and concerns about crypto, we've got crypto-focused Blockchain Capital joining us, who's actually raised funds, $580 million of them, across 2 new funds, we understand. One of the biggest raises for the asset class this year, not just ever for the venture firm in its 10-year history. So pleased to welcome to the show Spencer Bogart, Blockchain Capital general partner. And are you bucking a trend, or is there more interest, more LP interest in coming into crypto?
There's certainly plenty of LP interest. Listen, we're doing what we've always done, which is continue to double down on the industry that we have long-term conviction in the middle of a bear market. And so we're looking forward to deploying this capital into some fresh opportunities.
Okay, so talk about the fresh opportunities. Where in the space do you think that valuations aren't elevated, that people are really proving some disruption in this moment?
Sure. So we see opportunities at both the early stage and the later stage. If we go back to 2020 to 2022, I'd say that the industry was mostly characterized by an influx of new large allocators that were deploying very large sums of capital to the mid and late stage segment of the market. All of those capital allocators have walked off the playing field, right? They're no longer active in the industry. But meanwhile, during this last kind of market cycle that we saw from 2020 to 2022, we did have a lot of early stage companies that were funded. And a few of those are growing up into that kind of mid-stage of the market, and that's what we're keeping a close eye on.
Spencer, I just want to check some of the mechanics with you, because you guys already had $2 billion of assets, right? Is it that that capital had already been committed, and now you're bringing in new funds because you've got opportunities to write new checks?
Correct. So our assets under management grew to $2 billion over the past decade that we've been doing this. So we're now deploying capital out of our 6th early stage fund, and again, our first opportunity fund. So that's doing Series B and later.
Okay,
and so that $2 billion came from the prior 5 funds.
The focus, decentralized finance and gaming. Just explain how the focus of the sort of target startups changed then with this new fund.
You know, it continues to cover a lot of the opportunities in the space, but I'd say early on in our first fund vintages, we're really focused on, if you think from a sequencing perspective, which opportunities need to work first. And that's largely thinking about things that we broadly bucket under centralized finance. So these are largely on-ramps, right, and off-ramps. So it's things like Coinbase and Kraken, BitGo, Anchorage, you know, the largest exchanges and custodians. Because nothing else can really work unless you have robust, reliable on-ramps and off-ramps. Now, over time, we've blended and moved more towards I'd characterize them maybe as more crypto-native opportunities. So these are things like decentralized infrastructure, decentralized finance, and then especially gaming has been on the horizon for the past couple of years, and we've made a select few investments in that category.
I'm just interested in, aside from the investments you're making, you had an interesting turn of phrase. You said these big players who are writing big checks have walked off the field. I mean, A16Z is still out there with a massive crypto fund, I think a Katie Hahn. I mean, are these players not writing checks at the moment? Are they not deploying the capital they raised?
No, those are not the large allocators that I'm thinking of. So I think most of the crypto native investors have stayed true to the industry and continue to deploy capital. The ones that I'm thinking about are more of the large late stage private equity or hedge funds even that were building some pockets of illiquid private investments. Several of them kind of came in and they said, listen, we have 0% exposure to this sector. We'd like to get it up to 10% in a 12-month period. And naturally that resulted in clearing prices that were above and beyond our appetite.
There has, though, been still this push and pull, this tension of institutional appetite when we think about more broadly a spot ETF for Bitcoin, but then at the same time nervousness from institutional money, from old guard money, because of ultimately regulation, particularly here in the US. How is that affecting startups, founders, the companies that are managing to scale at the moment?
Look, I think across whether it's the large institutional allocators that are looking at the space or it's early stage startup founders, I think they're looking at the same thing, which is the actual metrics on the ground. So yes, it is a bear market. Yes, it's a so-called crypto winter in industry speak. But if you look at the numbers on the ground, we've seen stablecoins process over $6 trillion of volume in the past 12 months alone. And that's accounting only for transactions in the Ethereum network. If we expanded, it'd probably be closer to 9 or 10 trillion. That's just stablecoins. Within DeFi, we've got $700 million of protocol revenue that's been generated by these DeFi applications. We've got $700 billion of volume going across decentralized exchanges in the past 12 months. All of which is to say that actually on the ground, there's a lot of healthy things happening. It is not the way that I think most people perceive it, that in these bear markets or crypto winters, that activity just disappears.
So Spencer, let's talk quickly about gaming. And when I think about the use of blockchain in gaming, it's about monetizing, right? In-game customization, skins, character shares. Is it limited to that, though, the opportunities you see?
So no, it's not limited to that. I would largely characterize the opportunity in gaming as the same as most of the applications of blockchain technology, which is to put users at the center and to disintermediate some of the economics associated with it. So in the case of gaming, we have, you know, tens of millions of people around the world that invest maybe dozens or if not hundreds of hours a week into acquiring in-game assets. They spend their time, they spend their money to acquire these assets. And the promise from a lot of these blockchain startups is that within a gaming context, they can give users actual ownership of these assets in the same way that they would in the real world or the physical world.
Yeah. Spencer Bogart, Blockchain Capital, always good to catch up and have you on the show. Thank you. Now, coming up here on Bloomberg Technology, a conversation with May Habib, co-founder and CEO of the AI startup Writer on its Series B funding announcement. That's coming up next. This is Bloomberg Technology.
do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
From New York City.
From London, in Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Time for Talking Tech. And first up, Bob Van Dijk, CEO of Prosus, is stepping down from his role as head of the tech investment firm. Van Dijk will remain as a consultant to the board and its parent company, Naspers, until the end of September 2024. His departure comes after a complicated shareholder structure that was highly criticized by some investors and government regulators. And Alibaba is unveiling plans to beef up its investments in Turkey. During a meeting Friday with Turkey's President Erdogan, the Chinese internet company pledged $2 billion. Alibaba's already invested over $1 billion through its Turkish unit, Trendyol, Turkey's biggest e-commerce platform. Plus, investment firm KKR has agreed to buy 20% of Singapore Telecommunications regional data center business for more than $800 million US. Singapore's largest telecoms provider will use the capital to bankroll an expansion across Southeast Asia. The deal also allows KKR to take up to 2 seats on the unit's board, further expanding its reach into the server networks that power the internet. Now, speaking of investing, artificial intelligence startup Writer is planning to invest more in its AI models. Writer's raised $100 million in a Series B round, the round valuing the company at more than $500 million. Joining us now from San Francisco, Writer's CEO and co-founder, May Habib. And May, very simple question to start with. What do you use those funds for?
Oh, thanks so much, Ed. Great to be here. Well, we're using the funds to further invest in our large language model technologies and our full stack generative AI platform. Enterprises are ready to move from, all the talk of the promise of generative AI to real impactful applications they can put into production, and we're going to keep beefing up our platform to do that.
Talk about real impactful revenue for you as well, because there is so much optimism, dare I say hype, around how much revenue this is going to bring in for the key public companies already. What about you? What are you seeing in terms of growth?
Oh, thanks so much, Caroline. So we are 4x, since the beginning of the year. So absolutely an influx of folks who, have gotten their hands dirty working with large language models, but are kind of stuck in POC purgatory, proofs of concepts that don't make it to production. And so we succeed and our customers succeed when we can really help them realize that promise, building applications that people actually use that involve, their data and are secure in their environments.
And their employees becoming ultimately more productive, May. This comes at a tough time, doesn't it? Just from the mentality of, yes, there's productivity to be had, but boy, are we worried about the dislocation, the disruption it caused for labor. In particular, I'm thinking of the strikes happening over on the West Coast and here in the East Coast for writers, for actors. AI is a worry there. How much are you thinking you might end up displacing workers?
Yeah. It was a big concern of a lot of the executives that took a chance on us, and executives who have joined this round, customers like Vanguard and L'Oreal and Accenture. And those executives aren't there promoting AI to displace jobs at all. We're really all in concert to help transform work, to make it more creative, more interesting, and really take away the kind of cognitive manual labor in a lot of these workflows. So I would say we're quite different in that regard. In the way that Writer is use case based and workflow based. People are the heart of making generative AI work.
May, you got that access to capital, but I think I'm right in saying you're also in the H100 club, aren't you? How important is it to have that compute access? You have a cluster in the thousands, I think I'm right in saying.
So NVIDIA is a close partner. They're a customer of Writer as well. We really wouldn't be where we are if we didn't have that partnership. And I think, very importantly, a philosophy of smaller models are more agile. They're easier to manage. They're easier for our customers to put in their virtual private clouds. And, bigger isn't always better.
It's a good point you raised. Caroline and I have covered a lot of these raises. Foundation models that are raising increments of hundreds of millions and at high valuation. And do you worry about the sort of hype around it? Do you think that your own valuation was fair in this round in terms of your potential?
Yeah, Ed, we could have done this at billions of valuation, which I think is absolutely absurd. I think some of what is happening is not good for the industry. We want, unhyped use cases. We want unhyped, transformations, augmentations. The real use cases here are when you put people and AI together. And I think over focus on the large language models, the size of them, the valuations of the companies, it's really distracting from actually getting value.
What about the way in which they're built, they're constructed? May we come off a week where a lot of key CEOs, thought leaders were out there in Washington thinking about future regulation. How do you think about your role in forming that?
Yeah, well, we already get RFPs that ask us about the EU AI Act, Caroline, and it's not even law yet. And so, we are enterprise first, bottoms up. We've built for customers being able to audit our training data and really look at, if there is copyrighted information in there, there isn't. I think the companies that really make it in the enterprise have to think about a world where regulation is here, and it's here pretty globally, not just in Europe.
May, really quickly, what kind of roles are a priority for you to hire? What kind of people do you need?
Ed, literally everything. If you're in tech and you want to work in AI, please email me.
Well, we won't ask you to give us your email address on live television, but maybe you can go to your Twitter and social media accounts. We thank you so much, May Habib. Great to have you on today on The Round, of course, CEO and co-founder of Writer. Coming up, look, let's talk about Meta, bringing back some perks for its employees to try and lure them back into the office after a wave of mass layoffs. Ed, this is going to be a fascinating one. More on that next. This is Bloomberg Technology.
Do you think there's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well? Or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea. But technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
Welcome back to Bloomberg Technology. Ed Ludlow here in New York City, Caro.
Yeah, it's so good to have you here, Ed. Let's have a quick check on these markets. I'm Caroline High. Let's give it a quick look at, as we get through midday trading, NASDAQ actually turning a little bit to the higher side, NASDAQ 100 in particular. We're in this nervous macro period where we get not only the Federal Reserve come Wednesday, you get the Bank of England on Thursday, the Bank of Japan to round out the week. Where is, well, the pressure point's going to be for some of these central bankers? To the upside, it feels like on the 2-year yield, we're up against just about 2 basis points overall because we're worrying again about whether we pause this time but have to keep on raising. In the fight of inflation that you see, prices of oil on the rise. I'm seeing Bitcoin actually, interestingly, managing to shake off some of this anxiety. We're up almost 3%. Ask not the reason why. Many people are saying, look, this is thin liquidity at the moment, but we're above that 27,000 level. Moving on, go to some of the individual movers that are on our minds. Of course, Apple actually managing to make up some of that sell-off come Friday. This as we see some good mood music coming around the early sales and interest, at least in the iPhone 15 and all of the array. Tesla on the downside, they're off by 2.6%. Some analysts writing that they're concerned about the future earnings potential of this particular company, so keep an eye on some of the analyst notes there today. And Microsoft, this was an interesting one, maybe a bit of a revolving door, but ultimately their head of product, who I might add has been at the business for a very long time, driving the likes of the Surface and indeed Microsoft Windows of late. But Panos Panay will be staying long enough to help replacements, we understand, transition into the role. But after more than decades, having joined since 2004, Panos Panay is leaving Microsoft, Ed.
Yeah, speaking of departures and returns, it's been a pretty rough year for Meta employees. After 20,000 of their teammates were laid off over the past year. But now they're starting to enjoy coming back into the office. One reason is the company has revived a number of popular pre-pandemic perks, from branded T-shirts to happy hours. Let's bring in Bloomberg's Aisha Counts out of SF for more. And Aisha, this is interesting because when you and I reported the rounds of layoffs at the end of last year and beginning of this year, we covered how deep and sudden and wide they were, and many people were upset. Talk to us about some of the cultural fixes that Meta's bringing back in.
Yeah, as you mentioned, around the time of the layoffs, I mean, people were anxious. They were scared that they could lose their jobs at any moment. They started to scale back perks, and now those are coming back. So employees I was talking to were saying happy hours on Thursdays are happening again. Dinner time, which used to be at like 6:30 or 7, is now at 6, and people are super excited about that. The restaurants are opening up again. And even some of the more sort of luxurious perks like laundry services and haircuts are back. So people are excited that things are actually coming back, and it's definitely boosting spirits.
There's enough LaCroix to go around, Aisha. What about, though, enough jobs to go around? I'm actually, in the detail of your story, people are actually being brought back who had previously been laid off.
I talked to, some employees that had been rehired, and there are other people that are in the process. It's slow, and they have to sort of go through the application process again, but Meta is rehiring. And they said this, too, in the earnings call, right, that they want to hire more people in hot areas like AI, especially generative AI. So, yeah, they are slowly starting to bring some people back.
I think what's so interesting now, Aisha, is we're in a time where we're not really either talking about the metaverse and the sort of losses that unit was going on. We are talking more about the work that Meta's doing in AI, Llama 2, open source. What is the latest signal we're getting out of Meta of what the priority is for Mark Zuckerberg?
It's still AI. I mean, they'll tell you on the earnings call that, the metaverse is still a priority, and the company is still putting money there. But it really is AI. Even employees that I've talked to said, like, everyone wants to be on the generative AI teams. That's sort of like the hot team that's doing well, that's getting money. So even just from where employees are going and what teams they want to be on, you can see that. And then, of course, as you mentioned, they have Code Llama, Llama 1, Llama 2. They're really sort of pushing to be a leader in the AI space.
Aisha Counts, brilliant. We thank you for that story. And meanwhile, I mean, ultimately, here you are in New York with all your knowledge of really the anxiety that has been in the past for San Francisco, Silicon Valley more broadly, but Meta, it is notable that they had a long way to work to get back that morale.
Yeah, the way it was described to me at the time is like at first they used a scalpel and they were like, okay, let's very clearly work out what we need to do. But the year of efficiency was the priority. So they later chucked out the scalpel and they brought the sledgehammer, which is one way that some executives put it to me. And they realized, well, hold on, we actually need some of these people. And it's amazing to see Aisha report they're now, as individuals, being hired back.
And at a time where share price is on the rise, that's always helpful for your mood music as well. But there is still this ongoing concern about really the future of social media. It's bread and butter, the future direction of WhatsApp, of Messenger, but notably of Instagram and of Facebook, the OG, the blue. And how we regulate that going forward, how we make it a safer space. And we want to stick on that particular point because we understand that more than 100 parents of transgender kids have signed an open letter urging the US Senate to oppose the Kids Online Safety Act, or KOSA as it's known. The legislation aims to make the internet safer for kids, but look, some LGBTQ advocates are raising some concerns against particularly Senator Marsha Blackburn's legislation that could give new power to state attorneys general to dictate what children can access online. And perhaps that cuts trans children off from what the parents are saying as life-saving online resources and community. Let's bring in someone who's trying to find the nuance within all of this. Frank McCourt Jr. is the founder of Project Liberty Action Network and Project Liberty, an organization which strives to address the harms of social media and technology on society, and especially for children. You've been a proponent of the kids' online safety, but at the heart of it, Frank, you're someone who wants technology to be the answer here. Can technology, when we talk about AI and the focus, ever solve for the nuance, for the ability to get this very difficult context satisfied?
Yeah, I think it can. And yeah, I'm glad you mentioned AI because all this is, moving very quickly now, right? And we, I think, need to really focus on the infrastructure. And I'm a builder at heart, right? I'm from a family of I'm a fifth generation builder. 130 years we've been building large infrastructure projects. And when we look at the design, the current design of big tech, and in particular, how social media platforms are being used and being brought forward, we have a design problem and an infrastructure problem. And fortunately now we have the technology to actually fix it, right? We can provide a digital identity. We can provide ownership and data control to individuals. We can actually share value within individuals. So I think we need to fix the tech to fix the problem. But fixing the tech alone won't solve it.
But that's the thing, Frank, that you just heard Kara and I talking there to Aisha about what Meta is working on. It's good at artificial intelligence, the cutting edge of foundation models. From a regulatory perspective, their position was always that we don't know who should have oversight. We just don't think we should do it ourselves. But why do we not talk more about them finding technological fixes for the problems on their own platforms?
Because they don't want to fix it. Because these big platforms have our data. They aggregate it and they exploit it and monetize it. And we need a new design for the technology where individuals own and control their data. You mentioned regulation. I think regulation is part of it, but it's not going to solve the entire problem. And for me, what's very interesting about this KOSA, the Kids Online Safety Act, is we've seen the level of concern parents have with the current tech architecture. We know it's broken. KOSA is an effort in the right direction, right? To let big tech know we're not going to live with this any longer. We're going to fix it. So I think it's not the be all end all, but it's a step in the right direction.
So what is the technological fix? Is it algorithmic? Is it, I've asked that question to the companies many times over the years, and I'm yet to hear a straightforward answer.
Yeah, because they don't want to give you an answer. Because
but what is your answer, Frank?
Return ownership and control of data to the individual.
Blockchain.
Using blockchain, but it's not I think about it first at the infrastructure level. I mentioned that. We're in the third generation of the internet now. The first generation was enabled by a protocol called TCP/IP. The second generation by a protocol, HTTP.
We need a third generation of the internet now, enabled by another protocol. We would suggest it's DSNP, a decentralized social networking protocol, which enables people, individuals, to own and control their data, and by deploying blockchain, derive value from that data.
We, of course, come into this conversation talking about Meta. But firstly, I want to push back at that. I think a lot of people who work at the company do want to see a fix. They never built this because they thought this would be a net negative to in any way. They want to be able to try and ensure that kids aren't in any way exposed to harmful content. But also there's this conversation that this isn't just about US companies and US regulation. This is about Chinese players, for example, and TikTok, of course, owned by ByteDance. Just want you to take a listen to what Mike Pence had to say about the regulation of TikTok.
We'll be banning TikTok. TikTok is a platform of the communist Chinese government. They're collecting data on Americans every single day. What young Americans deserve to know is that their privacy is being compromised with participation in the TikTok platform.
Does self-regulation, technological regulation, or indeed, in the end, regulation coming from the US ever solve for international players at this point?
Well, I think the TikTok example is a good one, right? Autocratic technology is awesome if you're an autocracy. So autocratic technology is going to work very, very well for China. But I would argue that you can't have a democracy with autocratic technology.
But in this circumstance, right, the proposal from TikTok and Oracle was a technological solution. House the data in a US data center with oversight from the US government, not have any data locally housed in China. Why was that, to your mind, Frank, not or was it, to your mind, a good enough solution?
No, it's not a good enough solution. I think we're playing around the edges. Buckminster Fuller had a great saying, and I'm going to paraphrase it. When the model is so broken, don't waste your time trying to fix it. Build a new model and make the old one obsolete. That's where we're at right now. 20, 30 years ago, there wasn't the ability to store data in a decentralized way, so we needed these large, centralized server farms gathering up this data. And you're right, Caroline, I don't think people went out of their way thinking that they were going to do something, most of the employees from Meta or these other companies do something bad with all this data. But just look at where we are now. Just look at where we are, right? Kids, anxious, depressed, attempting to kill themselves or killing themselves. Our society generally, we can't have conversations anymore, highly polarized. Our democracy struggling to survive. And I would argue even our economy is going to struggle if the bulk of the value resides in 5 or 6 platforms. There's a moment here where we can change all this, and we need to. It does not have to be this way.
Frank, can I ask a personal question as to why you're doing this? You are a father of 6, and I'm sure they're grown, but to a large extent. But you go back from a 19th century business that was built. You say you were builders. Why turn your attention here? Why be so galvanized, so focused on this particular part of infrastructure, even though it's not bricks and mortar?
Well, it started a decade ago when we started with Georgetown, a public policy school in Washington, D.C., brand new school, and thought that maybe we could contribute in that way. Learned very quickly, and by the way, inside the public policy school was something we call the Massive Data Institute. We learned very quickly that the data that these policymakers need is not available to them. It's in these large platforms. So that's when we began to use our skills as builders, as infrastructure specialists, to look at the design of the technology and came to just a very simple conclusion. Why is our data being scraped and aggregated by a few platforms? It just doesn't feel correct to me. We should own our digital DNA. This is our lived life. There's no separation between now your biological identity and your digital identity. Somehow we've let them be separated, but the fact of the matter, they're one and the same. And by the way, there's a lot of value to be derived from this data. So there's a lot of companies that are going to be built and innovation that's going to occur. I think we should lean into innovation and, of course, regulate things to buy the time. But this is not a regulatory fix, ultimately. This is going to be a tech fix for a tech problem. And then this time, let's get it right by optimizing for the right things, the things that are good for kids, good for society, good for democracy.
Frank McCourt Jr., founder of the Project Liberty Action Network. Just terrific conversation here. And actually, it's good to be out here on the West Coast in New York City. But up next, we're going to discuss the health of the Boston startup ecosystem. That's with Lily Lyman from _VC in our VC Spotlight segment coming up next. This is Bloomberg Technology.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Paul Jacobson assured me that when he takes the new Hummer EV on long journeys, it's not just fun to drive, it's equipped to go the distance.
I hear so much about road trip anxiety that I wanted to experience it myself. My family likes to drive a lot, so I brought my daughter home from college in this, and it was great. I mean, the computer system is all intuitive. It tells you how to keep track of the battery. It tells you where the charging stations are. It tells you how much power you'll have when you get to the charging station. So it really puts a lot of your anxiety at ease. But as far as driving it, it's a treat.
So where are you on the charging stations? I know General Motors has made an investment in one company. How are we doing in this country generally in getting charging stations in?
So I think this is an area where obviously we can continue to improve as a country and a society. We're doing our best. We've committed almost $1 billion to EV charging. So we've taken that and looked at home charging solutions, local community solutions, and road trip charging solutions. With my daughter, what we would end up doing is probably stopping, grabbing a bite to eat, plugging it into a charger, usually a high-speed charger, to get as much charge as we can, and being there for 20 to 30 minutes. Get us a lot of range, and by the time we've used that range, we're tired, ready to stop again, etc. So it was a really good experience for me, and it's taught me, number one, what are the concerns of the consumer that are ultimately going to drive our vehicles, and then number two, where do we need to focus on addressing some of those anxious points for people.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
It is good to be on the East Coast. I know where I am, New York City, reunited with Caro. But on today's VC Spotlight, we're going to be taking a look at the Boston startup ecosystem in full swing. And who better to talk to about that than Lily Lyman, general partner at _VC, early stage VC firm based in Boston, $246 million in assets. And I want to go straight to Klaviyo, potentially a big IPO, a tech company from your neck of the woods this week. How excited does that get people in your community in Boston?
Yeah, well, Ed, thanks for having me. We're very excited for the Klaviyo IPO, and I think it's in part because it's the type of company that gets built here in Boston. It's a great team. It's a huge market. They've been very capital efficient in how they've built, and I think that's reflected in the ownership of Andrew at moment of IPO will be over a third of the company. And so I think overall it's just the type of business that's built here in Boston. I think to note, there's also not a lot of puffery around it. They've just done a good job building, and I think they've earned the right to have success this week.
And maybe not that much puffery, as you say, because it's B2B ultimately. It's not B2C, so the retail investor isn't that aware of it. But this is your sweet spot. You are a B2B investor largely. And how much is Boston the ecosystem for that, particularly as we start to see the world shift towards AI? And, well, San Francisco seems to be sucking a lot of the oxygen there.
Yeah. So as you mentioned, we are B2B and vertical SaaS investors. And I think, Boston's typically known for its biotech and healthcare, but what we see is that there are a variety of sectors that are thriving here in the B2B space, whether it's commerce with companies like Salsify or insurtech with companies like Highmarley, also areas like supply chain logistics. And then, as you mentioned, increasingly in AI and machine learning. And we've had the pleasure to back several great companies in that space, a company like TetraScience, which is Snowflake for scientific data. I think in part what makes this ecosystem unique is the universities that we have in our backyard, and a lot of the leading edge technology and also talent coming out of those ecosystems consistently fuels what is now powering the AI and machine learning revolution that we're seeing across the board. So, we continue to expect to see a lot of great both tech and talent coming through this ecosystem here and fueling a lot of what people are excited about.
When you're an LP in the Harvard Fund and in the MIT Fund, how are you seeing a desire to build in what is a pretty unstable economic environment? There was meant to be the silver lining that as we had job layoffs, they would go out and build things. Is that happening, even coming out of the universities at the moment?
Yeah, as you mentioned, we are investors in some of the on-campus funds. So Harvard's Alston Fund, MIT Sandbox Fund, and the Dorm Room Fund. And what that partnership allows us to see is the most exceptional entrepreneurs coming out of those ecosystems as soon as they graduate. And we're seeing a lot of thriving ideas and opportunities. Over 26% of our portfolio actually comes from that ecosystem. And, I think in part that's because, people continue to see opportunities. Yes, this market is difficult, but one of the things that we're excited about is the caliber of founders. I think you have to be bold and you have to have grit to found companies in this market, and we're continuing to see that. Actually, PitchBook recently did a study that showed the number of founders and the amount of capital that they've raised. And if you look at Harvard and MIT graduate programs compared to that of Stanford and Berkeley's, it's actually higher here in Boston. Another way to think about that is at any given moment, there's between 1 and 4 founders of future unicorn companies walking around campus and walking around the halls here in the Boston ecosystem. So we're certainly seeing that entrepreneurial spirit continue to be thriving, and it's one of the areas we're most excited to invest in.
That is an interesting data point. And, the story that we hear all the time in San Francisco, I'm in New York this week, but in San Francisco, I went to Stanford, I studied computer science, and I dropped out and I started a company. I did it in San Francisco because despite the problems, San Francisco is a great place to live and work. If you were going to pitch Boston, what is it that's keeping those founders in the city where they either studied or raised their money from?
Yeah, there's a lot to this ecosystem to like. There's access to world-class talent, both coming out of the university systems, but also coming out of some of these homegrown tech giants that I mentioned, like the HubSpots, Toast, Klaviyo's, Salsify's. And some of the big tech giants from the West Coast have big offices here. So there's no shortage of great talent. And then, as I said, it's hard to find anywhere else in the world that has as much R&D coming out of the labs and the ecosystems here. So overall, I think the combination of those things, plus there's a thriving ecosystem of accelerators and incubators and angels, and I think it has all the ingredients you need to be successful. One of the things that was interesting is, Boston was thriving pre-pandemic, but I think post-pandemic it's accelerated even more. And in part is because we learned, West Coast investors, I think, learned that they could invest outside of their backyard. So we're actually seeing more later stage investment come into Boston. And actually some of these multi-geography firms are setting people on the ground here to cover this ecosystem as a result.
Good for the companies as you see them to have that later stage funding too. Lily Lyman, great to have some time, general partner at _venture capital _VC. Meanwhile, coming up, we're going to shift gears a little bit and talk about EVs in the context of the auto workers strike. It's underway, we know. They're pushing for a reset of wage scales and working conditions, and it could change the economics of car manufacturing, the future of it too. This is Bloomberg Technology.
Okay, so you're moving in on me. Quick. Distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right, I will concede. I can see. Got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
No, we're not fundamentally worried. We have a very strong business in China that has grown significantly over the last 10 years, and we're continuing to invest in China to make sure that we bring the product that the Chinese customers are expecting for us.
That was Mercedes-Benz CEO Ola Källenius there. After being asked whether he's worried about China's automakers and pricing wars, which are all global threats, legacy automakers here, like Ford, Stellantis, and General Motors, have been focusing on as well, except that now they also need to contend with another internal challenge, auto workers striking for better wages and working conditions. It's been going viral. Everyone has been talking about it through the weekend in the largest auto worker strike in years. And Caroline, what it comes down to, and what I hear is like this transition to EV, the Inflation Reduction Act, money, money, money. Does that money protect the jobs? Will there net be the same number of jobs when we all go electric as there are now?
It's the same conversation we're having around artificial intelligence as well. Just ultimately that technological innovation and investment ends up hurting the worker. Well, does it in this case? What did you...
Yeah, I mean, in the writers and actors strike, it's all about their copyright, their intellectual property. The funny thing is that no one gives a straight answer on the car side. Does an EV need fewer people to build than a combustion engine car? And we're still working that one out, Karen.
Oh, meanwhile, plenty to debate. And luckily, we're here for the whole week. That does it for this edition of Bloomberg Technology, though.
Check out the podcast wherever you get yours on the terminal and other platforms, Apple, Spotify, iHeart. This is Bloomberg Technology.
Bloomberg surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
One of the ones we're working on at the moment is how do we
charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We will be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment cost agreement on which we could lead the charge of air travel into a post-war Ukrainian recovery.
On the next episode of Hello World, meet the women driving Kyrgyzstan's tech revolution.
This is the first satellite in our country.
And some speedy horses. Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on Bloomberg TV.
Welcome to Bloomberg ETF IQ. I'm Katie Greifeld.
And I'm Matt Miller. Happy to have you back. You were gone for like a month.
It was just 1 week, but it felt like a month.
Felt like a long time. Let's get to the biggest stories right now in the more than $10 trillion global ETF industry. Countdown to the Fed. The central bank widely expected to keep rates on hold, but we saw the 10-year today hit 435, the highest level since 2007.
And the question, of course, is how high for how long? We're going to talk about that, plus the unloved rally. We're going to talk about that outperformance that we've seen both in high yield and leverage loans with John Kirshner from Janus Henderson.
It is also Climate Week. We'll discuss the drop in the popularity of ESG funds as protesters call on world leaders to end the use of fossil fuels.
And Matt, before we get there, as always, Eric Balchunas from Bloomberg Intelligence here with us now, taking a look at the flows. Eric, what do you got?
Katie, Matt, thank you. Katie, you called the unloved rally. I think that's a good phrase. It shows up in the flows here. I was going with ambivalence, but I think unloved works just the same. Now, this isn't to say there isn't flows going into equities. Look at the top of the list. IBV, VTI, the Qs, right? That's good. That's retail and trading crowd both getting into the market. And of the $22 billion into ETFs in the past week, only $2 billion of that went to Treasury ETFs, the rest into equities. So again, good. Let's look at the outflows though, and I'm going to hit you with some bad news. So look at the outflows. You're going to see SPY, IWM, VOO, so almost a reciprocal of what we saw going in. So this is a tug of war going on, so I can't say it's entirely bullish. But again, if you look in total, more money going to equities than out. And I said $2 billion is going to Treasury ETFs. You think, oh, well, that's good. It isn't really, though. The problem is there's something that's not in ETFs that is kind of bearish in a way, and it's a money market mutual funds. We now have to look at this because they now yield 5%, 5.3%. And so when investors feel like they want to take money off the table, they're going here instead of Treasury ETFs for the most part. This line here, you can see they took the summer off, but it's inching up again. And just 1 week, I know that looks like not much, that's $18 billion, right? That's a lot of money. That's because they have 5.6 trillion. So money coming into money market mutual funds is sort of like, hey, I want to be in equities, but I also want to hedge my bets being in the money market mutual fund and collect that 5.2% yield while I'm at it. So we're sort of seeing what we saw in the spring coming back in the fall.
It's pretty good. And Tom Keene is in triple leverage cash, which is maybe better than just MMFA index. All right, joining our conversation is Amanda Ribello. She is head of X-Trackers sales for U.S. onshore at DWS Group. And I'm going to go ahead and suggest that you change that. Because I don't get what you do from that. But
we can ask my boss for a promotion and I just take all of US.
You're basically running the ETFs here in the U.S., right?
The sales team, yeah.
Okay, so what do you think about this flood into money markets that Eric just showed us? I mean, cash is still king. Is that what you're seeing as well?
Yeah, so we do see a lot of clients still sitting on a lot of cash, and either they've gone into cash outright or they try to think about cash plus. We're speaking with our clients a lot about thinking you have to allocate to equities in some capacity, right? S&P is yielding about 1.55%, but you're against this almost 5% level on the cash side. So we're speaking a lot about European equities and in particular dividend strategies. So we're looking at HDEF, which is our high dividend EFA exposure, and that's yielding about 5.5%. So at least offering some value from that income perspective and also a low volatility versus S&P 500.
So dividend products, I would imagine, are not too hard of a sell, but what do you say about European equities, especially when you're talking to a U.S. audience, which already has a home bias, then you look at the outperformance of American equities. What's the pitch?
So the pitch is very much one of diversification. So I think a lot of us are feeling that U.S. equities are quite toppy. So S&P today is at around, I think, 4450 or so, something like that. Our end of year projection is actually 4100. So we think there will be a downturn. And then even when we think about longer term, we think it's only going to rebound to around this level in a year's time. So European equities, on the flip side, we see a lot of value there. Yes, we're a European house, but we do feel, along with a lot of our competitors, that there is some component for upside on European equities. So we like it from that perspective. Much lower volatility as well. European equities don't have the brunt of the tech names like we have on the US side. And then again, this diff story as well is really making sense. It's bird in hand theory ultimately.
And what about high yield? You guys introduced HYLB a couple of years back. You kind of undercut the high yield category, got a couple billion, and then BlackRock came in and tied you. And now State Street's come in at 5 basis points, right? And immediately seen flows. So I guess just get your take on whether high yield, because it's been a little unloved despite the higher yields.
Yeah.
And what about the fee war?
It is still relatively unloved. We do see a lot of clients still wanting to take, well, if they're not going to be in cash, then they're going to be on the IG side, and even within IG, kind of higher quality. But high yield, we think there's still an opportunity there. When we look at versus historical levels, the risk return profile, it's looking quite good actually. And what we think makes sense is to then think about segmenting within high yield. So looking at a low beta version of high yield, for example, like HYDW, that's basically looking at the higher quality names, the higher yielding names, the lower yielding names within high yield. So it's kind of a nice like in-between product. And that's where we think the interest should be going forward.
What about ESG? Speaking of unloved, right? I mean, certainly on this side of the Atlantic, that's not a phrase that people want to even use anymore.
Yeah, and it's interesting. It's climate week as well this week. What we see is there's actually a lot more distinction on the ESG side. So 4 years back, we were seeing broad-based ESG, but now we see, in terms of the flows and then also in terms of the products which are coming out, more climate focused. So we came out with our USCA product in April, largest launch in history, 2.04 billion. We see also a lot of clients thinking more about, okay, where can they put their money to work and what's actually having a bigger impact. And so we've actually put a paper out recently from our CIO office, which is linked to helping clients to think about which benchmarks to choose. So I think a lot of us understand that ESG more broad-based, the impact component is relatively little. But if you think about either climate transition, so companies that maybe haven't started yet to minimize their emissions but are looking to do so, they might be SBTI signatories, for example.
Right.
They might already be on the trajectory. This is making more sense than just outright thinking about removing fossil fuel emitters.
Well, that's what I'm really interested in. When you think about broad-based ESG, obviously the ESG umbrella has become politicized, weaponized, if you will. Is the solution then to just get specific, to narrow in that I'm talking about the climate here, or I'm talking about governance and how companies are run?
I think it's coming back to what are you really aiming to do? So ESG has become a little bit like a thematic or a marketing kind of term.
And you are a certified ESG analyst.
I am, yes. Which means that I've done my homework. Exactly, yeah. I think that's the thing. Like, we have a lot of people who are deeming to be ESG specialists, but do they actually have the training? At DWS, pretty much all of our investment platform has done this certified ESG analyst training. And it means then that we're genuinely qualified to be helping investors with that component. It's not just a marketing gimmick.
And look, I agree with you. I think broad-based ESG, it's hard to dislodge Vanguard and cheap beta, but adding it all on top is the way to go. I think you have one that I think is interesting, the green infrastructure.
Yeah.
So then you're giving money to companies that are moving this forward, and that does complement the cheap beta. Infrastructure, interesting, is the third most flow-getting thematic category this year out of about 20.
Yeah.
So talk a little bit about what makes it the difference between green and regular infrastructure ETF.
Yeah, so we're really proud of this product. I think a lot of people paid attention in the US market to the Inflation Reduction Act, and then prior to that in 2021, the IIJA. And so this product is aiming to provide a purer play into that investment, which is going to be taking place. So over the next 5 to 10 years, the US government is actually going to deploy another $370 billion into green infrastructure. So that's things like green mobility, things like electrifying rail, tolls, things like that. Additionally, things like green energy production as well. We think these are really important parts of helping the US economy to actually get back to its rightful place in the broader economy. When we look at the World Economic Forum, they've actually ranked US infrastructure more broadly as a score of 14. It was number 2 in 2002. And so,
so that's bad.
It's bad, but I feel like we want to do justice again to the US economy, and a lot of that hinges on having good infrastructure.
Amanda, great having you on the program. Thank you so much for coming in and joining us. Amanda Rebello, there of DWS Group. Coming up, this year's hottest options trade has found its way into the ETF arena for the first time. We'll tell you what that is next. This is ETF IQ on Bloomberg.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
Look, I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. What's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
This is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I found myself in a spot where I was constantly getting new challenges. A lot of, I think, the best mentorship I had at Bridgewater is because people often saw in me the potential to do things I didn't even see myself yet.
City. In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone. Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside? Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. Time now for the ETF Brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with uranium. Specifically, we're talking about uranium miners here. This is an ETF that tracks those companies, ticker URNM. It's up almost 41% year to date. A lot of that rally coming in the last month or so. And this is interesting because you look at uranium itself, only up about 32% year to date. So obviously those miners outperforming. Let's also talk about high yield, because one of the stories this summer has been State Street coming out and cutting the fee on SPHY, that's their high yield ETF, from 10 basis points to 5 basis points. And they immediately saw a return on that. You can see in August that ETF took in over $600 million. That was a record for this fund. So again, an immediate payoff for State Street there. Let's also talk about zero zero-day options. We haven't really talked about it on the ETF show. Now we have a reason why. Just to really put this into context, 0DTE, they make up about 40% or so of total volume on the S&P 500. It's the hottest options trade, Matt, and it's finally made its way into the ETF world.
Yeah, 0 days to expiry options. Let's talk more about this issue, Katie. Let's dig into it. Let's get into the weeds.
Why not?
Right now with Bloomberg cross-asset reporter Isabel Lee. This has been an options trade that has taken the market by storm, maybe made the VIX irrelevant. What do we know about 0DTE or what do we not know that we need to?
Okay, quick primer because you did ask me off air. What is it? So basically there are options that, bet in market direction, but what makes them unique is because they have a 24-hour expiry. So it's super short, which makes it super risky, but also cheap. Because we know that options are priced on their time value, and that's why it attracted a lot of retail investors, especially during the height of the pandemic when a lot of people had a lot of time. But also in 2022, big exchanges like SIBO extended it from 3 days to 5 days, and so that's why a lot of people like it. So this ETF...
Wait, 3 days to 5 days on 0 days?
Yes.
Oh, I get it.
Yeah. Yes. Yeah. Kind of a mind. So then this ETF utilizes 0DTE, and it's the first.
And that's kind of amazing that it is the first, given that this is, if we've been talking about it for, what, a year now? Usually it takes like 2 weeks for a theme to come into the ETF world. How did Defiance, that issuer, actually put this into this wrapper?
So they're the first, and when it comes to 24 hours, but then they're not the first that utilizes or sells options. We have JEPI, which is JP Morgan's equity premium income.
Yeah,
we know.
You know. So the difference is JEPI isn't daily. So this is daily, and they also filed for their own JEPI, but with a Y, and it tracks S&P, and they also filed for contracts that track Russell, but they haven't launched yet. Only the NASDAQ has launched. So it's really, sentiment check. A lot of people were divided. Some people were like, finally, but some people were also saying, how did the SEC approve this? Because it's very risky.
I mean, I'm in the finally camp, and I can imagine that they're very good at settlement and they can deal with this as long as they do it every day, which they are. Is it going to blow up even further the options trade, the ZDTE options trade?
It will give more access to retail traders, and that's why, I mean, you don't even have to know how this works. You can just buy an ETF, and that's
no
the
one knows
beauty
how
of
it works.
ETF.
Yeah.
We know a little about how it works. I know how it works.
Well, it'll be really fascinating to see how this ETF does. Of course, that's coming from Defiance. Isabel, thank you. That is Bloomberg's Isabel Lee. Now, still ahead, we're going to drill down into CLOs and that unloved rally that we keep talking about today. We're going to do that with John Kirshner of Janus Henderson coming up next. This is ETF IQ on Bloomberg.
Do you think there's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea. But technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
This is Bloomberg ETF IQ. I'm Matt Miller, and Kate Greifeld is back.
Kate, Katie, whatever you want. Eric Balchunas, though, from Bloomberg Intelligence, he's back with us now for today's drill down, where we focus on one ETF. Eric, what do you got?
Thanks, Kate. We're looking at J, that's what I call it. It's the Janus Henderson AAA CLO ETF. CLO is collateralized loan obligation, which is basically pools of senior secured corporate loans, and they float, right? So in an environment like this, people are looking for that kind of thing. It's actively managed. That's important. Janus is basically picking these for you. And the fee is 22 basis points. That's pretty good. That's really low for an active fund, which is part of the reason it has $3.9 billion. That is a stud hit ETF. It was also first to market. That helps a lot too. But you can see $3 billion or almost $4 billion shows how much interest there is here. Let's look at the holdings. You're probably not going to recognize a lot of these, but again, these are CLOs that Janus is picking for. You can see the weightings there. It's pretty evenly distributed. Now let's look at the return. So there's a BlackRock filing. Since this one was a hit, everybody has launched one now. I put BlackRock's here just as like the competitor, and I also put AGG, which is the total bond ETF, and TLT. And you can see both these are easily beating these two, right? So these are having good returns. And look at this. These are the two CLO ETFs. Look at the steady, non-volatile path. That is very desirable. Low volatility and almost no correlation to anything, kind of like gold or GLD. So Katie, look, low fee, actively managed, nice return, low volatility. There's a lot to like here, and that's why it's got $4 billion.
Eric, thank you. And joining us now to talk about this ETF, I'm thrilled to say, is John Kirshner. He is head of U.S. securitized products over at Janus Henderson. And John, Eric walked us through it a little bit, but let's just talk about how big this ETF has gotten, because right now we're staring at almost $4 billion. A year ago, that was about $1.6 billion. So it's really ballooned in size. Where is the interest coming from? Who's buying this fund?
Really, just a broad swath of our clients. Retail investors, institutional investors, pretty much anybody this ETF works for. And the reason why is, like Eric mentioned, it's floating rate, and it's non-correlated to a lot of other things out there. So what happened last year, the Fed started raising rates. A lot of fixed income products did not do that well, simply because interest rates went up, so bond prices went down, and a lot of fixed income products were down in double digits. JAAA was actually positive last year, and that has continued this year. So our message to investors is what you want is safety, liquidity, and a diversification benefit, and you're getting all those with JAAA.
I'll ask the dumb money question, which is my role on this show. I remember back in 2009, I was walking on the beach with Eric Schatzker, and we were discussing whether CLOs would come back. You know, that was kind of the dynamite that set off the great financial crisis explosion. Is there any reason that investors should be worried about? I know these are A's, right? But there's an ETF with B's in them too, right? So should we be worried about CLOs?
So I'm going to correct you there, Matt, because what happened during the global financial crisis was a CDO, not a CLO. Now, it's one letter, it's an acronym, I get it.
Debt loan.
Debt loan, but those were made out of, the CDOs were made out of subprime mortgages. Mortgages that should have never been issued. And because whenever you create something out of security that is fraud, what happens is when the housing bubble blew up, then all those securities blew up, and then whatever you made out of them blew up as well. So what happens with JAAA, it's made out of leverage loans. Leverage loans have had a very long track record of good performance through good times and bad. So even if we went into another GFC or another COVID, what happened with CLOs is they actually performed quite well during that time, and they're actually safer these days than they were back then.
So I want to ask a little bit about the correlation. I used to think gold was the king of zero correlation, which is kind of a holy grail, right? You're not correlated to anything, which makes it a good hedge or an alternative at least. You guys have better zero correlation to emerging markets, Bitcoin, TLT, which is Treasuries, the stock market. How does it have such perfect zero correlation to everything? I've never really seen something that's this zero to everything.
Yeah, I mean, we could talk about this for an hour, but bottom line is what...
We've got 3 minutes.
Yeah, exactly. So we're not going to talk about it for an hour. But bottom line, when the Fed is raising rates, that affects almost every financial asset out there, even gold, right? Because as rates go up, people say, well, I want to be in fixed income, not gold, because you don't get any cash flow over gold. Almost any asset out there will be affected by the Fed. Now, a floating rate asset like JAAA, it doesn't have a headwind from higher rates. It actually has a tailwind because that coupon keeps stepping up.
As long as they can pay.
As well, they can pay because the loans are the loans that make up the CLO are adjusting at the same time. So leverage loans as well, but leverage loans have a lot of credit risk. JAAA is just taking some of those cash flows and taking the safest portion of them, and that's why it's rated AAA.
So we've talked a lot about JAAA. Let's talk about JBBB, which Matt mentioned, because I thought this was pretty shocking. You take a look at total returns year to date. I mean, we're talking about almost 13%. Then you take a look at the inflows, and they really haven't been there. I mean, 23 million or so year to date. When you think about that compared to what we're seeing in JAAA, which is also sitting on positive returns year to date, why isn't there the same magnitude of appetite for these BBB loans?
I think there will be. A couple of things. The track record is obviously less. We launched it just over a year and a half ago. So people want to see, this is a new product. It's going to have more volatility. How is it going to react in different markets? JAAA is a very simple story because it is so high credit quality. But we are starting to get some small inflows into JBBB. But bottom line, what we said at Janus Henderson is, look, we want to make sure that we have a bit of a track record, that we show off our expertise in this sector, and then once we have that, we will go out there and pound the table. One other point about JBBB is everybody came to us when we launched it and said, when should I get in? When should I get in? What's the good timing? And the bottom line is, there's never a bad time, never a great time. Now, you know, if we go into some kind of downturn, maybe prices will go down, the yields will go up, and that might be a better time. But it's kind of like stocks. When you're trying to time stocks, it's really not a great thing to do because no one ever gets it right. If you want a high quality, high yielding product that's floating rate, JBBB is great. So I would recommend it.
So not much time left, but to your point that investors want to see more of a track record, is that the case when you think about some of these platforms, some of these wirehouses too, that basically this product hasn't been on the market for long enough? That's
exactly right, Katie. And so, look, we want to make sure our investors have a good experience. And so we tell them, we try to outline the risks and the reward, and then have them make their own decisions. But bottom line, JBBB will grow, as well as our new ETF that's coming out in November. Look for that one, and be happy to come back and talk about that in a few months.
Nice
John,
tease.
Yeah, it was great having you here, and especially explaining the difference between CDOs and CLOs. I think you did better than Margot Robbie, so I appreciate it. John Kirshner of Janus Henderson. If you just can't get enough of ETFs, by the way, a reminder, you can listen to Eric and Joel Weber on their podcast, Trillions. It's bi-weekly. It covers the industry. Does that mean every 2 weeks or twice a week?
Every 2 weeks.
Every 2 weeks. That does it for Bloomberg ETF IQ. I'm Matt Miller with Katie Greifeld and Eric Balchunas. This is Bloomberg.
From the world of politics
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
and Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee
The
Lines.
door was open for regulators to do more. And that puts the Fed between a rock and a hard place.
As they deliver news
This is such an important economic issue.
He's no longer trying to run away from
That really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with 2 more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Okay, so you're moving in on me quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
My knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
Just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right, I will concede. I can see. Got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
I'm John Oliver. Welcome to Bloomberg Markets.
And I'm Matt Miller. Let's get a quick check on where the markets stand at this hour. We've had some pretty fascinating levels, I think, today. The S&P, not among those. Right now, it's up 0.25%, 44.61, 44.62. So a little bit risk on. It's a Monday, and it's got that feel. The U.S. 10-year yield is what I think was interesting. This morning, we hit 4.35, I believe, which is tied with the highest yield on the 10-year Treasury since 2007. So really pushing those upper bounds. The Bloomberg Dollar Index now down 1.5 to 1252. Still feeling pretty high, near its 20-year highs. Okay, last year it was up another 100 points, but it's been pushing this year. And then NYMEX crude. Right now it's only up 10 cents to $90.87. I have seen a 92 print for the day on NYMEX on WTI, and I've seen 95 on Brent. So we're looking at pretty high prices for oil as well, John.
So much attention on what's happening in the crude world right now. Let's also take a look at some individual movers in the equity world right now. I'll start with Nikola. Nice move higher, about 32% on news of a new COO. Staying with the technology theme, you're looking at ARM Holdings right now, down about 9%. And that's kind of interesting as we await the pricing on the Instacart deal. Bernstein with some cautious comments after the high-profile IPO of that design chip design player. And then Lyft shares down about 3%. News of an SEC settlement dating back to before the IPO, a stock transaction that had taken place. But in getting that feel for Lyft and Nikola and obviously the auto sector, we have to, Matt, take a look at what's happening at this hour for General Motors and Stellantis shares as we continue to track the story for the UAW strike. And obviously, a lot of the analysts on Wall Street are trying to piece together what the financial impact will be. Really depends on how long things go. For now, we're seeing Ford, GM, and Stellantis shares in the red.
Yeah, fascinating story that continues into its fourth day, the fourth day at least of the strike. The story's been going on since before they left. UAW President Shawn Fain continues to say his union workers deserve more from their employers. Here's how he put it on CBS's Face the Nation this week.
We're prepared to do whatever we have to do. So the membership is ready. The membership is fed up. We're fed up with falling behind. It's been decades of falling behind, and especially this past decade, in the most wealthiest times in the history of these companies. There is no excuse. These companies have made $250 billion in the last 10 years, $21 billion in the last 6 months alone. And our workers' wages and conditions have went backwards.
So there's the view from the head of the UAW, Keith Naughton, covering every twist and turn for the Bloomberg team and the auto sector, broadly speaking, from Detroit. Keith, where do things stand right now? What do we know at this point?
They are still far apart. I mean, the latest proposal from Stellantis took the pay increase offer up to 21%. GM and Ford are at 20%, but the union is still at 36%. So there's a very wide divide.
I wonder if they've gotten back to the levels they were at pre-financial crisis if you adjust for inflation, Keith. I mean, they gave up a lot. Are they going to get that back even with a 20% increase?
Yeah, you know, even before the bankruptcies of GM and Chrysler in 2009, you know, auto worker wages, real wages, have been in decline for a couple of decades. So it's going to take quite a bit to claw back all of that. I'm not sure it can all be done in one negotiation. Sean Fain thinks it can be.
And speaking of Sean Fain, Keith, and you helped to write a pretty extensive Business Week piece, we are getting lessons, it seems like, every day in the approach that he is taking through this with his team, with his social media, et cetera.
Yeah, it's a completely different approach. You know, he stood up Bill Ford, the chairman of Ford and the great-grandson of Henry Ford, when Bill Ford showed up to negotiate and offer what the company said was their best offer ever. Sean Fain wasn't there.
What about the request for pension benefits? You know, they were getting those before they gave them up to help the automakers operate more sustainably, and now they're, you know, making record profits. But then they ask for a 4-day work week, which, does that not seem a little bit silly, Keith?
Those are two of the biggest asks that they have on the table. They've started backing off the 4-day work week, but in exchange for that, they want a lot more paid time off. On the pension point, I think they're trying to make a point that there are still a group of people who get traditional pensions. They're called CEOs.
All right. I mean, $20, $25, $30 million a year and pensions. They could maybe give some of that up in negotiations. Keith, thanks very much. Keith Naughton talking to us about the negotiations, about the strike that we are seeing now in its 4th day. Earlier today, we've been talking a lot about cars. I caught up with the CEO of Mercedes, Ola Källenius, about the strike and its impact on his business.
We don't expect any major impact on our business. And of course, Mercedes-Benz doing business in more than 150 countries and have operations in all major economic regions. We try to make sure that we're competitive, that we're an attractive employer. But at the same time, we're in transformation. The auto industry is getting more competitive, not less competitive. So whatever pressures we have on cost is going to have to be made up in productivity. So I think we have to be very mindful to keep the gain on productivity up. If I look at what's happening at Mercedes-Benz around the world, and primarily in Germany, where we have most of our operations, yes, we're investing heavily into the new technologies. The lion's share of our capital allocation goes into electrification and digitalization, and we're creating new jobs there. But the fact of the matter, on the powertrain side of things, the net at the end of this transition, which is a 10-year plus affair, is going to be less jobs on powertrain. On vehicle assembly, it's about the same, but we will use demography over this 10-year plus period, our demographics, to make sure that we can get into a position where we do this in a sensible way.
All right, well, let's bring in Tyler Thiel, Vice President, CEO, and Director of Public Policy for the Anderson Economic Group. That firm's stats on the economic impact from this labor disruption have been getting a lot of attention, including here at Bloomberg. Tyler, great to have you with us. I guess as people are trying to figure out the economic impact for every additional day of strike action, there's a few different components that go into that. Can you walk us through how the math breaks down?
Sure. Thanks for having me. Well, last month it seemed unlikely that a strike would occur against all of the Detroit Three. However, our analysis properly took into consideration the magnitude of impact in the industry and in the economy as a whole, if that were to happen. So while we look at these targeted strikes against each of GM, Ford, and Stellantis, we consider a couple of important categories at the top. So the first is obviously, and of course, the lost wages to the workers on strike, the loss of their economic spending power in their local economies. So that's going out to eat, going to the movies, buying kids new shoes. These are all things that UAW workers on strike might be cutting back on doing during that time. And, you know, we know they voted to go on strike, but they didn't necessarily vote to lose a month or a month and a half of wages. So we looked hypothetically at a 10-day strike, and we calculated that the losses could exceed $5 billion in a 10-day period with all three. So again, we talk about the lost wages there. The next category we look at is losses to the OEMs, less those wages that, of course, they're not paying. We look at very conservative industry multipliers, losses to dealers and consumers, and then that's where we get that total of potentially over $5 billion in 10 days.
And Tyler, what are you going to be monitoring to try to determine, you know, whether this gets to 10 days, whether we go beyond 10 days? We were talking to Keith Naughton before, who cited a consultant who said, if you get all the way to Halloween and people are still striking, there's probably going to be a growing conversation among the workers about the need to get back to work. But what are you going to be watching closely as signs that give you an update on how things are playing out?
Certainly. Well, to me, inventory is a major important indicator to be looking at. So inventory varies greatly among specific makes or models and among manufacturers. If we look at a very rough average, we're hovering at about 55 days inventory. Again, that's very different from different data sources. However, this is about 1/5 of where we were when we sustained a 42-day strike against GM in 2019. So we have been attempting to estimate loss of units. So we're looking at a little under 10,000 units per location for a 10-day strike with the locations that are currently on strike. And when we talk about this inventory and how it affects consumer and dealer losses, I mentioned that 55-day mark, but we have dealers going on the news saying prices may increase after 30 days. And so that's where you see changes in the automotive industry, changes to consumer behavior, changes to insurance rates that those consumers get on those vehicles they may purchase. So when we estimate losses of units, there are kind of three ways you can consider that loss. One is a substitution. Consumer simply goes down the street and buys a foreign brand because they don't have certainty on their domestic vehicle purchase. The other is a delay. You know, there's always hope that the domestic brands can work overtime after a strike. The workers can earn more and make up for lost time on vehicle production. And the third is complete loss. If a consumer, completely loses confidence in the opportunity for a short-term vehicle purchase, and they delay that vehicle purchase significantly.
Tyler, how hard is it to do this kind of research when the automakers are hitting individual lines? Right now, I think they have hit Bronco, Colorado, and Wrangler. That's very different than if they strike at the Rouge, right? And they stop the F-150 production, or if they hit GM on Silverados or Tahoes. It's a very different kind of strike.
Certainly. I think these strikes are incredibly targeted to hit pain points, but maybe not come out, showing all the cards and hitting the absolute most painful points. These production facilities and assembly facilities that are affected are some of the higher producing of popular brands like the Bronco. If you've tried to order one, you know that it could be a long wait. And this adds to that wait, adds to that uncertainty, possibly removes purchases. That said, some of what's happening is exactly what we expected last week. I was very skeptical that these targeted strikes could allow for the opportunity for fewer losses in other areas. And the additional layoffs we see, like I said, are exactly what I expected, because the OEMs are keen to cut costs at any facility that may not be able to operate efficiently during the strikes. And so we see those multiplier effects in the automotive industry, in the production and assembly process.
The last week, Tyler, I've been asking competitors. You may have heard I asked Ola Kalenius, but I've also asked other foreign brands how this affects their U.S. production in terms of supply chain difficulties, and also in terms of the wages that they pay their own workers, right? If union workers are already getting more, and then they get a 25% increase, you can see the foreign workers going from those plants up to Detroit. How much of a difference is it going to make to those that aren't directly affected by the strike?
I think if the strike is lengthy, foreign automakers have an opportunity to sell more vehicles, possibly at a slightly higher price. But I was watching that interview as well, and I think he hit the nail on the head with some things. The contract negotiations here have to end in a very sustainable result. We cannot go back to what we saw in 2007 and 2008 that resulted in the bankruptcies. We don't want to push our domestic automakers to invest even more heavily in workforce reduction advancements because they can't afford to employ workers. So the UAW workers deserve a fair contract, and hopefully that can happen in a way that creates stability and balance within the U.S. automotive industry, because as we've seen, the European automotive industry, with a smaller industry, smaller number of workers to work with, may have a leg up in their ability to adjust and measure against what happens here.
Tyler, great having you on the program. Thanks very much for joining us. Tyler Thiel there, Vice President and Chief Operating Officer, as well as Director of Public Policy for Anderson Economic Group, talking to us about the strikes. Coming up, U.S. airline stocks are under pressure today as well. That's because Brent crude hit $95 a barrel. They are the focus in our Stock of the Hour next. This is Bloomberg.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think, within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under-tightening would be a worse mistake than over-tightening, because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
This is Bloomberg Markets. I'm John Oakman with Matt Miller. Time now for our stock of the hour. We've been watching the airline stocks today. Names like JetBlue under pressure. JetBlue at its lowest level in about a decade. The industry feeling some jitters from investors right now after a big summer of travel. Investors getting nervous about bottom line performance, Matt, for the carriers with these higher jet fuel prices and rising labor costs, and whether airlines are going to be able to raise their fares to offset those mounting expenses.
All right, let's talk about that a little bit with one of the best voices in the industry. George Ferguson covers airlines for us here at Bloomberg Intelligence. And George, we are seeing a big jump in, I guess, the crude prices as well. I'm not as familiar with the jet fuel market, but those, as you would expect, those prices are following. What does it look like to you, someone who's steeped in this industry?
Yeah, I think you framed it pretty well in the beginning of the session. Fuel prices have popped pretty quickly here. They popped 50% since last quarter. I think airlines had dialed in the right level of fares to manage those higher labor costs. But again, fuel, a bit of surprise. It's really knocked the heck out of earnings estimates for 3Q. It felt like as we closed 2Q that there wasn't going to be enough strength in demand, I think, to keep fares up. We'd already seen domestic fares starting to slip. And I think the challenge here is, with domestic fares already at some near records, when you add higher fuel costs to it, I just think it's impossible for the airlines to get the right fare increases to manage these increased costs. So to us, it looks like as we go into 4Q and 1Q, profitability is probably sliding because of these higher costs and weaker demand.
What, George, would the companies possibly consider then if they don't just want to accept some weaker bottom line performance and present that to Wall Street? Are there other things they might be thinking about right now?
I mean, this is the real challenge of this business, right? It's that once you buy an airplane, you really want to fly it. And so what probably needs to happen is capacity probably needs to be brought out of the system. Therefore, you could keep fares higher. I just don't see that happening right now. I think it's too early. Like I said, demand has softened a bit, but I think the carriers will try to fight over market share. And as you do that, fares slip further. But I think what needs to happen is capacity needs to come out of the market.
All right, well, we'll see how it all plays out. George, great to get your perspective as always. Bloomberg Intelligence senior airline analyst George Ferguson joining us, and we'll continue to track the airline stocks themselves. But we're also tracking the auto sector, of course, and from the Maserati perspective, the CEO giving his perspective as parent company Stellantis deals with the auto strike. Quick to pin the blame for the UAW strike on President Biden and Democrats. Former Vice President Mike Pence did just that when speaking on Friday to Bloomberg.
The heavy-handed effort with their Green New Deal to use taxpayer dollars to drive these companies away from the traditional manufacturing that so many UAW workers have made it in. I think that's what brought us to today.
What do you like most about your job?
I think
think the people, I mean, ultimately we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. What's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, probably I try and play that role.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
This is Bloomberg Markets. I'm Matt Miller with John Ehrlichman. The CEO of Maserati, Davide Grasso, says it's still unclear what the long-term ramifications of the current auto strike, which his parent company Stellantis is involved in, will ultimately be for all of the other automakers out there. Of course, Maserati is produced solely in the country of Italy, so not directly subject to UAW strikes. I asked him nonetheless about his thoughts as well as the state of the business. Take a listen.
Clearly, we're a global brand, and for us, North America is an important market. So, we look forward to the resolution of this because longer-term impacts will be on everybody. I mean, on everybody in every sector. So, so far we have not been impacted, but the long-term ripple effects, it could be far-reaching for everybody. When you work in luxury, the focus is not on volume. If you want to be healthy and delivering to the customer needs over the long term, you have to focus on profit. And on quality, of course. So without quality, these are the two fundamental elements of our plan. Without quality, you don't have luxury. Quality brands, luxury brands, even in other fields, normally are like 100 years old, and they were born as a high quality brand, right? And over time, you become luxury because you are very steady in delivering luxury. The other thing you need to do is you need to have your added value recognized by the customer in pricing, right? So we put a lot of effort in that and rebalancing and redefining our business model, and we have now a 9.2% AOI, adjusted operating, and margin. And our goal is there's no reason why we shouldn't be at 15% first, which is like benchmark, and above 15%.
Now, as Davide Grasso talking, John, about really a new slate of Maserati products. They have this supercar out, the MC20, and from that Neptune V6 engine, they've derived more affordable products, although they're still expensive, obviously, for the masses. One being the Gran Turismo you're looking at there, as well as the Grecale, which is their sort of mid-size SUV that you can see there. The question is, are there going to be any impacts on this Italian brand from the U.S. strikes?
It's a great question, and obviously it was a great conversation you had there. We'll continue to track that part of the auto sector and what's happening in Detroit and beyond in other parts of the U.S. with the strike right now. For Matt Miller, I'm John Ehrlichman. This is Bloomberg.
There's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere.
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
From New York City.
From London. In Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Oil gets costlier, treasuries get cheaper, and equities, they remain a spectator. Live from Studio 2 at Bloomberg headquarters here in New York, I'm Romaine Bostic.
And I'm Katie Greifeld, kicking you off to the closing bell here
and welcome
in the
back,
US.
Katie.
Thank you. It's thrilling to be back, and you're looking actually at a bit of a rally to welcome me back. A little bit. We're looking at the S&P 500 about 0.2% higher. Big tech even more so. The NASDAQ 100 up by 0.3%. I will note that's on pretty light volume, of course, as we await that Fed decision coming on Wednesday. You go down the board, the story gets more interesting. You're taking a look at Treasury yields. They're actually a little bit lower right now, to the tune of 2 basis points on the 10-year. We got as high as 4.36% earlier today. We'll see how that changes this week. And like Romaine mentioned, crude oil. Oil in general, really the story of today. Crude oil in particular up about 0.2% above $90 a barrel.
Yeah, $91. Hard to believe, Katie. You remember back in late June, we were actually flirting with year-to-date lows on crude oil. But right now, WTI rallying more than 30% in less than 3 months, and now just a few cents away from a fresh 52-week high. Brent futures in London, a nickel away from $95 a barrel earlier in this session. And the debate now intensifying as to just how much further prices are going to rise. Ed Morris and his team over at Citigroup, they actually see oil easing soon as a result of supply increases at countries that aren't named Saudi Arabia or Russia. But oil executives, not so sure. Chevron CEO Mike Wirth sat down with Bloomberg Television today. He says $100 a barrel is coming soon.
The trends would suggest that we're certainly on our way. We're getting close.
Mike Wirth there, his comments actually backed up by the latest CFTC data, which showed hedge funds increasing their bullish wagers on Brent and WTI to a 15-month high. Meanwhile, that same CFTC report showed investors still net bearish on U.S. Treasuries, suggesting rates will continue to move higher. Asset managers, net sellers of Treasury futures in the past week, and while leverage funds were net buyers, they still as a group remain near record net short levels. The shifts in positioning indicative of that raging basis trade we've been talking about, where investors go long a Treasury while shorting the corresponding future. The Bank for International Settlements in its quarterly report released today, warning of potential instability as a result of that trade, saying hedge funds have built around $600 billion in net short positions in Treasuries, which would be comparable to the levels leading up to the repo market turmoil that we saw back in 2019. And of course, the pandemic-related Treasury market dislocations in March of 2020. But of course, the direction of Treasury still highly tethered to the direction of inflation-adjusted rates. Remember, the bulk of the increase in nominal 10-year yields over the past year or so is due to these so-called real rates, or, as some people call it, Katie Greifeld, real yields, which I think might have a better ring to it.
Might have a better ring. There's a great show on real yields, 1 p.m. on Fridays. But in any case, it's Monday, and you're taking a look at real rates really across the spectrum here, across tenors rising to the highest levels in over a decade in some cases. And as Romaine said, these are inflation adjusted. These are real rates. And as such, they're seen as a proxy on growth expectations. So you could look at this chart and say, maybe that's good news that real rates are rising. But again, you think about nominal rates, it's real rates plus break-evens, those inflation expectations, which bring us back to oil. The fact that oil prices have been rising so mightily, you've actually seen a bit of a divergence open up between WTI crude and 2-year break-evens, which, as you can see, are very strongly correlated to crude prices. So we'll see if that white line, those 2-year break-evens, catches up with that blue line, Romaine, and what that means for the direction of travel of overall yields.
All right, a big macro week this week as we kick you off to the close on Monday. Sonali Peer joining us right now, portfolio manager of high yield and multi-sector credit over at PIMCO. And Sonali, I do want to start off here with what we're seeing first in the rates market. The general, not just the trajectory of yields, but this general idea here, I guess, of how restrictive right now the bond market, the fixed income market, if you will, is showing us.
Yeah, certainly. Thanks for having me first. Wednesday we are expecting essentially a hawkish pause from the Fed. At this point, the bulk of the move is behind us, and I think what we're trying to digest here is the lags of monetary policy and the transmission mechanism from which we will see different industries, different markets try to adjust, and that's essentially what we saw earlier back in March with the regional banks. And so, we're really here trying to digest a lot of what's to come, given much of the debt has been termed out and so hasn't had the full bear of the rise in rates yet.
Well, then when we talk about positioning right now and the idea that there are still a lot of people still kind of, just magnetized to that shorter end of the curve here, is there anything that sort of breaks that trend?
I think it's exciting when to get that type of yield in the front end, especially given where we've come from. But the reality is, in order to have comfort around returns in the future, that's a yield you're renting. In order to own it, you've got to go out the curve and really fix it in, right? And so, while the curve is inverted and you're getting paid pretty well on the front end, in fact, I would say it's probably worth going further out and picking up some spread as well in perhaps credit markets, agency mortgages, and the like.
Is duration risk more attractive at this point than credit risk?
It's a good question. I would say actually fixed income generally is more attractive, right? So obviously we've had a pretty big repricing from the Treasury market. But when you think about the all-in yields and the income it generates, it's a question of risk appetite for sure. But, our preference is kind of the higher quality spread. There's also, where we are in the cycle and the potential for a recession or not, although the market has coalesced around a soft landing. All in all, when I look at this, you can see that, we've seen flows, say, in strategies that offer a little bit more flexibility, and where clients have liquidity. You're right. We haven't seen significant inflows into high yield yet, but I think part of that has to do with the uncertainty out there. And should we be able to have more certainty in the broader economic outlook, naturally that could lead to inflows into lower quality credit.
I am curious if I can get your thoughts here, Sonali, on what's been going on in the mortgage bond space, at least relative to it being an attractive opportunity against the backdrop of what you can or maybe cannot get in the corporate bond space.
Yeah, so agency mortgages have repriced quite significantly, especially with the Fed now not a net buyer of the lower coupons that were being produced in the back half of 2020 and in 2021, and as a result, valuation has changed considerably. We haven't seen these level of spreads on agency mortgages even post GFC. Levels were lower than this, so we think this is an opportunity, certainly vis-a-vis, say, single A corporate cash. This certainly looks like an opportunity here that we find attractive.
All right, great conversation here. Great way to kick off the show with Sonali Peer over at PIMCO. As we kick you off to the close, a conversation coming up here about the UAW strike and the hardball tactics that Shawn Fain, its leader, has taken. We're going to sit down with a person who actually wrote the book here on a lot of the union organizing tactics that we're using today. Jane McAlevey over at UC Berkeley going to be joining us in just a second.
And sticking with our coverage of the summer of strikes, we're going to keep the conversation going with Mary Kay Henry, the president of the Service Employees International Union.
And we're going to sit down here with the second biggest miner in the world, the CEO of that company, Rio Tinto, as Climate Week and the UN meetings in New York kick off. We're going to get his thoughts here on how his company, and more importantly, the broader mining industry, can contribute to that fight against climate change. That conversation and so much more. This is Bloomberg.
Okay, so you're moving in on me quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
Just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. Got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
What do you have for skincare for men in their 70s that have a lot of wrinkles? I mean, is there any way to get rid of the wrinkles?
I have a lot of amazing things,
Really?
but maybe it'll be a little bit beyond skincare.
Oh.
All right, well, let's get the latest on the summer of strikes with the walkout by auto workers in its fourth day. Joining us now to discuss is Bloomberg's Detroit Bureau Chief David Welch. And David, on that note, 4 days, are these sides any closer?
Maybe a little bit. I mean, the union is still rejecting offers. They've rejected everything on the table. I think if you want to maybe reach for some hint of progress, the union said they made progress with Ford over the weekend, and they said they met with GM without elaborating, and look, maybe it's good news that there's an absence of anti-corporate rhetoric coming from UAW President Shawn Fain. But he also did say that the offers still aren't good enough. So, look, they're probably closer in the sense that the pay raises that are being offered are much bigger and kind of, maybe getting somewhere near where the union may settle. But so far, he says it's no good.
I think it's interesting, too. I mean, when we sort of look at the structure, I guess, of what Shawn inherited with regards to the UAW and the great story that you and your colleagues wrote today, David, about kind of how we got here. I was actually kind of surprised to learn that he was the first president to actually be elected directly by the membership here. And I'm curious as to how much that changes the complexion of how he's negotiating.
Quite a bit. There's a lot of politics in the background of the union right now. First off, the past two presidents did time for stealing from the union itself, so there's no trust. And that explains to a degree why Shawn Fain is negotiating openly and showing a lot of the union's offers and a lot of the company's counteroffers, so the members know what's going on. These deals were always done behind closed doors, and then a tentative agreement would be put forth to the membership and they could vote for it or not. So there's this aspect of having to show the members that he's a real union leader, he's honest, he's trying to get a great deal for them, because there's, in addition to the money that was stolen, there's the idea out there that the past two presidents were taking graft from the companies and kind of lying down in negotiations and not really fighting hard. So he has to prove that. And remember, too, he was elected directly, but he also won in a runoff by a very narrow margin. So he's got to prove to, almost half the union members who voted that he's the real deal, and that even though they voted for somebody else, he's the guy who should be running the union. And so he's got to get a good deal. And look, the deal he has, the pay raises are already better than any of the deals they've gotten in history.
Yeah.
So from that perspective, he's won. But now it's, there are other things on the table that he's trying to get.
All right, David Welch out there in Detroit, keeping an eye here on the strike and the potential for folks to get back to the negotiating table. We want to continue this conversation right now with Jane McAlevey. She's a former AFL-CIO organizer and currently senior policy fellow at the UC Berkeley Labor Center. And as I said before, for the most part, kind of wrote the book on some of the modern tactics that these unions use, not only to organize, but of course in these strike situations, Jane. And I do want to get your general take here on, I guess what at least publicly seems to be very hardball tactics that Shawn Fain has taken here. What do you generally make of that as a negotiating strategy?
I mean, I think it's both good, and I think building on what David Welch had just said, there is a very large audience and a diverse audience inside of the union that this new president has to satisfy. So I think his negotiating posture is good. I think he's signaling we're not messing around. There's been 40% raises given to the shareholders effectively and to the CEOs for a long time, and we're coming back, right? We sacrificed for you in 2007 and 2008. You asked the working class and the workers who build the profit margin that the CEOs and the shareholders have been pulling huge hundreds of millions down from. So I think the negotiating posture is a good one. It's a little bit dangerous in the sense that his expectations for the members are raised quite high. So how you come from a set of demands as significant as they've put out there and then walk them back into a settlement is going to be challenging. And the part that's not getting as much attention in the media is something that's super important, which is how the union is going to be able to relate to and find an agreement to organize in the expanding EV electric sector cars, as well as in the battery plants. I think it's a more complex issue than talking about wages, but it's as fundamental to what they have to reach in a settlement as the wages are if there's going to be a future United Autos worker in this country, honestly. So we might touch on what the implications are for the piece that's being less spoken about, because it's a little more complicated than just wages, which most people understand.
Jane, I want to talk a little bit more about tactics here. Like Romaine mentioned, those hardball tactics. And like you said, it seems to be playing out pretty well for Shawn Fain. Dangerous, though. When you think about some of the other strikes or potential strikes percolating in this economy, do you think that maybe the writers and actors, maybe some of the hotel workers will take a page out of Shawn Fain's book?
actually think I think they're ahead of him. The hotel workers, in fact, are using the same strategy in the gigantic Los Angeles strike. They are announcing which hotel will be struck which day. So you could argue that actually Fein is borrowing some of the tactics. And again, these are not brand new tactics. It's just that we have not had large-scale strikes in so long that I think the general American public is not even familiar with what good strike tactics are. So this is one that can work very effectively as a threat to say, and if you don't come to the table with more reasonable demands, we're going to start to escalate the number of facilities we're targeting, and it could become a full-blown national strike. So they're really putting that choice to the CEOs of these companies and to their negotiators and saying, we're giving you time to work this out with us, but if you don't, we're going to escalate. So I think on every front, what's fundamental, and this goes to the EV transition, electric vehicle transition that the auto workers are dealing with, what's fundamental is that every strike you just listed, the issues are structural that the workers are fighting over. And structural fights are much more difficult to win for the working side, the working people, than are raises, because we know the companies are just overloaded with money now. You do the numbers on any one of whether it's the Marriott Corporation, where the hotel workers have their primary fight, whether it's the big folks sitting in Hollywood and the Netflix and the streamers for the writers and actors, or whether it's the big three.
Yeah.
The structural issues on the table are much harder to get at around the role of future technology, right? That's what's at the heart of all of these, almost every strike that's happening right now.
That's a great point, Jane. And I am just curious then, going back to just strictly with what the UAW is dealing with, then does that maybe, is it maybe more advantageous that he did choose to go after all three automakers at once rather than just striking, say, at GM and then Ford and then Stellantis at some other point?
I think so, but I think it also means that there was not a good front-end deal, right? The reason that you pattern bargain, so pattern bargaining is the tradition of what the United Auto Workers do, and they may still try to do a pattern bargain here. But I think that they had to hit all three at once because the companies, I think, are collaborating quite tightly on this, like the AMTPA is, right? When the managers in the Hollywood strike, they're pretty tight-lipped so far, and it seems like the big three at the management level are pretty tight-lipped so far about what they're doing in their strategy. So they may have forced a situation where Sean Fein and the leadership of the union had to say, we're going to go after all three of them, because no one here is acting like they want to come forward with a reasonable agreement from which we will then set that as the pattern. Walter Reuther, the founder and leader for many years of the United Auto Workers, through its heyday, was famous for creating the tactic of pattern bargaining back in the 1940s. So that wasn't obvious to Sean Fein and the leadership. That tells me that not one of those big three companies was ready to come forward with the kind of agreement that would let them settle first and then really go after the other two.
All right, Jane, we got to leave it there. Really appreciate your time today. Our thanks to Jane McElvey, Senior Policy Fellow at the UC Berkeley Labor Center. Now, coming up on The Close, we're going to talk with the CEO of mining giant Rio Tinto, who's in town for the Climate Week meetings in New York. This is Bloomberg.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think in the first within 6 to 12 months open up 3 or 4 large bases in Ukraine, and we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
All right, one of the biggest rallies cross-asset rise right now is in the energy space. Brent crude right now sitting just above 94 bucks a barrel. WTI crude above 91 here, and a big question now about how much higher it can go. Julia Fanzera is joining us right now, who covers this sector for us here at Bloomberg, and a lot of chatter here about $100 a barrel oil. Why?
It's something we hadn't been hearing about in a while, but after Saudi Arabia and Russia extended their production cuts, it seems that oil's momentum is moving forward. I do think that we have to take into account that a lot of this momentum that's pushing prices forward is not the fundamental oil players, it's the algorithms. And so traders have really been looking for a potential pullback because right now all the technical indicators are saying that oil is slightly overbought.
Well, one of the shops looking for a pullback here is Citigroup's Ed Morris, saying that basically if you look outside of OPEC+, you should see supply coming from some of those other countries. How widespread is that view?
I think that Ed Morris is still in the minority at the moment thinking that, because a lot of traders are saying that right now being close to $95 a barrel for Brent, but not exactly there, is fair value for oil. And I think it's interesting because I think in the note he added that geopolitics could also push oil over $100 a barrel. And that's really something for Ed Morse to say that. And so I think that is also key.
It's interesting, too, and we heard from Mike Wirth, the CEO of Chevron, earlier on this network. He actually does see $100 a barrel coming pretty soon here. And if you look at the time spreads out there, this is clearly a supply-driven issue. Is demand not a factor anymore, at least not in any material way?
Demand will always be a factor, but it's definitely not at the forefront of everyone's mind right now. It is very much a supply-driven rally, as you said. I think it's interesting because at the World Petroleum Congress in Calgary, Saudi Arabia said that they're actually saying that the jury's still out for China demand, and that also additionally that Aramco isn't really seeing demand hit 125 million barrels a day, that they're actually tempering it back. So I think that is also incredibly interesting, that some of these demand outlooks might have been a little too optimistic.
And so we're all fixated on $100. It's a nice round numbers. There's 3 numbers in there. Are there any other levels that we should be watching here?
I think that we should be really watching diesel prices because diesel has actually far outpaced crude. It's at its highest seasonal level on record, which means that Americans and people worldwide are also going to be experiencing higher costs of heating. And I think that's really important for us to look at and not ignore that either.
All right, Julia Fanzeras covering all this for us here at Bloomberg. A modest gain in oil prices on the day, but of course that's on the back of what's been roughly about a 30% rally over the last 2.5 months or so. We go back to the broader markets, Katie Greifeld, and we have a market that I guess is kind of in a waiting pattern. Now, you were gone for a week. I'm not sure exactly what you were doing in your clandestine days off here, but the market did nothing while you were gone, by the way, and it looks like it's kind of continuing that here on this.
You know, I was looking at the price action. It seems up until Friday it was kind of tame. Then you saw a big decline in the S&P 500.
It's called triple witching.
Triple witching. I've heard a little bit about that.
Yeah. All right. Well, the VIX slightly elevated here on the day, but still well below some of the historical averages. We'll be back in a moment. This is Bloomberg.
do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. What's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
On the next episode of Hello World, meet the women driving Kyrgyzstan's tech revolution.
This is the first satellite in our country.
And some speedy horses. Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on Bloomberg TV.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Welcome back. Tens of thousands of people took to the streets of Manhattan in New York yesterday to protest against the use of fossil fuels. The rally coinciding with the start of Climate Week here in New York as world leaders in business, politics, and the arts meet to discuss actions to cut greenhouse gases. The CEO of Rio Tinto, Jakob Stausholm, is one of the leaders attending, and pleased to say that he joins us now here in Studio 2 in New York. Great to have you here, and this is obviously going to be a week where everyone's going to be focused on what's going on with the climate and the fight against climate change. For some people, it may seem counterintuitive that the head of the second largest miner in the world would be at the forefront of that. What role do you play? Does Rio Tinto play?
So climate change is actually really at the heart of our business. We're not in fossil fuel extraction, but we do have a big carbon footprint, and we need to address that. We have set targets to reduce it by 50% by 2030. But even more importantly, if you think about what does it mean to address climate change, it's actually about building a whole new energy system. Mm-hmm. It's about electrifying societies. It's a very physical change. It will require a lot of investments, and you can't do it without the critical minerals that we are producing. We are the Western world's largest producer of aluminium. Mm-hmm. We are a major producer of copper. Those are the two most important minerals. But also battery materials is growing a lot right now. So it's highly relevant for us to be part of this.
Well, there's been a lot of talk about the need for more lithium. Not necessarily a rare mineral, but certainly something where the capacity to mine it just quite isn't there here. I know you have some projects, at least one big project in South America, and there's been there's been reporting by Bloomberg about a project in Western Australia as well.
Yeah, so in Western Australia, we're doing exploration many places on the planet. We have another project in Serbia that we would like to progress on, and we are, as you say, building in Argentina right now. But we're actually doing exploration on a number of continents right now. It's not that lithium is ever going to be as big as copper and as aluminium, but the point is the current production is very small, and basically in 2030 we expect 10 times more demand than in 2020, so quite a few new mines needs to be up and running.
When it comes to the lithium exploration, are you able to put a number to that? What kind of magnitude are we talking about?
So, as I said, it was fairly small, and it's now going to be 10 times bigger. It's actually ending up being quite a big industry, but it's still tiny compared to the copper world. So for us, we have the competences as a miner and as a manufacturer. We have the technology. We are strong in exploration, and therefore we think we can play a meaningful role. to contribute to this, but it will always have its limitations as well.
In addition to the physical land, would you consider any M&A in the lithium space to get up to scale?
Well, we tend to look at it slightly different. We rather use our competences to develop the projects ourselves, because lithium companies right now are very, very expensive, and that might be relevant for someone who doesn't have any competences in the area, but we can do it. We believe we can find much cheaper ways to get there.
Can you do that in a way that I guess is quote unquote clean? There's been a lot of discussion about how the mining of these sort of renewable, or these I guess materials that would go into sort of renewable energy projects like EVs come with their own baggage as well.
Yeah. No, look, you're absolutely right. Out of our 4 objectives for Rio Tinto, one of our objectives is to have impeccable ESG credentials. I do believe that societies nowadays are much more focusing on how things are being done, and we rather want to be a step ahead than a step behind on this. We cannot run away from the fact that extraction has an impact on nature, but we can minimize that, and we can offset that, and we can find really, really good solutions. So that's actually the value proposition from our side. Sometimes it might cost a little extra, but you then build something that is really sustainable and a win-win. Because you have to bear in mind, you don't build a mine for 2 or 3 years, you build it for 3 or 4 decades.
Well, then you have to work with regulators too. I mean, this has been a discussion. I mean, so you've gotten past that hurdle in Argentina.
Yes.
You're working on that in Australia.
Yes.
I know the Serbian government at one point blocked the deal there.
Yeah.
Have they softened at all since?
Look, we are very optimistic. Ultimately, we have to be humble. It's not just a private investment choice, it is actually a societal choice. And if we want a sustainability in our operations, everybody needs to feel comfortable, and it has to be seen as contributing to society. I think that is the case. I think we can contribute an awful lot to the countries where we are mining and manufacturing, but it is about how and the solutions you get in place.
I want to talk a little bit about iron ore, because you've seen the sell side come out and upgrade or downgrade your stock depending on iron ore demand, specifically from China. From your view, where do you see Chinese demand right now?
Well, the demand is good. You will have seen that there's tight supply and demand, that prices have gone up the last couple of months, etc. The Chinese steel mills, they are producing, and there's demand for their steel.
Demand for their steel. Do you see that continuing, though? Is that sustainable as we get into maybe next year?
There's always uncertainty about the future, of course. We tend not to look so much at the short term. We tend to think about the long term, and we look kind of 5-10 years down the road. And the world steel demand will continue to be good. There will be more recyclability, which is good, and therefore slightly less demand for iron ore. China's demand is probably going to stabilize, whereas you see other developing countries like India growing significantly. But we see a good, stable demand long-term for our iron ore production.
We'd be remiss in not asking you about what's going on in the aluminium market here. Of course, one of the worst performing commodities out there, at least in terms of what we see in the futures market here. How much of that is impacted by what we've been seeing with Russian supply and where that supply is going?
Yeah, no, first of all, the U.S. have actually put on a tariff for not importing Russian aluminium, but that's not the case around in the world and around in the rest of the Western world. We are not doing business in Russia. We are condemning the war, and therefore that's what we have seen recommendation. We would have thought that there would have been some limitations on how to import Russian aluminium. I don't think we can blame it just on Russian aluminium. There is just in general significant supply. And one of the challenges we are having in a week like this week, Climate Week, is that unfortunately the price is the same whether you are selling low carbon aluminium or high carbon aluminium. And there's a huge difference because aluminium is the most energy intensive metal on the planet. And therefore if you use coal for producing aluminium, you have very significant CO2 emissions. So it would have been nice if we had more differentiated price setting here, because you're absolutely right. We have the Western world's largest aluminium business, primarily based in Canada. Very low carbon because we got the hydropower there. It's a unique system that Canada has got, but it would be good if there could be put a value to that business.
All right, Jakob, I know you have a busy week ahead of you, so really appreciate your time on set today. Our thanks to Rio Tinto CEO Jakob Stausholm. Now, still ahead on the close, nearly 13,000 United Auto Workers marching on the picket lines against Detroit's Big Three. So what's next for the auto space with little to no chance of a near-term resolution? More on that next. This is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I found myself in a spot where I was constantly getting new challenges. A lot of, I think, the best mentorship I had at Bridgewater is because people often saw in me the potential to do things I didn't even see in myself yet.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Do you think there's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well? Or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stenivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
City. From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
All right, time now for our top calls. The big movers on the back of analyst recommendations, and we start off with NetApp here. A downgrade to market perform for the data management company. William Blair doing the downgrade there and says it's questioning the ability of the company to perform and achieve revenue growth in the cloud computing space. Also see some limited operating margin upside at current levels. Shares down 2% on the day. Next up, let's take a look at DoorDash, which is actually getting an upgrade to buy over at Mizuho. The analyst actually citing market share gains that DoorDash is making in the U.S. and says a moderation in food inflation and the resiliency in consumer spending should also provide some incremental support. Those shares having a decent day, up 2%. And finally, Carvana, an upgrade to neutral from underperform. This over at Wedbush following the used car platform's debt restructuring. The analyst sees this along with improved profitability and decent pricing conditions driving upside in the near term. Those shares, though, unchanged on the day. And those are some of our top calls. We do want to stay in the automotive space here and take a closer look here at the strike, the UAW strike entering day 4 against Ford, General Motors, and Stellantis. Garrett Nelson, analyst over at CFRA, took notes on the negative implications it could have on those automakers, but cautioned that the UAW could potentially overplay its hand here as the balance shifts of the Detroit 3 are flush with cash, the balance sheets, I should say, and can likely wait out a strike longer than the workers can. Garrett Nelson joining us right now to talk a little bit more about this. And let's talk about the health of the balance sheets for the big 3 automakers here, the cash they have on hand, and how much or how far that might actually take them.
Sure, thanks for having me. All 3 of the Detroit 3 automakers, GM, Ford, and Stellantis, their balance sheets are flush with cash right now. It's been an extremely strong pricing environment over the last 2 to 3 years, really ever since COVID, which drove inventories to record lows. Now, inventories have since recovered back to about normal levels, but the companies have generated record profits over the last couple years, and so their balance sheets are in very strong shape. And we think that they can wait out a strike probably longer than the UAW members can. They can also resort to other measures such as hiring replacement workers or even plant lockouts to force the union into a deal.
So to that point, of course, these automakers have plenty of cash to wait this out. But even with that being said, when you look across these 3 automakers, who potentially has the most at risk here?
We think General Motors is in the most precarious situation just because their vehicle dealer inventories are so much lower than either Ford or Stellantis. You look at GM's Chevy brand, which is about 2/3 of their total sales volume. At the end of August, they had only about 51 days supply. The industry average at the end of August was about 58 days. But you compare that, to Ford, which was much higher, over 70 days supply, and Stellantis, all 4 of their major brands, for example, Jeep, Ram, were all over 100 days supply. So we think Stellantis is in the best position, just given the inventory build that they've had in recent months, whereas GM is in the worst position.
When we talk about this idea, I guess, of the changes that the UAW is asking for, not only just with regards to the raises, the actual pay itself, but some of the other assurances they want with regards to electric vehicles, the tiered system, et cetera. Do you see any sort of light at the end of the tunnel for the automakers budging on those issues?
Yeah, a couple are non-negotiable. For example, the 32-hour work week that the UAW is proposing while being paid for 40 hours. You think about that. That's the equivalent, that alone would equate to a 20% pay increase. So we think that's a non-starter. Another non-starter is the restoration of traditional pension plans. They just represent too much of a liability for the automakers to go back to that, to agree to that. So those are 2 things where we don't see the automakers budging at all. But we could see them potentially making some concessions related to the status of temporary workers, making them full-time workers faster, and also retiree benefits.
All right, Garrett, gonna have to leave it there. Garrett Nelson over at CFRA Research, a closer look here at the big 3 automakers and day 4 here of the UAW strike. After the break, we're gonna talk a little bit more here about the union progress that some labor unions have made in this country. Mary Kay Henry, she's Service Employees International Union International President. We're gonna get her thoughts on the UAW strike and, well, the summer of strikes overall. All that and more coming up in a bit. This is Bloomberg.
Okay, so you're moving in on me. Quick. Distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right, I will concede. I can see. Got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Welcome back to The Close. Romain Bostic here. It's time now for our Wall Street Week daily segment. The host of Wall Street Week, David Weston, joins us as he does every day at this time. And David, a lot of talk right now about the UAW strike, day 4 here, and whether there's sort of any sort of distance, how much distance is between them and the automakers.
And you've been talking on your program, as we all are talking about it. So we thought, Romain, we'd actually go to somebody who knows her way around a fair number of union negotiations. She's Mary Kay Henry, Service Employees International Union International President. Mary Kay, thank you so much for being with us. I think we have a pretty good sense now of how we got here, what the differences are between the auto workers on the one hand and management on the other. Give me a sense from your point of view, do you see a path to getting out of here? That actually is getting to yes, as they say.
Yes, I think the autos workers' demands are righteous. I think the big three are in the best economic position ever to negotiate a fair settlement with the auto workers. And I think the country is ripe for an investment in this industry because the growth of electric vehicles is going to be our future. And so those combination of factors, in my mind, have made SEIU members proud to stand in solidarity with the auto workers' demands.
And from what we've seen already in the offers from the automakers, they agree that there needs to be a significant increase in salaries. So they agree that it's overdue, as it were. But when you talk about investment, the auto companies say, yes, we need to invest, but we need some money to invest in the EVs. Are they wrong about that? And by the way, should the union take that into account in formulating their demands?
Yes, and I believe the union has done that. Of course, the union wants the companies to be able to make investments, but they also want the companies to justly share in the profits that the workers help create. And when you look at CEO comp and how that has risen since the 2008 concessions, and when you look at inflation and record profits, they deserve record-setting contracts.
Well, what do you make then of some of the responses that we've heard from some of the companies? Of course, Bill Ford, he kind of made it clear that, at least in his words, that their company would effectively be hobbled if they actually had to pay this over time, what the UAW is asking for. You have McDonald's and the whole $20 an hour wage that is being considered in California, them coming out and saying this would actually send us to the poorhouse. And of course, you have the Hollywood studios all saying that they can't operate if they continue to pay their writers and their actors more and more.
I think working people have heard those kinds of excuses for decades, and that working people have led this country through the pandemic and now to an economic recovery that is benefiting the top 2% of the economy. And each one of those cases, the UAW bargaining, the SAG-AFTRA Writers Guild strikes, and the fast food workers who finally got to set a table with McDonald's, Wendy's, and Burger King, are examples of how we're going to insist that the profits that are being created are shared by the people generating those profits all across the economy.
There's so much talk about these strikes, Mary Kay, in the context of the workers versus the employers, the companies themselves. But there's also been some discussion here about whether this sort of generates more interest of employees wanting to join labor unions?
Absolutely, it does. And we're seeing that all across the economy. We're backing airport workers who do baggage handling and cabin cleaning and wheelchair attending, and they're taking direct action later this week at 3 airports that are American hubs because they're calling on American Airlines, who's getting money from the government, has record profits, whose CEO is doing very well, to help invest in the frontline workers who have no paid time off or health care. And that's an example of workers rising up because they're inspired by what auto workers are doing, fast food workers, and what SAG-AFTRA WAG members are doing. And so we're going to see it as Starbucks workers continue to make a demand on that company to come to the table and hear their voices on the front.
So, Mary Kay, there is the traditional way of organizing workers. Obviously, you have an election, they have a vote, and they decide what to do. Can you... Oh, I'm sorry. I think we've lost Mary Kay Henry. So bad. So I was going to ask her, actually, can the auto workers actually try to get access to the EV plants that don't even belong necessarily fully to the auto companies? Can they actually organize workers that way without an election?
Well, that's what I'm curious about, too, because there has been a lot of talk. If they fail at this, does this create sort of longer-term problems for them being able to convince members that being part of the union is a good thing? And obviously, the EV thing is going to be critical to that.
And they certainly have gotten the hopes of the workers up. There's no question about that. And by the way, the president hasn't discouraged either. Mary Kay, I'm delighted we have you back. Let me just ask you, though, the president of the United States has taken a position, I would say, on this. We heard him on Friday. Is that helpful or not? Because it doesn't help the UAW climb back down off of any of the demands at all. If anything, I think the president seems to be egging them on.
I think a key thing that the president said was the companies have scored record profits, and the auto workers deserve record-setting contracts. And so to have the president of the United States helping to make that case while workers are rising up and saying to Hollywood that is profitable, Amazon that's profitable, Starbucks that's profitable, now it's time to invest in the frontline workforce and to share power is incredibly important in this moment.
And finally, Mary Kay, what role, if any, does public opinion play in all this? Certainly there seems to be a sense right now that a lot of Americans are sort of sympathetic, it seems like, to the workers. Does that make a difference in the negotiations in your experience, or is it just off to the side?
Absolutely, it makes a difference. I heard from auto workers and friends that the horn honking outside their picket lines was a huge boost of morale. 88% of young people under 30 favor unions, and they're joining together in record numbers. All of that creates a climate where I hope American CEOs will join us at the bargaining table in insisting that working people ought to have a say in the future of the productivity that we create for this country.
Mary Kay, it's always great to have you with us. Thank you. That's Mary Kay Henry. She's Service Employees International Union International President. Tomorrow, we're going to be joined by Sir Tony Blair. He's the former British Prime Minister, of course. And on Friday, we'll have Jose Minaya. He's Nuveen CEO on Wall Street Week. That'll be at 6 p.m. Eastern Time on Friday.
All right. Interesting conversations coming up. Be sure to tune in for that. And you can catch David every day at this time for our Wall Street Week daily segment as we set you up for the final hour of trading here on a Monday afternoon, where the price action in the equity market as well. Not much price action at all. A little bit of a waiting pattern ahead of a 2-day Fed meeting begins tomorrow and a big decision on Wednesday. It's going to be a busy week for the macro. Stick with us. Full market coverage coming up after the break. This is Bloomberg.
given that we have this productivity enhancing technology that is AI, that has come off the back of this transformative communications network that's the internet, and we have a fundamental shift in the way the energy system is working, so there could be the ingredients of a pivot point of a kind that we've only seen a couple of times previously in history.
But let's ask what the driving forces will be. The world is propelled forward and has been for thousands of years by great power competition. That is the thing that drives innovation right now across the board. It is a competition which is intensifying between two superpowers, the United States and a communist-led superpower. Now, is this starting to sound familiar?
It does.
So what is really significant about this historical moment is that we are in the first inning, the early phase of Cold War II.
Right.
And that is going to drive all the things that we've talked about, and it will not necessarily drive these changes in directions that are benign. The big technological advance of Cold War I was, of course, nuclear weapons. And the arms race with nuclear weapons was an extremely dangerous one that very nearly blew the world up, particularly in 1962 at the time of the Cuban Missile Crisis. Yeah. I don't believe for a minute that we can have a Cold War II without a similar risk.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
This is Bloomberg.
Almost 3 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld.
Fastest hour in television begins right now with the view from the top, a look at equity markets, and not a whole lot to look at here, Katie Greifeld.
Especially not if you look at the NASDAQ 100. It had been the outperformer on the day, now just about flat. In volume too, Romaine. I mean, nothing to write home about.
Yeah, and I think this might be a sort of the trend line maybe for the next 36 to 48 hours. A lot of people sort of want to wait for the next big Fed decision. And we should point out, this is a big week for the macro because not only you have the Fed on Wednesday and the BOJ on Friday, but in between that, you get, Indonesia, Turkey, Brazil, Argentina, South Africa, and the UK.
Yeah, there you go. And it's fun this week because usually the BOJ is kind of the snoozer. Not this week. We'll see what we actually get from the Bank of Japan, and maybe that's the one to watch over what the Fed is going to do, which is widely expected to hold.
Yeah, I'll flip up the board here. You see crude oil camped out around $92 a barrel. You're seeing a downdraft in Treasuries. That means an updraft in yields, at least on the short end of the curve. And the dollar, a little bit of stasis right now, but I thought it was interesting. You look at the latest CFTC data, and you're actually starting to see some of those short bets on the dollar be paired here. Now, folks flipping to long dollar after what had been a somewhat unprecedented doldrum that we saw for a good portion of the year.
So some capitulation there. Let's go back to the equity market, though, because there's plenty of interesting movers to look at on a quiet day. Let's talk about Tilray. Of course, this is a cannabis company, and it really had been surging on optimism that the U.S. Drug Enforcement Administration review will result in a lower risk rating. But then you had Kerrisdale Capital saying in a post on X that it is short this company. As a result, you're looking at a big plunge there.
Yeah, a big deal here. A lot of volatility there. I saw you had Ford on the screen as well.
I did. We have to talk about Ford, of course. We are in the fourth day of that UAW strike, and it's hitting Ford shares. But, we just had that conversation with Garrett Nelson over at CFRA saying that these companies are flush with cash, these automakers. They can wait this out, but even still, you're seeing a decline there.
And not only are they flush with cash, but a lot of people talked about the strategy that Fain has taken. It actually spares some of those higher margin vehicles. Those particular plants are still able to operate and in theory still pump out, F1 Megalodon 50 or whatever.
F3 million. So a silver lining. You're not necessarily seeing that in the shares, at least today. Let's quickly talk about Nikola. I thought this was really interesting. Obviously surging today after saying that it has hired former GM President Mary Chan as its new chief operating officer. She will move into that role starting October 9th, I believe. And I mean, look at the price. It's up, 32%.
Wow.
So I think we can still call that a penny stock.
To $1.56. Yeah. All right. Well, I guess it's good that they actually have some leadership because, of course, there was a leadership vacuum there, raising a lot of questions about the future of the company. And she obviously has a great pedigree. So a big win for Nikola. Of course, she's still got to find a way to start producing some of these vehicles.
Exactly. Still has to deliver, but, you know, a good day for Nikola. Obviously, that's a stock that's been beaten up and then some.
Yeah, of course, at least on a percentage basis, Katie Greifeld, one of the stars of the show here on the day. Meanwhile, we move closer to the closing bells. 1 hour away. Our cross-platform coverage, counting you down to the close. That coverage starts now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostic here alongside Katie Greifeld, joined right now by our colleagues. Carol Masser sighting once again.
She's back.
Wow.
Who are you? Where am I, as I said to Tim?
Masser. I didn't even know you still worked here. Tim Senevic actually did show up, I think, for at least 2 days last week. Welcome to our audiences across all of our Bloomberg
we
platforms.
We have a good contract. I'm just going to tell you.
Apparently.
Yeah, you do. I need to get your agent,
Were
Carol
Katie
Masser.
and Carol on vacation together?
They were just sailing the 7 seas all the way
invited her, but
Colorado or somewhere. I don't know how to get to Colorado by boat, but they managed to do it.
Did not talk inflation. What? Didn't talk a lot about inflation or the markets, but man, I feel like I came back and, you know, it's all out there still in a meeting where we've got, of course, a Fed meeting, or a week, I should say, where we've got a Fed meeting. What am I talking about? What are we talking about? We're talking about the oil markets because we've got Brent going up to about $95 a barrel. We've seen a significant move up in both Brent and WTI over the last couple of weeks. And so you do wonder about some of these supply-demand metrics that are going on specifically. You've got supply curbs by Saudi Arabia and Russia. And it's coming at a time, right, Tim, where you feel like production, as people try to think about where we are shifting to in terms of energy, maybe they're not putting so much money and efforts into it. I think the big question is for the Federal Reserve and what it means for the Fed as it tries to get inflation under control. And it comes at a time when it seems like the Fed is getting inflation under control, Katie. So high energy prices, you can strip them out all you want, but energy is really in everything.
And that's the thing that also obviously feeds into inflation expectations, what oil, what gas is doing, which of course feeds into how the Fed is thinking about policy. So we'll see how that's playing out. But I did want to pivot and talk about one of the other most read stories on the terminal other than what we're seeing in the oil market. And that's what's going on at Meta. I don't know if you guys saw this, but Meta is restoring its happy hours. It's giving out branded T-shirts once again. It's trying to boost morale.
Yeah, you said the two magic words for Carol Masser.
As it brings its
were they happy an hour? Boost morale,
I think she just put in her application.
Happy hour? I don't know. I don't know how you guys feel, but what is more fun than going out to drink with your colleagues after work wearing a company T-shirt?
I got an answer for that.
Okay.
Drinking with your colleagues during work. I was going to say, you know, having equity in a company that's up 238% since lows of last year. I mean, I think, Romaine, that can do a lot to improve morale somewhere, too.
Yeah, I mean, you know, money always sort of heals a lot of wounds here. But, I mean, it gets to the idea, how do you lure people back to the office? I guess in Carol Masser's case, alcohol.
No, listen, when we have alcohol during on-air time, it's because we're talking to somebody who's actually, it's a business. Okay.
They're talking to winemakers. Yeah. I've been in the studio for that. It is, those are good conversations. It is fun, though, to think about this story and Meta. When you think about this was the year of efficiency for Meta, but now they're finding, I mean, to lure workers back, you have to give them some perks.
Well, to be fair, the laundry is no longer free. It now, you know, costs a fee to do laundry, Romaine. So not everything is back to where it was, but
to do laundry where? At Meta's?
Just
Meta's? Are people really?
Get on the shuttle.
They have like washing machines there? You just bring your dirty laundry there?
You just bring it in
there.
What is it like? Tim does darks, Katie does the pinks.
I've never worked anywhere.
No, I do. I will tell you, they just drop their laundry off and it gets done. You know what I think is interesting, though, in this story? It's a lot of fun. I thought what was interesting, too, is when, was it the La Croix that ran out? Like, they didn't have that in the in their kitchen?
Can you imagine?
Salt or LaCroix.
Woe is me. Oh, La Croix? Did I say La Croix?
Yeah. You don't have to fancy
It's how they say it in France. I can do French fine. What's interesting is they say, I'm just going to read from the story, morale at Meta has always tracked closely with the company's stock performance, which is more than doubled this year to an 18-month high. So there is
Wait, you're saying when employee morale is high, the companies do better?
It's not me.
Or maybe it's the other way around.
I think employees are happy when the company is doing well.
Yeah. Wow, the stock market is real life.
So what's the solution?
Well, if we were a publicly held company, we'd be like a $4 trillion company. That's all I'm going to say. Okay. Because the stock would be doing really well.
Welcome back, Carol Masser.
You're very welcome. Now I know who you all are again. All right, we're going to be back in less than an hour's time. We're going to get you down to the close on this Monday on radio, TV, YouTube, and of course, Bloomberg Originals.
I know. I missed her.
You know, if you ask, sometimes they say yes, actually. All right, we'll see you at 4 p.m., guys.
We continue our markets coverage right here on Bloomberg Television, counting you down to the close with just about 50 minutes until we get to those bells. Ed Al-Husseini joining us right now, senior interest rate and currency analyst over at Columbia Threadneedle, on what is, I guess, going to be a big week here, at least for central bank policy. Not a whole lot of expectations for a change in rates, but certainly a lot of expectations for what the Fed will telegraph about economic conditions.
I think that's right. And really the focus is on what kind of forward guidance can they give us about 2024. At this point, really the focus on staying on hold for longer, how long, what will change their trajectory potentially next year, either to the upside or the downside. I think those are still very much open questions.
There was a big open question a few months ago about whether Fed policy was restrictive or restrictive enough, I should say. It seems like most people now are in the camp that we're pretty much there. Maybe there's a quibble of 25 basis points or so. Do you think that we're there?
Yeah, and I think, look, Fed policy is set to get more restrictive next year if they stay on hold, but inflation declines, and therefore real rates rise. And I think there's a good number of people on the FOMC who are buying into that view. So even if we're a little bit wrong this year, next year we'll have that room to see more data come in, stay on hold, watch real rates increase, and then adjust as necessary.
Well, on the topic of restrictive policy and how restrictive policy actually is, there was a really interesting note from JP Morgan a little while ago, basically pointing out that you have the equity market up year to date, largely driven by multiple expansion. At the same time, you have real rates and the cost of capital moving deeper into restrictive territory. When you're thinking about that dynamic between basically what we're seeing in real rates and what we're seeing in risk assets, how does that relationship come back to normal?
Yeah, it's really tough. I don't think anybody knows. Is there a threshold level above which, in terms of real rates, above which credit spreads widen and equities get re-rated lower? We're not sure. We're going to find out. I think ultimately, as investors, we've got to keep our eyes on the real economy, particularly the labor market. I think once the labor market starts to degrade at a faster pace, the re-rating of risk assets will take on a life of its own.
Let's talk about the pace more here, because the last few jobs reports, you are starting to see some of the edge come off. The soft landing camp has taken that as a win. But when you think about how high rates are and how long they could stay there, what is the risk that the pace picks up beyond what the Fed is actually aiming for?
In terms of the deterioration, again, it's so hard to say, because once you trip a threshold, the unemployment rate starts to increase. And again, that takes on a dynamic of its own. It's risk aversion by companies that feeds on itself. It's risk aversion by consumers that tends to feed on itself as well. Clearly, we've not had that this year. Does that take it off the table for next year? Absolutely not.
Give us a sense here. Once we do get, I guess, maybe some clarity about, I know the Fed isn't going to have that sort of mission accomplished banner that everybody wants to see, but at some point they are going to have to try to telegraph to the markets that we're done, or at least we're close to done, or at least we feel comfortable where we are here. Do you think that the tone of that is going to have a major market impact?
I think so. Look, I think the process probably begins this week. The Fed's been getting louder around the concept of risk management. The fact that the upside risk to inflation is now increasingly being balanced by downside risks to employment. That's only going to become more acute next year. And that will have, I think, an important, that will be an important flag for risk assets in particular, because it tends to put a ceiling on interest rate uncertainty, interest rate volatility. Look, in the course of the past year, the decline in interest rate volatility has been a tailwind for risk. Next year, I think that dynamic starts to change as real economy factors start to take over.
So then where does money go? I mean, where do the good investments end up being in that environment, should that happen?
I think the key question for investors now is, when do you come off the sidelines in terms of moving out of cash and into credit and into duration? And with the prospects for the economy, again, degrading slowly at the moment, but potentially a little bit faster next year, the impetus is really on consumers and retail investors to move off of cash and into a little bit of duration to hedge against that risk.
And I asked a version of this question earlier, but what's more attractive, duration risk or credit risk?
I don't think you want to be too far out on the curve. I think you really want to be closer to that 2 to 5 year area of the curve. I think it's a sweet spot. It takes takes advantage of the fact that the Fed's hiking cycle is coming to an end, gives you a little bit of protection, but doesn't give you that exposure to large movements further out on the curve. Versus credit, look, the credit story is very interesting because credit spreads are compressed, reflecting the fact that growth has been pretty good. Credit risk has been de minimis this year. At the same time, all-in yields are very attractive. So from an income perspective, credit remains a very, very good story. So to me, short to intermediate maturity credit, short to intermediate maturity treasuries both present quite attractive value at the moment.
Well, Ed, just quickly, I talked to a lot of investors who look at what's going on in the credit market. They look at those spreads at pretty tight levels and they say that market is way too expensive. How are you thinking about that?
Absolutely. You broaden out the scope, look at structured products. There's lots of pockets where you get exposure to the consumer balance sheet in structured products where valuations are more attractive. Agency MBS, of course, for about a year now has been screening cheap relative to investment grade credit. That valuation gap remains. And again, you're able to pick up better carry, better income out of those pockets of fixed income.
All right, Ed, it's always great to see you. Our thanks to Ed Al-Husseini of Columbia Threadneedle. Now, coming up, we're going to get insight on the world of exchange-traded funds from Jay Jacobs. He is U.S. head of thematics and active equity ETFs over at BlackRock.
And some interesting developments going on with Clorox. Some of its key factories shut down after a cyber attack. Those shares now flirting with some of the lowest levels that we've seen year to date. We're going to have an impact on their earnings coming up a little bit later.
And as we head to the close, we'll be joined by Richard Bernstein. He is CEO and CIO at Richard Bernstein Advisors. All that and more coming up. This is Bloomberg.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We will be Ukraine's biggest airline the week after they tell us it's safe to go back in there because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment cost agreement on which we could lead the charge of air travel into a post-war Ukrainian recovery.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets. China open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Small market gains here in the U.S. to start what is going to be a big week for the macro, a big Fed decision midweek here. Sandwiched in between all that here, we're going to have a lot of economic data and some other central bank decisions that could really move this market. You did see some of the sentiment sour overnight, particularly in Europe as well as in Asia. That did spill over just a bit here into the U.S. session. The cash session for most of the major indices right now still hovering around unchanged on the day. Automakers on the back foot, and one of the few bright spots, believe it or not, are a couple couple of the big tech names, including Alphabet and Apple. Apple shares up about 2% here on the day. Let's bring Abigail Doolittle into this conversation as we do every day at this time for our Options Insight segment. And Abigail, you've been taking a look at some of the options trading out there, and the indications are that, well, there's potentially smooth sailing ahead.
Well, with the VIX below a 15, Romaine, it does suggest that there's some complacency. It doesn't quite jive up, though, with the Federal Reserve still potentially in hiking mode, some of the other uncertainty, political uncertainty, macro uncertainty, but that is what some of these indexes are saying. To talk more about this, Matt Rao, head of cross-asset strategy over at Nomura. Great to have you back. I think this is the first time since the pandemic. And what do you make of this? Because it does seem, and it doesn't really quite feel like climbing the wall of worry. These are big systemic, potentially issues. And I would argue that maybe the biggest one is that we have rates higher for longer and stocks too. Historically, that hasn't always ended well.
Yeah, I would say one of the greatest risks is that the market has already priced in the best possible outcome. And we may be sitting in a place where there's not much left to push higher. I would say one piece of evidence for that is last earnings season, where companies that outperformed, you know, they were maybe flat, maybe up a little bit. Companies that missed were punished. And I think that based on where we stand from an economic perspective, we haven't priced in earnings erosion that should be coming at this point in the cycle. And things still look priced for perfection with a lot of negative catalysts to come.
So are you seeing any signs within the options world? I'm sure on single stocks where there's a lot of risk, it's probably priced into some degree. Yeah. And I will say last week we took a bigger look at the SKU index, which traders hate, but it's been pretty predictable in terms of spiking up and then coming back down ahead of a big sell-off. Yeah. But are you seeing anything, any signs of risk in the options market?
Only a little bit. I mean, I think when you pointed to VIX being at 15 and sub 15. You know, long volatility strategies are somewhat unpopular because they tend to cost people money. We've had such a compression of volatility because it's being used as a yield enhancement tool over the last few years. One of the signs is that a lot of that vol selling is getting a little bit less profitable. So what that means is that there's now a little bit of a return to the value proposition of hedging. Now, when you get to a world with rates rising as fast as they have, to the degree that they have, investors have residual return to spend on things like puts against stock positions. So when I normalize all of these things for where we stand from an absolute rate of return perspective, we should be seeing higher levels of volatility. But we still have these sort of zero interest rate habits of selling vol for yield pickup that are continuing, and that's a little concerning.
And then piling in when the sell-off happens or as it happens. Yeah. What are your clients asking you about right now? What's the top one or two common questions to all of your clients?
Mainly it's about how do I stay invested and protect myself at the same time. And you know, the biggest challenge, you know, for institutional investors, which is our primary investor focus, is the key to long-term success is compounding at a higher rate. And the best way to compound at a higher rate is to sort of smooth over the divots in return streams. So we're focusing quite a lot on helping institutional investors with staying invested, but doing it in a protected manner.
Well, the terminal chart that we were just taking a look at there was back in 1987. We took a look at this a few weeks ago with Steve Sosnick of Interactive Brokers, showing that rates higher for longer, stocks higher, and then obviously it didn't end very well, at least for a short period of time. Do you see something along those lines, some sort of implosion powder going in?
Certainly it's possible. I mean, one of my favorite people in the business said the greatest mistakes in investing are people misunderstanding the difference between possibility and probability. The probability is there. The possibility, I think, is relatively low because there is so much excess money on the sidelines that could step in to start buying as valuations come down. But I think that we do have the potential for stagflation to be the condition that the market is in, and it's not talked about a whole lot. So I think the market hasn't contemplated rising rates as fast and high as we have, and at the same time decoupling from globalization. We don't have a good frame of reference for how to analyze that experiment.
Well, another conversation for another time could be, does stagflation equal the highly desired soft landing? Yeah. Matt Rao of Nomura, head of cross-asset strategy over there. Thanks so much for joining us for Options Insight today. And from New York, this is Bloomberg.
what do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. What's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, probably I try and play that role.
From New York City. In London. In Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Now, for decades, derivatives firms such as CME and Cboe have called Chicago their home, but now a slew of new taxes are threatening Chicago's future as a financial hub. Romaine, I imagine this hits pretty close to home for you, and we're talking about an $800 million in proposed taxes by a new mayor, and in particular, a levy on financial transactions, which I would imagine these firms don't want.
Yeah, this is a big deal because, I mean, we're talking about the new mayor, Brandon Johnson, and he kind of ran on this platform of increasing taxes in this area. And then he was kind of talked off that. I mean, there were a lot of folks who basically said, you're not going to get elected if you sort of push this forward. And he backed off, and now it seems he's back into this. And this is a big deal. I mean, this really is the identity of Chicago. I grew up there.
Yeah.
And we talked, I mean, most of these firms really go all the way back to the 1800s in some form or another here. And it was that concentration of traders and all the sort of support staff needed that really sort of made that kind of financial district what it was. I was just there in July on a weekday, and I remember walking through just past the old buildings, and it was like a ghost town.
Yeah. And I mean, you've seen shades of this in other parts of the country. And I mean, you think about the reputation of Chicago, though, as this trading hub. Of course, we know that Ken Griffin's Citadel left. You think about some of these other firms, such as CME and Cboe.
Yeah.
They haven't explicitly threatened to leave, but behind the scenes, there's great reporting that they've basically worked together to press their case to policymakers.
Yeah, and we should point out that, I mean, for example, we talk about the Cboe and what goes on in Chicago. We forget that a lot of their servers that actually run those operations actually aren't based in Illinois.
Right.
A lot of them are right here in your backyard in New Jersey. So, I mean, they've already tried to sort of diversify away from that. Even Citadel has their servers, last time I checked, right outside of Chicago in a suburban area where they were able to get more favorable treatment.
Yeah, exactly.
Yeah.
It all comes down to taxes. So we're going to see how that one turns out. Obviously, an important story for Chicago and the industry overall. This is Bloomberg.
We've been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted. And I think many people, even in the markets, have not quite understood in my mind how much we are now in a different regime compared to the last 4 decades, effectively.
So it's what, almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
This is the countdown to the close. 30 minutes left to go here in the trading session, Katie.
And we're looking at a pretty flat S&P 500. It's a little bit more exciting if you take a look at the sector level. Pretty much an even split here. Up at the top, it's no surprise you have energy leading the pack, up 0.7%, of course, with us all on $100 a barrel watch. Then you have tech participating a little bit. You go down the list, though. There is some red on your screen there. Materials, real estate, and then consumer discretionary off by over 1%. Romain, a lot of that is coming from Tesla.
Yeah, coming from Tesla. I guess the good part about this market right now is you have Apple up a couple of percentage points on the day. Alphabet up almost 1% as well. That's a big part of the reason why you're not seeing this market a lot lower than where it is already. Meanwhile, ARM Holdings, day 3 here of trading there, down once again. Of course, had that big pop on the first day of trading, up more than 20%, giving back some of that here for yet another day. Keep an eye on a couple names here. Target share is down about 3% here on the day. A lot of concerns right now about what we could potentially see out of consumer spending heading into what is sort of a critical shopping period for names like Target, Walmart, etc. And Goodyear down about 4%. In fact, a lot of the auto suppliers are moving lower. That includes names like Autoliv, American Axle, as well as Goodyear. There's a lot of concerns right now that the strike, the UAW strike, could be a prolonged strike and could have some huge downstream effects on some of those suppliers. Meanwhile, I do want to turn back to, well, the fixed income market. Some interesting commentary about from Amanda Lyman over at BlackRock, talking about this idea here of the potential returns that you could potentially see in the junk bond space. I thought it was an interesting commentary, and it had me scratching my head. And then I went and looked at the data, and well, that yellow line on the top, when you weight it back to the start of the year, that's actually outperformed most of the other asset classes in the fixed income space, Katie. So junk bonds, where's that right now?
Junk bonds, where it's at. Let's go from the fixed income market over to the world of thematics, because joining us now is Jay Jacobs. He is BlackRock head of U.S. thematics and active equity ETFs. Jay, it's great to have you here in person with us. And I'm hoping you can help make sense of some of this flow data, because when I think thematics, it's basically a grab bag of exciting things. But you take a look at the flows, we're on track for 2 straight years of outflows from thematics as a category, even though you have the likes of AI really propelling a rally in the stock market. How are you thinking about that? What is it going to take to see money come back into thematics?
We've seen investors getting a lot more precise about their exposures this year, and frankly, it makes sense. I mean, you look at, we have high interest rates, which are likely here to stay. We have a stagnating global economy. We have earnings growth, which has basically been flat. And so investors are trying to get more precise about their exposures. Now, they haven't been broadly buying every theme like we kind of saw in 2020, where there was really broad excitement around disruption as a concept. This year, it's very targeted. Two themes are seeing flows. It's robotics and AI, and it's U.S. infrastructure. That is where people have seen the most opportunity thus far.
And when it comes to AI, how specific are people being? Are they just shoveling all their money at NVIDIA, or are they actually thinking about, okay, what companies are going to benefit, who's building, et cetera?
No, right now it's hyper concentrated. So if you just look at the S&P 500, the S&P 500 is up 16% this year. Market cap weighted, if you look at equal weight, it's only up 4%. So that shows that a lot of the money, a lot of the interest is going into the mega caps. We see the same thing within our AI basket. The mega cap tech names are up over 50% this year. The rest of the basket, it's more like 20%. So it is really, people are not doing a good job of looking beyond the obvious names in AI. They've been really focused on just those mega caps.
Well, is it hard to sort of figure out, I guess, those unobvious names, the idea that who benefits and whether it actually is going to be material to their bottom line?
I think it is. It's a really massive, nuanced theme. This is why at BlackRock, we've identified AI as one of our 5 mega forces that is a powerful structural trend that's really revamping the world. It's not just a tech story. I mean, the easy answer is this is mega cap tech. The more nuanced answer is this is a services economy change. This is a healthcare. This is going to impact healthcare. This is going to impact software names. This is going to impact how we think about things like aging populations and how we replace part of the workforce as people age out of it. So it's a really nuanced, powerful theme that goes way beyond just the tech sector.
But if you're trying to sort of create a product that's AI related, do you need to segment it out? Do you need to have one that kind of more focuses on, I guess, the quote unquote picks and shovels, and another that focuses more on companies that might benefit from, better productivity and lower labor costs?
I think there's going to be several approaches that do well in this space. So we look at it through a thematic perspective, which is owning the entire ecosystem. Like you said, the picks and shovels, people are developing the inputs that go into AI. But we also look at, our SOX ETF, which is semiconductors. They have really benefited this year as you've seen more demand for GPUs and CPUs in the AI space. And then even beyond that, we have active managers that are looking to play the AI space within technology as well. So this is not a one-ticker solution for AI. This is a big enough theme that's going to support multiple different investment views on it.
And so obviously, when you think about thematics, there's a lot of big hits and there's a lot of big misses. And when you're thinking about that and you're trying to develop a product lineup, how do you evaluate that? How long do you give an ETF to, try and capture lightning in a bottle versus saying, okay, this didn't work?
Yeah, we really start with the investment thesis behind the theme. So do we believe that this is going to have a powerful impact on the global economy? That is why BlackRock has, released this Megaforces framework of thinking about disruptive trends around the world. And then beneath that, really, how do you get kind of pure play exposure to those themes? Now, what can often happen is the size of the theme changes, is either bigger or smaller than we thought it was, or the speed of the theme can change. It happens faster than we expect or slower than we expect. If you look at AI this year, it's coming on faster than anyone could have reasonably expected with ChatGPT and just how quickly that platform has grown. But also the use cases has expanded massively. So the size of the theme, the total potential of it is growing at a massive rate.
I mean, how do you decide kind of the weighting of sort of which companies should maybe have a higher weighting than others? Is it based on the impact that they'll have in that AI space or something else?
So in our IRBO ETF, we actually equal weight because if you market cap weight, you end up really heavy in those mega cap tech stocks, which again have enjoyed a lot of the run up, but maybe not so much in the next inning or two. And also we really want more of that SMID exposure. There's a lot of lesser known, not really kind of household names that are driving AI forward. We want to tilt towards those smaller names so that we give people access to the entire ecosystem of this theme.
And Jay, every time you're on, I feel like I bring up IBLC. I'm going to do it again. That is the iShares Blockchain and Tech ETF. You take a look at performance year to date, it's actually crushing it. It's up 79% on a total return basis. You look at total assets, under $8 million. Flows not following performance there. What's going on?
This is a emerging theme that is still very early in its life cycle. So when the earlier a theme is, I would say there's more return opportunity, but there's also more risk. And so when we look at something like blockchain technology, investors have opinions on it. We continue to believe in that theme over the long run, but right now we're kind of seeing the volatility of that theme probably just create a little bit of noise in people's interest.
And you think about catalysts, maybe a spot Bitcoin ETF. I won't ask you about it. I know you can't talk to an active filing. Our thanks to Jay Jacobs of BlackRock. Really enjoyed this conversation. Now coming up on the close.
You kind of asked him anyway.
I got it in there. But coming up, we're going to talk about Clorox, because what does Clorox have in common with casinos like MGM and Caesars Entertainment? They've recently been hit by critical cyber hacks. It's our stock of the hour up next. This is Bloomberg.
Do you think there's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea. But technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening, because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Time now for our stock of the hour. A closer look at Clorox, the household products maker. Last month, it actually said that it had to take down some of its main systems because of unauthorized activity. And then we're learning today the company is saying that unauthorized activity and the effects of it are going to be material to their bottom line. Leslie Patton covers the consumer packaged goods industry for us here at Bloomberg, and she joins us now for more on what's happening here. And Leslie, this is kind of interesting here. I didn't realize, so basically all of their U.S. factories were affected by this, I guess what we're calling a cyber attack. And I guess some of these plants are still down and others are maybe up, but they're not necessarily up in that automated way that they're supposed to be.
That's right. So the vast majority of factories are back to producing items, supplies, but there are some still offline where production isn't happening. And that's right. There are some still, a lot of them are still doing the manual orders. So they're able to resume output, but at a limited level.
Your reporting also seemed to suggest that even the direct-to-consumer business, someone going to their website and trying to buy it, that's also down? Is that still down?
That's right. For certain websites of theirs that have the feature that sell directly to consumers, that has temporarily been disabled, the company's directing people to go to Amazon to order instead.
And you take a look at shares of Clorox right now, currently off over 2%. Just put this into context for us, Leslie. We know that they've come out and warned that this will hit earnings, but how bad is this for Clorox exactly?
It's a big deal for the company. The company's already going through an internal reorganization, trying to figure out what to do next to bring its systems more advanced, more AI type stuff, making decisions closer to the customer level. And also at the same time, they're trying to figure things out after the pandemic. So think fewer Clorox wipes and more cat litter. They're trying to figure this stuff out from an inventory and demand perspective. And this is just going to throw all of that off. It's a pretty big distraction for the company right now.
Well, Leslie, that's exactly where I wanted to go. Not necessarily to cat litter, but what this means for customers, what this means for shoppers. How long should we expect maybe some of these shortages to last?
The shortages are going to vary by store and by region, but yes, shoppers should expect to see some spotty outages, when they're shopping at the grocery store or their favorite club warehouse, and it's across different categories. And some you may not even think of, like Clorox makes Burt's Bees face lotions and face creams and Brita water filters too.
So did the company actually quantify at all exactly what type of impact this is going to have on their earnings?
Right now, no, they're not quantifying anything, but it's a big deal for the quarter we're in and going to end in the next few weeks here. So analysts, Wall Street, are going to be closely watching this for sure.
We have seen some other consumer products companies, including Mondelez, also go through something similar here. And so we do have some sense maybe of how that affected them.
Sure, that's right. So we can look at those as kind of a proxy to see what we can expect next. But again, it's hard to say. I think it will have a pretty big impact given this is across the U.S., across all of their facilities in the U.S., and now we're seeing nationwide shortages.
Beyond what we've heard the company say about how this will impact earnings, what has the response been from the company? Are they in touch with the FBI? What's the path forward?
Yeah, that's right. So the company's working with the FBI, working through an investigation right now, obviously not releasing the details of that because it's ongoing, but they've told me that so far it's progressing.
All right, Leslie Patton there covering this for us here. A look at Clorox. Those shares down 2% here on the day. Katie Greifeld. And remember, I think while you were gone, we were talking about this big hack at two of the big casinos out in Las Vegas. I mean, they're basically saying if you showed up to play the slot machine, you weren't going to play it.
I barely checked my email, but that was the one email that I did read to see what was going on with that story. And then to walk in this morning and see Clorox as well. It's strange.
Yeah, strange. Is this the apocalypse now? You can't gamble and you can't clean your bathroom.
I mean, it feels like we saw something similar in 2020, 2021, right? Cyber hacks were huge then.
Are we back to that?
I don't know.
All right. Closing bells are approaching us very quickly here. Richard Bernstein going to be joining us after the break. Stick with us. Full market coverage coming up right here on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Paul Jacobson assured me that when he takes the new Hummer EV on long journeys, it's not just fun to drive, it's equipped to go the distance.
I hear so much about road trip anxiety that I wanted to experience it myself. My family likes to drive a lot, so I brought my daughter home from college in this, and it was great. I mean, the computer system is all intuitive. It tells you how to keep track of the battery. It tells you where the charging stations are. It tells you how much power you'll have when you get to the charging station. So it really puts a lot of your anxiety at ease. But as far as driving it, it's a treat.
So where are you on the charging stations? I know General Motors has made an investment in one company. How are we doing in this country generally in getting charging stations in?
So I think this is an area where obviously we can continue to improve as a country and a society. We're doing our best. We've committed almost $1 billion to EV charging. So we've taken that and looked at home charging solutions, local community solutions, and road trip charging solutions. With my daughter, what we would end up doing is probably stopping, grabbing a bite to eat, plugging it into a charger, usually a high-speed charger, to get as much charge as we can, and being there for 20 to 30 minutes. Get us a lot of range, and by the time we've used that range, we're tired, ready to stop again, etc. So it was a really good experience for me, and it's taught me, number one, what are the concerns of the consumer that are ultimately going to drive our vehicles, and then number two, where do we need to focus on addressing some of those anxious points for people.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
This is the countdown to the close. Romaine Bostick here, joined now by Scarlett Fu, as she does every day at this time to help us count you down to the closing bells. And Scarlett, everyone was talking last week, of course, about the big ARM IPO. We're actually set to get another IPO this week. We're now learning that Instacart is prepared to price its IPO at around $31 a share here. That would be at the top end of its range. That story just crossing the wire based on Bloomberg reporting.
And of course, this is going to set the tone for whether more companies go public as well. ARM certainly a pretty good debut, although right now it's trading about $6 above its IPO price of 51.
Do you think, if that does come to market, I guess that would be tonight, you get the pricing, maybe it starts trading tomorrow. Yeah. Does that provide a catalyst for this market? Because I'm looking at the broader market right now. It's a snoozer, Scarlett.
We could use a catalyst, right? I mean, the idea that once upon a time was a dovish hike, that's given way to a hawkish pause. I mean, really what we're dealing with is an anything goes Fed, where the Fed is like, you know what, we're not going to make any decisions until we see all the data.
And I think that's key here. I mean, they've made it clear there's probably not going to be any change in policy, but I think in terms of what you see in those economic projections and obviously whatever Jay Powell's willing to share with us is going to have a big
talk around for about 30, 40 minutes, right?
Yeah, absolutely. Richard Bernstein joining us right now over at Richard Bernstein Advisors, helping us count you down to those closing bells. Just about 8 minutes or so until we get to those bells. And Richard, let's talk a little bit about, I guess, what the next big market catalyst might actually be. I mean, the Fed, for all intents and purposes, is, I guess, sort of out of the way. I mean, even if they give us more hikes down the road, we're not getting another 5 percentage points of it.
So Romaine, I think the next thing to happen, positive or negative, is back to fundamentals. I think the profit cycle is troughing, and I think that we're going to see profits rebound as we go through the end of this year into next year. I think that'll surprise a lot of people, because if the overall market is growing earnings 10 to 15% as we go through 23 into 24, that should change people's attitudes about, whether it's the Magnificent Seven or cyclical stocks or whatever. But I think that's going to be the next big issue.
That could be the next big issue. Why when you look at sort of the economic conditions, Richard, as well as the market reaction to them, there's been a lot of discussion here about this idea that we're not necessarily as late cycle as I think some people thought. And there's even a big cohort out there who think we're going to see a reacceleration in this economy that would suggest a new cycle.
Right. I think, it's interesting that people are using the term landing. In fact, even the Fed is using the term landing. The Treasury Secretary is using the term landing. Everybody feels comfortable saying the word landing. The reality, however, appears to be that increasing number of leading indicators are starting to show the economy is actually troughing and potentially reaccelerating. So maybe we should be talking about taking off instead of landing, if you want to use the airline analogy.
Well, the continued rise in oil prices certainly lends credence to that idea that perhaps the economy is reaccelerating. What does that mean for fundamentals, for earnings, Richard?
Yeah, I think, look, Scarlett, the interesting thing is that, the dollar has stopped weakening, but yet commodity prices are still up. That says that somebody out there is demanding commodities, right? It's not just a matter of the dollar falling and commodity prices are going up. So whether it's, non-U.S. economies like China, which I think the consensus is overly bearish about the prospects for their economy, whether it's our own economy, even the European economy, I think this is saying that the global economy is not exactly falling apart here. In fact, it seems reasonably healthy, if not healthier, than people thought 6 months ago.
Well, it is holding up, even as central banks continue to keep their monetary policy pretty tight. When you talk about fundamentals, Richard, how concerned are you about the strikes taking place for the big three automakers? There's some talk that perhaps stoppage for less than a month, less than 2 months won't really do much to profits, but beyond that, there's a big question mark.
Yeah, Scarlett, I think this is absolutely fascinating that we're having this big UAW strike, because for anybody who is arguing that the labor market is cooling significantly, I don't think they're paying attention here. You don't go on strike when the labor market is weak or weakening significantly. You go on strike when the labor market is strong. And we're not only seeing it at UAW, but we've seen this throughout the whole year, where you may not have seen strikes, but you've seen labor flexing their muscles. And so I think it's very symptomatic of a very tight labor market. Now, for the Fed, I think this makes their job really hard, because it's supporting the notion that maybe we are having a price and wage spiral, if not a wage and price spiral, maybe a price and wage spiral. But it argues that their job is probably going to be tougher than many people think.
Well, it's funny, too, because, with all the labor issues out there, meaning labor issues for the companies, not for the workers, there are some people that are actually saying that is actually a big component of the potential soft landing. The idea that you've had all of this, all these rate hikes and all of these things that were supposed to knock the economy down. And at least for right now, you have a labor market that's held up. And at least for right now, Richard, consumer spending that's held up.
Yeah, I think, Romaine, that's what people like me kind of believe, that the Fed still has a lot of work to do. And that's the reason why, is that, what economic model says that the Fed raises rates 525 basis points or whatever, and that the economy might be reaccelerating? I mean, there's like zero economic models out there that would ever have predicted that. So I think we're a little bit in uncharted territory. I will not say this time it's different, because that is the kiss of death, as we all know. So let's say we're in uncharted territory a little bit. And I think that, the Fed may be a little self-congratulatory too early, given what's going on here in the labor markets.
Which might lend to their sounding a little bit more hawkish when they do speak, or when Powell speaks on Wednesday. One thing that does tend to happen is when you have higher rates, it makes share buybacks less appealing. Companies don't necessarily go out to borrow money to buy back their own shares. How significant is this loss of source of buying for share prices right now? Because we're in this blackout period for buybacks, and we've seen how banks have dialed back a lot of their purchases since the Silicon Valley Bank collapse in March.
Absolutely. I think people have to remember that buybacks are a function of really undervalued stock more than anything else, unless management is really out to lunch and they're buying back their stock at lofty valuations. Let's assume for a second that managements know what they're doing when they're buying back stock. And if that's the case, yes, when you get rising rates, you do depress valuations, but that should actually help stock buybacks. But the other side that I think people aren't really thinking about is, what effect does this have on other purchases leveraging? If you start looking at private equity, private debt, that whole marketplace, as their cost of capital starts to go up. Now, so far, that has not happened. Private debt has effectively negative interest rate deposits. There are the Fed, right? Because they get paid on capital committed. So they're sitting here with a bunch of deposits that they're getting paid on. It's negative interest rates for them. And the Fed can't touch them. And we all know how big private debt has become.
All right, Richard, going to have to leave it there. Always a great conversation. Richard Bernstein over there at Richard Bernstein Advisors, helping us count you down to the closing bells as we move closer to those bells. Our full market coverage right here on Bloomberg. It starts right now as we take you to the bell and beyond.
Beyond the bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu. We're counting you down to the closing bell, and here to help take us beyond the bell. It's a global simulcast with our friends Carol Masser and Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms on a Monday afternoon. Carol Masser, where the markets, at least in the equity space, don't seem to be doing much of anything.
Ho-hum, it's like we've got a Fed meeting. Oh, wait, we do on Wednesday. Yeah, it does really feel like we're marking time a little bit until we get kind of an update. Not necessarily. We all expect the Fed to stand down in terms of any kind of moves on interest rates, but nonetheless, it does feel like a little wait and see as we get as we get an update on the economic projections. Having said that, energy definitely stand out. We talked about it last time. Energy names are the outperformers in today's trade. This says I'm looking at Brent right now at 94.53, so definitely moving up almost at 95 today. We saw it get very close.
Okay, back to the Fed because they're meeting this week, and that's what everybody is waiting for. The summary of economic projections. Bloomberg Economics, Scarlett, is saying we're likely going to see that the median participant sees one more rate hike in 2023. The question is, when's it going to happen, of course, and is it going to be, what's it going to look like in terms of the next year or two? We just spoke earlier to our Drive to the Close guest who actually mentioned about 10-year yields, and he was basically like, you know what? We're at a normalized level of rates right now. If you go back in history, right? Yeah, he was like perspective here. This is Thomas Martin, senior portfolio manager at Globalt Investments, and he was like 4 to 5% on the 10-year. Kind of makes sense.
Yeah, a lot of people have been talking about that, particularly when you overlay it with the latest CPI data that we have. Maybe this is the restrictive territory. Maybe that's where we stay. The big question is, can the market handle it? Not much going on today in the price action, unchanged relatively across the board, with the Dow Jones Industrial Average higher by roughly 5 points as we wait for these numbers to settle. The S&P higher by about 3 points, and the NASDAQ only higher by 2. The Russell 2000, that is your relative underperformer on the day, down about 13 points or 0.7%.
Yeah, looking at the S&P 500, really kind of an even split. It's like investors are, again,
you didn't even need to show up to work today, Carol. You could have taken another day.
Hey, now you tell me. What's up with that, buddy?
All right, when you look at volume, no surprise, I guess, that it's about 22% below the year-to-date average. So we are marking time, as Carol put it. Let's take a look at the sector performances here. On the upside, you've got tech hardware. That's really Apple leading the way. Insurance companies and energy as oil prices continue to move higher, making fresh 15-month highs. On the downside, Tesla dragging down the auto companies by more than 3%. Of course, GM and Ford also in the red. Real estate investment trusts and telecom services all down by about 0.8%.
All right, so let's get to some of the individual gainers. Apple was top among the names in the S&P 500 and NASDAQ 100 today, finishing with a gain of about 1.7%. At its highs, was up as much as 2.5%. Mega caps, we did see in some of our write-throughs, kind of leading among the gainers today. Analyst commentary today, though, on Apple, focusing on pre-orders for Apple's latest iPhone. I'm going to need one. My husband's going to need one. I don't know about you guys. Anyway, there's a bit of a debate as firms note a preference for more expensive models, but see mixed prospects for the stock. So basically, analysts are trying to kind of...
Do you not have a phone now? Is that...
She has the first Apple Watch, guys.
No, I have the second Apple Watch.
I'm not kidding.
Hey,
I'm not kidding at all.
Some might say that's
barely
vintage.
Even tells the time.
Apple shares, by the way, are coming off 2 straight weekly declines, still up nearly 40% year-to-date, so not too shabby. DoorDash, I think you were talking about this earlier on TV, Romaine.
We were, yeah.
Okay, see, I do listen. Mizuho. Say it again.
Mizuho.
This is what happens. Yeah. I forget Bloomberg passwords. I can't speak anymore when I'm away for 2 weeks. Upgrading the food delivery
drinking on the job does that.
No, I'm not. Water only. Upgrading the food delivery company to buy from neutral. The analyst over there, James Lee, says he's confident that growth and gross order value should outperform guidance and street expectations in the second half of 2023. Price target to 105 from 90. What are we closed today?
Don't look, Carol. Just don't look.
Where's my?
It's in the red.
I can't
but
see
just
it.
barely.
80.92 is where we closed. And then Team Atlassian, top of the NASDAQ 100 today. Again, Mizuho reiterating its buy rating and $240 price target. Did I get it right?
No, but keep going.
After having learned that the company has announced a series of price increases to the cloud versions of flagship products, stock is up about 61% year to date. It's like being around my family, my 4 brothers, my 2 sisters.
That's a compliment.
What it's like. It is a compliment. I love.
Let's get to some of the gainers on the day. Scarlett talked about the autos and components up there. Tesla among the best performers in there.
Did you say gainers or decliners?
Did I say gainers?
See, I'm rubbing off.
See, I was doing gainers last week when you were gone. All right, let's talk decliners. Tesla finishing the day down by 3.3%. That EV price war that we've talked about quite a bit over the last few months, it's got at least one analyst concerned. We got Mark Delaney over at Goldman Sachs lowering his 2023 and 2024 profit estimates for the company. Delaney citing lower average selling prices and auto gross margin. He said that Tesla could further lower prices in 2024 to support higher volumes. We've seen the company have a pattern of doing that. That would offset any EPS benefit from a reduction in costs. Let's take a look at Moderna. Shares of COVID vaccine makers falling on the day today. This after Pfizer came out earlier today and actually gave a prediction about how many people are going to get that COVID vaccine. They said that 24% of the U.S. population that's recommended to take the COVID-19